Good morning. It is Wednesday, May 4th here in New York City. I'm Julie Hyman, joined by Brian Sozzi and Brad Smith. May the 4th be with you, as they say. Let's take a look at what's going on with futures here this morning. We've got a gain of about 8.5 to 9 points on the S&P 500 futures, good for a gain of about 0.25%. We had ADP come out with its private payrolls report this morning for last month. 247,000 was the read on that. That was well below economists' estimates for 390,000. And also there was a revised gain higher in March that we should mention as well. Larger businesses hired more, but it was the smaller businesses that accounted for that shortfall. Remember, we've got the big jobs report on Friday. 385,000 is the estimate on that. We've got Dow futures also heading higher. Nasdaq futures up a little smaller, just about 0.1%. And we also got to check on crude oil this morning, and that's because the European Union delivering its long-awaited proposal to suspend Russian oil imports. That coming from EU or EC President, I should say, Ursula von der Leyen. All 27 of the EU nations would have to approve of that plan, and there would be a phase-in period. So watching oil get a big bump this morning, up by 4%, Saz.
Yeah, I feel the anticipation for that Friday jobs report, but here are three things you need to know right now. A tale of two ride-share companies, Uber and Lyft shares both falling sharply this morning. The ride-share companies have both reported earnings, and the tones at each company couldn't be more different, guys. Let's start here with Lyft. This was, on paper, the quarter looked good. Active riders up 32% year over year. That was okay, but it was the guidance that is essentially squashing shares of Lyft here. The company guiding to adjusted operating profits of $10 million to $20 million. The street was at about $83 million. Not a good look.
Interesting quarter, too, on the driver front when you saw this 40% increase of active drivers. Let's remember, this was during a quarter where many of the drivers were also incurring higher gas costs as well. And then also they were talking about Lyft Pink. This gives us a little bit more insight into how they're competing against some of the rewards that competitive platforms like Uber, which we also know moved up their earnings, how they're competing up against them and where they're expanding even with these partnerships in delivery. Beyond just ridership, I think in that delivery segment, it'll be interesting to see what more they have to offer in the future and how that expands too. Yeah,
and you would think we would have sort of a tale of the tape this morning with two very different reactions in Uber and Lyft, but that is not, in fact, what we are seeing. Uber shares had made an attempt at a comeback, and now they've come back down. Lyft shares, meantime, with their decline this morning, are set for the biggest drop ever with that 26% decline.
Uber tried to be cute, moving up their earnings release. They're like, you know what, we're going to have a pretty good quarter. We don't want to get lumped into this Lyft route here. Now, initially, the stock did go green for a little bit, but the sell-off has continued in large part because I think what Lyft said on the conference call, more marketing, more incentives, and Uber is not going to be immune to this.
No, not at all. And I mean, thinking through Uber and what we were seeing there, gross bookings, that particularly came in to play there, growing 35% year over year. They wanted to really cast a lot of light on where those different segments, and given that they're vastly different businesses, at least in how diversified Uber is versus a Lyft that is so concentrated on the mobility, whether that be micro mobility, whether that be the drivers that they have to engage with. I think at the end of the day for Uber as well, looking at these comparisons, how they're going to continue to try and differentiate themselves is in all of those other services and trying to create this sticky ecosystem.
I mean, two big picture thoughts here. One is that both the companies are going to have to spend more. That's the bottom line. Yeah. And we're not necessarily even talking about inflation of the fuel variety, right? We're talking about trying to attract and retain drivers. Yeah. And guess what? Uber has that issue, whether you're talking about getting people from place to place or stuff or food from place to place. The other thing, when I think about Lyft specifically, there was one word that jumped out to me from many of the analyst notes. And it's not the word that you might expect, Brian Sozzi. Overdone. Overdone is that word. Most of the analysts I saw, even though they said, yes, this was a bad quarter, the drop is overdone when you look at that 27% drop in the
Well, we have John Zimmer coming up on the show, so we're looking forward to putting some questions in him. And I'll just add this, too. You still get the sense, though, these are two different companies. Lyft struggling with a lot of things. Uber, their adjusted operating profits in that mobility segment up 107%. That was pretty good.
Absolutely. Well, we're going to continue to talk about some more earnings that have come out. Another mover that we're watching is AMD reporting 71% growth in sales this quarter. The stock is currently moving higher pre-market by about 7%. The chip maker beat on both revenue and earnings here. There was really a lot to break down here, but I'm giving the trophy and the operating income to gamers. They were the real MVP here. The company talked about it on the earnings call, particularly saying that they saw the largest operating income through the enterprise, embedded, and semi-custom segment. That was up 218% year over year, hit $881 million and accounted for the lion's share of that operating income. And that was cited, or they were citing strong demand for Sony and Microsoft consoles, as well as some other Steam Decks out there too.
Yeah, and the company's forecast for this current quarter also coming in ahead. Sales forecast of about $6.5 billion, around $6 billion is what analysts had been projecting. So this continued growth that AMD is looking for. Its margins, by the way, are also catching up with Intel's. You know, there's been this long-time rivalry between the two companies, and I was looking at the sales growth for AMD, and it has just been incredible. If you go back to 2019 compared with now, there was just an incredible jump during the pandemic, and like so many of these pandemic plays, the jump has been sustained. If you look at that quarterly revenue, sustained and grown upon, right? It's still dwarfed by Intel's revenue, by the way, but the growth is really there.
Well, you know my thoughts on this. AMD is just an absolute beast. CEO Lisa Su continues to get it done. Three things that really stood out to me in this release. One, and I haven't heard this from Lisa before here, but on that conference call, noting that there's some weakness starting to emerge in the PC market. I have not heard this for about 2.5 years because everybody stocked up on PCs during the pandemic. But I would, read through that potential, maybe disappointing quarters at an HP and a Dell when they report in a couple weeks. Just something to keep in mind. Number two, cloud revenue. AMD continues to clean up in the cloud, really gaining a lot of business. Lisa called out with Alibaba, Amazon, Microsoft and Google. They also signed a deal with Meta, so they're cleaning up there. And last but not least, why you're seeing this stock up here pre-market, good quarter, market has come to expect it, but it was that guidance raise, Julie, that you mentioned. You're seeing now a complete re-rating in AMD because of that Xilinx acquisition, and that's in large part why they came out here and raised their outlook, and I would suspect you'll see estimates come up across Wall Street. You
know, coming back to that year-over-year comp that you were mentioning a moment ago, and even the growth since pre-pandemic time, I mean, I'm surprised that they didn't just insert the to-the-moon rocket emoji, because at the end of the day, when we looked at those comparisons year-over-year, and you've got it on screen here as well, I mean, that jump, the 71%, that is leading to the re-rating here. That's also leading to where they see other total addressable markets to make up perhaps for some of the declines that we may see experienced in the PC. They also mentioned that in that PC market, it's really kind of looking at where they are addressing the PC market and saying that they expect it, the TAM, total addressable market, to be flat to called down mid-single digits. Right. And so we'll see if that truly is the case moving forward from here.
Yeah, in terms of chip availability as well, we should just mention a brief word about what's going on in the chip market and obviously supply issues. AMD seems to think it's better positioned because its chips are higher cost, and so it thinks its manufacturer, the likes of Taiwan Semiconductor, will be more motivated to produce its chips over some lower price chips. We'll see if that continues to be the case. There's one other thing going on today that you should probably pay attention to. That's the Federal Reserve. It is meeting, of course, to discuss its next moves amidst soaring inflation. 50 basis point rate hike is broadly expected to be announced this afternoon. Yahoo Finance's Brian Chung, he's back in D.C. because the meeting is in person once again. No more Zoom Federal Reserve meeting. So, Brian, what can we expect?
Yeah, well, it's a bit of a cloudy day here in D.C., but it's going to be as clear as it could be from the Federal Reserve to raise interest rates by 50 basis points at the conclusion of the meeting today. Now, for historical reference, that has not happened. The Fed has not increased by a half point since May of 2000. So it's been over 2 decades since we've seen a dramatic move. Same situation as we saw in May 2000, where inflation is the reason for the Fed choosing to go with what I'm calling that king size bump. But the difference is that whereas inflation was above 2% in May of 2000, now it's currently almost at 7%, at least as measured in the personal consumption expenditures index. So the Federal Reserve is going to be very much predictable in terms of their action today. The question is, what could they do down the line? Now, there are 2 things to watch for. First of all, the balance sheet policy. We already know the Fed had begun preliminary discussions in their last meeting in March to begin a process of winding down their asset holdings by the pace of about $95 billion a month that would be ramped up over the course of 3 months. We'll probably get the finalized details of how they want to do that in today's meeting. But another thing to watch for is the Fed chairman's press conference, where there's been some chatter over whether or not he will try to leave on the table or take off the table even more aggressive move in future meetings. That could be, for example, a 0.75% interest rate increase. I guess you might want to call that maybe a mega bump or a giga bump. Either way, we'll have to listen in for that press conference commentary, again, in person here in Washington, D.C. That's going to kick off at 2:30. The press statement will come out at 2 p.m. and we'll have the full coverage of all of that.
Yeah,
on Yahoo Finance.
And Brian, this really has major implications, of course, because the jobs. As Brian was saying, really, of course, this has major implications for the jobs report on Friday, because if Powell comes out here and signals in that press conference that a 75 basis point rate hike is not off the table and that jobs number comes in hot, I can't see how the market would like that.
In a good news is bad news kind of environment like we find ourselves in, good news on the economic front and the data that we've seen and monitored, that the Fed is no doubt going to be ingesting, but then continues to spell out how much they might lean into that to continue the path of high rate hikes, to your point, 75 basis points. That was the CME FedWatch tool probability, actually the highest probability that we had seen, but we'll see what comes out in this meeting and then going forward from here, what that tone and tenor might look like from the Fed. All right, guys, coming up, why our next guest says that there won't be much surprise from the Fed today. We'll speak with ProShares' Simeon Hyman after the break. Welcome back, everyone. Treasuries are on the move this morning as the market tries to anticipate the Fed. As a reminder, we have our own Brian Chung on the ground for that announcement at 2 p.m. today. But first, a read on what's making Treasuries so cheap. Joining us now, we've got Simeon Hyman, ProShares Global Investment Strategist. Simeon, if you were to throw your own predictions out there going into this meeting, what are you looking for?
Well, look, the 50 basis points seems quite reasonable. I think what puts that in context is the fact that a lot of the Fed's work has already been done if you look at longer term expectations. First, the 10-year break-evens, they're somewhere close to 3%. We'd like them at 2, but 3 is not that far off, considering that current inflation is running much higher than that. And second, if you look at expectations for both Fed funds and the 10-year Treasury yield, you have expectations for Fed funds at the end of next year somewhere in the very high 2s, just shy of 3, which is historically not a bad place. You should have 1% real Fed funds rate. So that's looking like perhaps something a little bit more accommodative than that, but certainly not far off. I think the one thing that's a little interesting is that expectations for the 10-year 18 months from now are sitting only at about 3%. That strikes us as a little bit low because the real return on the 10-year should be more like 2% or so. So the odds of something with a good 4 handle over the next 12 to 18 months are pretty good.
Simeon, if the Fed comes out here in their press conference today and says they do not pull off that 75 basis point rate hike off the table and the jobs numbers beat on Friday above estimates, how much further does the S&P 500 fall into correction?
Well, a couple of things here. First, there's another piece that's doing part of the Fed's job right now, which is in alignment, which if we think about, say, back to the financial crisis, we had a little bit of a mismatch of the fiscal and the monetary. But important news this morning, the Treasury sales were actually shrunk. So there's been surprising deficit reduction lately. So there's contractionary stuff going on the fiscal side. So I'm not sure this would completely, let's say, freak out markets. But the earnings season has an important tell, and I think it says a little bit of something that's been going on over the last week or so. If you looked at S&P 500 earnings snapshot so far through the earnings season last Friday close, you had something like about 13% sales growth, but only 2% earnings growth. That waved the flag of margin compression. Now, in the last couple of days, that earnings growth number has risen to about 6%. Still noting a little bit of margin compression, but not as much. And I think that's part of the relief rally. So in part, the answer to your question is, let's see what earnings show up this week. And I think that may tell us more about how the market behaves. If we see margins hold up a little bit better, that's going to be a big tell, because so far, top line has been telling us that companies at least are generating revenue and the consumers remaining pretty strong.
Is there something, Simeon, it's Julie here. Hey, is there something in the sectors of the companies that are seeing better margin resistance here versus those that are not, that tells us about the broader environment as well?
Well, it does, and I'll actually go to market cap, which also tells a little bit about sectors. So this margin compression we're seeing in the S&P 500, we're actually not seeing it all in mid caps. So far, season to date in mid caps, you have very robust top line growth of over 20% year over year, but you're so far cranking out over 30% in terms of earnings growth. So that's a sort of forgotten piece of the markets. People forgot about in their portfolios and their minds. It might be a good time to rethink both. And yes, does that tell us something about where margins are coming from? Sure, you have a little bit more industrials. You have a little bit more of the cyclicals and mid caps compared to the tech-heavy S&P 500. So there is a little bit of a sector story here, absolutely.
A policy tightrope that the Fed is walking right now, for sure. And so what is the probability that you would put it at with regards to whether the Fed can continue in its policy and what they've projected thus far without tipping into a recession, mild or severe?
Well, the path to normalcy, and critically, we've got to look not just at Fed funds, but we have to look at the reduction of the balance sheet. So, getting to somewhere well past 2% on Fed funds is not particularly tight monetary policy in the context of even if we get down to 2 or 3% inflation. That's normal stuff. Again, 1% real is kind of a long-term normal, if you will. So I don't think that there's such a risk of of the Fed freaking out markets from being too aggressive on the tightening side, at least based on the expectations that we all see. Even if we saw 75 basis points today, I don't think that's the that's the element that will really upset markets. The tightening piece is important. If that piece is really accelerated, then the long end could jump up a little higher. Remember, we have artificial suppression of longer term yields. We should be at 4 or 5% on that 10-year right now in the absence of quantitative easing. So I'd look for the pace of tightening to be at least as important as any surprises on the Fed funds rate itself.
Simeon, I hear what you were saying about 6% earnings growth, but just based on what the Fed is doing on rates, do you think corporate America is now prepared to go into a period of negative earnings growth, of course, including what's happening with inflation?
Well, it still seems unlikely that we're going to have an earnings recession, even putting aside the question of broader stagflation. So I do think that companies will manage to stay more or less on the positive side. But you have to watch some specific company-specific factors that are relevant right now. I'll give you one example, and it starts on the fixed income side and can bleed all the way into the bottom line. Folks are very enamored with floating rate debt right now because the floating rate piece keeps you whole on in the face of rising interest rates. The challenge with companies with floating rate on their balance sheets is that they're on the hook for it. So your protection as an investor is coming from those companies with the floating rate obligation having to pay higher and higher coupons. The benefit for companies with fixed coupon debt is just like your mortgage becomes more trivial over time. So I think there's some, I don't want to call them idiosyncratic, but there's some things to look for, whether they're sector or capitalization, market cap size, large versus mid, whether they're cyclical, technology, but also looking into the structure of how companies are financing themselves, because it looks so far that top lines are going to hold up. But if there are elements of either your financing structure or your cost structure that put a little bit more headwinds on there can be some companies that will struggle.
Simeon Hyman, ProShares Global Investment Strategist. Always good to see you. Have a great rest of the week.
Thank you.
Coming up, Starbucks CEO Howard Schultz has found a few ways to recaffeinate the bottom line of the coffee giant after a soft quarter, and you see shares up 7% in the pre-market. We'll have more on this next. Welcome back. Lots of earnings to get through this morning, but let's start with Starbucks. The master orator, Howard Schultz, appears to still have some juice on Wall Street with the stock rising after a weak quarter. Julie liked that one, right? I hand wrote that one myself, put it in the prompter. But look, I have seen this time and time again covering Howard Schultz. First, when I was an analyst, he would hop onto an earnings call. The stock would be down after a disappointing quarter. This guy hops to the mic. All of a sudden, Starbucks shares are popping in the pre-market. After hours, they turn around, and we're seeing it again here, laying out a lot of things. I think, I have a piece on the Yahoo Finance homepage right now. I think he wants to turn Starbucks into a McDonald's. Put more drive-thrus in its stores, put in new technology, turning to more of a fast food place instead of that third place, that thing that he's been pitching for decades where you sit in there and scrub free Wi-Fi.
Okay, let's talk about the numbers for just a second, because it is so interesting to me that the shares, to your point, are up 7% after he talked. Yeah. The numbers were not great. Okay, so earnings per share missed estimates by 2 cents. Operating margin, 12.4%, missed estimates. U.S. comps were the bright spot here, to be sure. And revenue, you can see, beat by a little bit. U.S. comparable sales up 12%, but global comps were up 7%. 7.5% is what analysts had been looking for. China comps down 23%. And we see that in a number of different food-related and just anything-related earnings for this season, is that China is a weak spot. So we're definitely not talking about universal strength by any means. I agree with you that it's the Schultz effect, if you will.
And I mean, internationally, you bring up global. Internationally, China has been such a big part of their growth strategy. Anytime you see a massive shutdown, lockdown, like we have seen over the past quarter, impacting Starbucks very much head on. The ticket price decline, 4% decline in average ticket, and then additionally the global comp store sales that they saw continued headwinds there, and who knows when those are going to lift, quite frankly, going forward, and some of that pressure. But coming back to Schultz, is he a Michael Jordan type figure for Starbucks, wearing 4-5 when he comes back this time, and a very different message, to your point, that he is pitching, because now it's about how do you streamline the amount of hours that are worked, the amount of square footage that you've got, leaning into some of the digital investments as well, and what does that look like for the number of employees that you need to make that happen?
Well, he the past month, he started on April 4th officially as CEO, and his global listening tours that he has been on have been a disaster. He has put his foot in his mouth repeated number of times. But we may not have to worry about Michael Jordan sticking around Starbucks for much longer. They talked about, Schultz was mentioning that they will likely have a successor sometime by September. Now, there's a key analyst day in September. Wouldn't be surprised if a successor is announced this summer, and then they could show off this likely much younger person who understands NFTs at that investor day.
Starbucks and NFT, that's where we're going, right? We didn't even talk about what he said about unions, right? He kind of came out swinging against this whole union push on the part of the company, and talked about the things that Starbucks is going to do effectively to try to combat them, raising its average wage to $17 an hour. It's giving tenured employees another pay rise. So spending $1 billion overall on some of these measures. I was just telling you guys on an anecdotal basis, I passed a Starbucks the other day that had a hiring sign outside that said the starting wage was $14.50. Now, that 17 is an average, but still, it's interesting to see that kind of a number.
He's fraying his workforce. It was just startling to hear this talk from a one-time Democratic presidential hopeful, talking about, we're going to give you, if you're not part of a union, we're going to give you raises, we're going to give you more training, and then for all you union folks out there, well, you could just go there and negotiate your own thing. You're going to have to negotiate, maybe you got a couple more bucks.
Democratic independent, right?
Yeah.
Yeah, he was definitely centrist, to be sure. Okay, important question. Standard Starbucks order.
I go black coffee. Our producer Val, she orders these really complicated drinks that cost $8 in 25 minutes to make, and that's a reason why they're coming out with these drive-thrus and probably more machines in the store to make drinks for our producer like Val.
Throughput is the challenge. That's their buzzword for getting stuff. What about you,
Grande
Brad?
French vanilla Pike Place. A little bit of room.
Grande French
That's simple.
You have to spit it at them very quickly.
We don't need machines to make that.
That's simple?
Yeah, I think it's simple.
Yeah.
I go veranda with half and half.
I think Val's got a double Oatly, 12 sugars, and 5 shots.
All right. Yeah. We don't have to. Let's give her a break.
Oatly,
it's okay.
bad quarter for Oatly.
What does the Starbucks NFT look like? That's the question.
I don't want to see it.
Siren.
It's with the logo.
It's got the siren logo.
Yeah, I assume so.
If you say so.
All right, we got the opening bell coming up, ladies and gents. Grab your coffee and get ready for a busy day of earnings. right, there's the opening bell on this Wednesday morning. I keep having to remind myself what day it is. It is Wednesday, day May 4th. I should remember that as well. You're going to tell me it's Friday?
It's Friday.
Don't toy with my emotions, Brian Sosby.
The Fed already raised rates.
Yeah.
So we're taking a look at stocks that we're indicating a higher open here this morning. Of course, everything could change at 2 p.m. when we hear from the Federal Reserve and get that press conference. But right now, the bias is slightly to the upside, but we're going to be awaiting some bigger action later on. Let's take a look at CVS. That's one of the other companies that was out with its numbers this morning. And CVS, which has really become a bigger, more complicated company over the past few years. The company coming out with earnings and sales that beat estimates here, and it is also raising its forecast for full-year profit, now saying profit for the full year going to be as much as $8.40 a share. $8.30 was the prior upper end of that. But the shares are not gaining much traction here. Now, a lot of the continued demand for CVS has been what's been going on with tests and vaccines. 6 million COVID-19 tests, 8 million vaccines nationwide in the first quarter of the year. That is what CVS administered. One would have to think, especially judging by what we've been hearing from other companies in the industry and the drug makers, that is going to wane as the year goes on. You see the breakdown there. Pharmacy services is now the biggest part of the business, which is quite interesting. That revenue of $39.5 billion, by the way, was a record for CVS.
I think this really speaks to, and we don't talk about this a lot when it comes to perhaps some of the pharmacies out there, but this vertical integration and really using all of the findings from over the course of the pandemic where people were stocking up on everything from toiletries, then even into some of the NyQuils, the DayQuils, and then additionally, how do you add on and layer on to that the different pharmacy services going forward from here and healthcare services. And I think for CVS, what we have seen is this integration that was started back in 2017, 2018, when you saw a lot of consolidation between the pharmacy benefits managers and some of the insurance businesses. That's what really kicked off this opportunity for that line of business to now be putting the team on its back, as Marshawn Lynch would say.
Yeah, we've also seen, I think, a reinvention of the CVS store, the actual physical store under CEO Karen Lynch. And you're starting to see in the results. Sales up 9.2% in that core retail business. Operating profits up 15.1%. Anytime you see that dynamic, that is a good thing. And of course, we not see it at Starbucks. But I walked in the CVS buyer office yesterday. I walk in, rows of eye creams, tooth whitening, various items, Beyond Meat sausages I think I found in there too. It's almost turning into a high-end supermarket here, and I like it.
That's been a process that's been going on for several years. Yeah. Just one side note, with Brad joining us here on the desk, I'm really going to have to, get on board with the sports analogies. The Michael Jordan one, I sort of got, right? Yeah. The return. Marshawn, what was the other one?
Marshawn Lynch. It's more of a Skittles reference than anything else. Got you covered.
Tiger Woods plays golf.
Val is telling me to say beast mode. I don't even. I have no idea what any of this means.
100%. Well, another company that's going beast mode on the shares today is Airbnb. You're seeing shares move higher by about 5.4% right now, and this is off of the most recent earnings that have come out. And continuing to track what's going on with Airbnb, I think the company and the demand that they're seeing right now. You're looking at the actuals versus the estimates. They beat on both the top and bottom. Revenue coming in at $1.5 billion versus that $1.45 billion. And then additionally, EPS slightly, still a loss, but lesser than expected here. And I think it's really what they forecasted here. Some of the demand that they're seeing going forward, and perhaps we'll get into it more when we talk about Marriott and kind of compare and contrast the two. But for Airbnb, I think that one thing that they can latch onto from the pandemic is the amount of people that are looking for these unique stays and a more clean opportunity, knowing what the kind of turnover or turn down process is like, and how much people are actually involved in that too, perhaps to their own disgruntled nature as a stayer at a few of these Airbnbs in the past.
We were showing some of the numbers on the screen in terms of the number of nights and experiences that were booked. That 59% increase. Daily rates are also higher, by the way. Gross booking value $17.2 billion. That was ahead of estimates. And when you talk about the forecast here, Chesky saying, Brian Chesky, the CEO, is saying that the company's seeing higher than historical demand for the fourth quarter. So it's very interesting here. He basically is saying yes, we're seeing big demand for the summer, as most of the travel companies are, but it's not only for the summer, it's beyond that as well, which I think is quite interesting.
Yeah, also interesting too, Brad, you mentioned long-term stays. Long-term stays on Airbnb at an all-time high, doubled versus the first quarter of 2019, or of course that is pre-pandemic. The average stay for an Airbnb for longer-term stayers, 28 days. That is very long. Secondarily, and to your point, Julie, April, 30% more nights booked in April for summer versus 2019. That is a good stat as well. And then something we can mention with Marriott too, Airbnb noting a return to urban rentals instead of rural. Rural, of course, a lot of people left the cities during the pandemic. Now they're coming back and apparently they want to stay in urban cities again and maybe order $12 Starbucks drinks.
Oh, we were going to mention Marriott real quick. Sneak it in, Saz.
Marriott, I like they came back with their dividend this morning. We saw that from Hilton yesterday. That was a good thing. Also, Marriott noting a return to urban travel. They're seeing business demand starting to come back as well. There you can see a couple of Yahoo Finance hot takeaways on Marriott's earnings. But again, good quarter from Marriott, and we'll be talking to Marriott CEO Anthony Capuano pretty much right at the 11 o'clock hour. Looking forward to catching up with him.
It's wedding demand right there.
Yeah.
It's all the people that are coming back to cities to do the bachelorette parties. And well, from my own end.
Are you trying to signal something for us?
Not at all.
Gotcha.
Not at all.
All right, back to a couple of companies we mentioned at the top. We just got to check on them. We've got Lyft shares indeed down by a record and down by even more than they were in pre-market trading. 29%. As I mentioned earlier, a lot of analysts think that drop is overdone. The market is thinking otherwise. Uber shares also getting caught in that downdraft, down by 10%, even though its numbers looked a lot better than Lyft's. Moderna, that company, a little bit of green on the screen there. Those shares up by 2%, and that's after Moderna's numbers came out way ahead of estimates. We are going to talk to CEO Stefan Bancel in just a moment, and Match Group reporting its numbers as well as a new CEO. Those shares off by 11%. Coming up, as we mentioned, those Lyft shares are plunging after the ride-hailing giant pumped the brakes on guidance. We'll speak with the co-founder on the other side of the break.
Lyft is pumping the brakes on guidance as the company picks up its investment in driver incentives and technology ahead of peak summer demand. Shares are getting hit hard this morning on the below consensus outlook, but the company did see first quarter active riders increase by 31.9% and delivered adjusted operating profits. Joining us now to discuss all this is Lyft co-founder and president John Zimmer. John, always nice to see you here. So I think it's the second quarter operating profits guidance that has spooked some on the street. Where are you putting this investment money, and why are you making this investment now?
Sure. So it's sometimes hard to remember that just the quarter we reported on had the largest spike in COVID cases with Omicron. And so we are investing in what we're seeing as a big opportunity for demand to increase going into Q2, going into the second half of the year. So we're investing in bringing the marketplace into more balance, continuing to have better and better ETAs. So that means investment on the supply side. That also means investment in our team that's working on the marketplace technology. We're finding that team is able to drive tens of millions of dollars of ongoing leverage as the business expands. And so the simple explanation for Q2 is we want to kickstart the post-pandemic growth. And we feel like it's a very smart, strong ROI investment.
What do you see, John, as being out of balance in the market right now?
It's less of it being out of balance. In fact, the ETAs for our marketplace improved by 30% year over year. It's more that we see a big wave of demand on the horizon. And you typically have to invest forward or pull forward investment to get ahead of that demand on the supply side. Demand can turn on a dime coming out of, for example, the COVID spike where people open the app and tap a button. And supply typically takes a few months as you bring new drivers onto the platform. We are happy seeing more drivers come on the platform year over year, 70% increase in driver activations. So it's less about seeing something that we don't like. It's more about seeing something on the horizon that we're excited about and want to lean into.
Does that horizon include, additional partnerships like we've seen with Olo or an expansion of the Lyft Pink program as well?
The Olo piece you referred to, the partnership, is on the B2B delivery side. And so, yeah, that emerging business is doing nicely. We have pilots now in hundreds of cities. And it's going well. So we'll continue to scale that. In terms of the Pink, which is our overall subscription service, we're also happy to be adding more benefits to that, and we'll have more to say towards the middle of the year.
All right, we'll be staying tuned for that. Additionally, there was an interesting analyst report out. New Street was looking for the potential or exploring the potential of a merger between Lyft and a company like DoorDash. Does that even make sense at this point for the business? And what kind of growth opportunity would that unlock if you would explore any type of merger with a company?
That's not something we're exploring. We're 100% focused on transportation. And we believe that's our strength long term. So what that means is when you open Lyft, we want to have something for you when you go from A to B to serve every ground transportation option. So that starts with the bikes we offer. We have exclusive contracts in cities like New York where we operate City Bike. That goes to rideshare, that goes to shared rides. We now have first party and third party rental cars. And we're even looking at services that we'll have more to say about to help you, if you own a personal vehicle, save thousands of dollars a year. So what we do is transportation focused, and ultimately we think that's the right strategy.
Hey, John, it's Julie here. I'm curious how promiscuous your customers and drivers are. In other words, we tend to see this as a two-horse race between you and Uber. If people switch, whether it's drivers or customers, do they tend to sort of bounce back and forth depending on where they're finding the best deals? Or are you finding that if you've gained market share or if they've gained market share during this period, that's pretty sticky?
There's kind of the three segments. There's the Lyft loyalists, the other loyalists, and then those that look at or haven't really committed yet to one of the other options. So the Pink subscription that we were just talking about is one of the ways we're investing to increase Lyft loyalists. If you look at share kind of pre and post pandemic, we see it as having remained stable, which is in light of the fact or in the face of the fact that we didn't have an Eats product, which people thought would advantage our competitor. It hasn't. And in light of the fact that the West Coast, where we over-index on share, and shared rides, where we over-index on share, have been slower to recover than the East Coast. And shared is just starting to come back. So we see that as continued upside specific for Lyft, and is also part of the reason we want to get ahead of that growing demand and invest on the supply side.
John, obviously you have seen what your stock price is doing today. And I know that corporate executives like to say we're focused on the long term. We try not to pay attention. But that's got to get your attention, right, when you see a drop like this. So what conversations are you guys having in the executive suite right now? What message are you trying to get out as the shares are down 31%?
Yes, I'll be crisp and clear. We do not like that. We do see it. That said, we are focused on increasing shareholder value over the long term. That might sound like a soundbite, but it's the reality. And so we question all the decisions we make when we see something like that. We take our investor feedback. We talk to our investors. We take it extremely seriously because ultimately we intend to drive a significant return on investment in the stock. So we're talking about, what could we do better to provide more details on the investments that we're making and the ROI on those investments. So what specifics can we provide that will give people confidence in the leverage we're going to be driving in the second half and into the future?
Well, John, just staying on that, what could you do? And then secondarily, you have a lot of cash. Do you see yourself coming out here and buying back the stock?
I'm not going to talk about buybacks. I think I'm restricted from talking about anything related to that. And the other question was around what other specifics can we talk about? Yeah,
what other specifics? What else can you, in terms of details, can you provide investors just to alleviate any concerns?
Yeah, I think we can look at providing further guidance into the second half. So what is this investment that you're telling us you're making in Q2 gonna do for the second half? And so we've decided to leave ourselves a bit room without providing that guidance, and I think we're seeing the impact of that in the stock going down. So that's something we're discussing. We are confident in the ROI. We've been in the industry for 10 years. We understand the investments needed in the near term to spur on additional growth. And as a reminder, we just reported on the prior quarter, which had the largest spike in COVID cases, and that's an inorganic action within the market that we respond to in Q2 with further investment because we see demand increasing. So we'll just look at more ways we can articulate the specific investment we're making, the specific return, and the improving leverage we will have on the business model in the quarters to come.
Well, I know it's been a long few hours, I'm sure. We appreciate you taking these questions. Lyft co-founder and president John Zimmer, good to see you. We'll talk to you soon.
You too. Thank you.
Coming up, we're live with Moderna CEO Stefan Bancel, fresh off his earnings call with Wall Street. Don't go anywhere.
A big beat for Moderna in the first quarter. Earnings per share and revenue blew past Wall Street estimates for the beginning of the year. Joining us to dive more into these numbers is Moderna CEO Stéphane Bancel. Yahoo Finance's Anjali Khemlani joins me as well. Stéphane, thank you for being here. Let's talk about that beat, first of all, and where it came from. When we're talking about the earnings per share beat, it's in particular large. I know you guys did some stock buybacks, which may have accounted for some of that beat. What else? What else drove the growth in the quarter?
Well, good morning, and thank you for having me. Well, I think first is strong sales. If you look at the sales compared to last year, we've increased the sale by 3x, 6.1 billion. Last year, 1.9 billion for Q1. And then I think also the operational leverage that we have on volume. Moderna is a pretty efficient company. We started, as we built it, to be very digital across the board, very industrialized. So as we get more volume, we get a lot of economies of scale. We're able to increase, net income by 3x as well. The share reduction helped a little bit, but we're talking, 5 million shares out of 400 million shares. So what is good is in Q4 and Q1, we're starting to reduce the float of a company, which means every investor owns a bigger chunk of our future cash flows, which is great. But it was not driven by the share count.
And I don't believe you came out with any earnings guidance for the full year, but can you tell me broadly if investors should expect that same sort of growth for the full year?
So we didn't give precise guidance, because none of us has managed the transition from a pandemic to an endemic setting for obvious reasons. But what we gave is kind of a framework, which is we confirmed this morning that we have signed advanced purchase agreements with governments around the world for $21 billion. And then David, our CFO, went and kind of described in terms of investment in R&D, which we think would be around $4 billion this year, and tax rate and so on, how people should think about modeling the year. What is interesting is in these $21 billion signed APAs, there is nothing for the US. And the reason is very simple. Those are signed contracts. As you're highly aware, there's currently no funding from Congress to buy more vaccines for the fall. So the US government is not able to buy vaccines now. What we are doing as a company is we're, of course, getting ready, assuming there is no contract. If there's a contract, it will be kind of easy. We will sell the product to the US government like in the last 2 years, and people will have access to the product in their local pharmacies like we have today. But if this doesn't happen, we're getting the company ready to be fully commercial. This might actually provide some upside, not only on sales, because there's zero sales assumed in 21 billion, but also on pricing. CMS has basically come up saying that for fiscal year 23, which starts in October, the price for COVID-19 vaccine should be around $60. As it's public information, the price that the US government paid in the last 2 years was 16.5. So you could see there's some upside there as well.
Stéphane, on that specific point, because you don't necessarily have the agreement right now, do you have any signal from the U.S. government or the FDA to sort of plan for boosters? And if so, what do you see as sort of the need for the fall?
So in our discussion with the U.S. government from, the different, agencies, CDC, FDA, HHS, and so on, it is very clear that people believe, like we do, that because of waning immunity and because of new variants emerging and being more and more infectious, it's going to be critical to protect people in the fall and winter, that the vaccines are not going to held efficacy-wise for people who got boosted, last November or December or January. And so they believe there needs to be a new booster. And they also believe that what we have as an Omicron-containing booster, which is a bivalent, so there's 2 mRNA in the vaccine being tested in the clinic, which we should have the data for in June, hoping for an authorization in the August timeframe to be able to stock the channel. That's what they want. It's already a problem of funding, not of desire of getting the product. And so we're just getting ready so that Americans can have access to vaccine in case of the US government not getting funding.
So right now you're operating as if the U.S. government is not going to fund. Do you anticipate that will come through, though?
I think it will come through. But again, given I'm not in control of what happened in Congress, I just need to be ready for the alternative, which is we have to go to a typical, what every pharmaceutical product does, private market. And we'll be ready for this. We're having a lot of discussion with wholesalers to make sure that we have all the PCs contracting and so on to be able to operate like a normal pharmaceutical company.
Stefan, let's talk about not just the variant that you're developing to attack Omicron, but also for younger children, because we know that you're putting in your application for an EUA for the youngest cohort. We've really become accustomed to the FDA being very speedy when it comes to vaccines for COVID-19. Do you think they're now dragging their feet on these sort of latest versions or the vaccine for children?
So I don't think the FDA is dragging their feet. At least the people we interact with, are working really hard to help protect American people, like we have seen happening over the last 2 years. I think what the FDA is on the record saying is that they want to review the Moderna and the Moderna and the Pfizer vaccine at the same time for the pediatric setting. And to the best of my information, Pfizer has not yet shared publicly the data with a third dose. You might recall they tried with 2 doses for pediatric. It didn't seem to be enough. And so they're trying with a third dose out of the gate. So that would be a 3-dose primary series to start protecting young children. We have shared data with 2 doses, which we believe is a very strong vaccine. Our dose is higher than Pfizer. You remember this is the case for every product. The primary series in early 2021 was higher than Pfizer. The booster is almost 2x the Pfizer dose. So our dose, even for children, even if it's lower versus adults, is higher than Pfizer. So we believe our 2-dose vaccine will work, and we believe a lot of parents, if authorized by the FDA, will like the idea of only getting 2 shots in their children versus 3 shots.
Stefan, for looking at, out in the fall, the future, you're talking about waning immunity. And of course, there's still a little bit of uncertainty for the U.S. government. Do you anticipate that because of this waning immunity, we could see the surge then be impactful enough that maybe we have to put in more restrictions and go back to limited offices?
That's the risk we all have in the fall, which is, if you think about it, this virus is not getting less infectious. The way biology works and evolution works is only one way, is more infection. And so as you see more and more infectious variants, and you see now the BA4 and the BA5, and you're going to keep seeing more, we're not done with this virus mutating. So on the one hand, you're going to have more and more infectious virus, and on the other hand, you're going to have waning immunity. And so as you described, the biggest risk we have in the fall is that if people don't get boosted, you're going to get a lot of people sick. And if you get a lot of people sick, those that are highest risk will get hospitalized. And this is where you get, again, too many people in the hospital, and we go at it again. So I think we have a risk in the fall that if we don't have the booster campaign under control and do it early enough, that we might be in a not great spot in the fall.
Well, hopefully you're wrong, but you probably know a lot better than I do. Thanks so much, Stefan, for being here. It's good to catch up with you, Moderna CEO Stefan Bancel and our Anjali Kemlani as well. We'll be right back with a check on the markets. Crossing just a moment ago, the measure of the services sector in the United States coming in a little worse than estimated. The Institute for Supply Management Services Index coming in at 57.1, 58.5 was the estimate. This follows on a similar measure from S&P Global that also came out below estimates. And remember, this is still expansion. Above 50 is still expansion, but we did see prices rise. An index of prices paid by firms for materials and services jumping to a record 84.6 in April. So this could be something that could be putting pressure on things there. What's interesting about the services number is services was supposed to sort of take over for manufacturing growth, if you will. And indeed, we've seen an uptick in services, but a little bit of slowdown reflected in these numbers. We're still seeing a mixed picture for markets because most of the focus for market participants remains on the Fed this afternoon. Coming up in the next hour, we're going to break down expectations for the Fed with Lux Capital's Josh Wolf. That's on the other side of the break.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Markets are, well, we're seeing some nervous action here, mixed action, I should say, ahead of that big Fed meeting later on today. The only index in that green right now is the Dow Jones Industrial Average, and slightly, I should say. Now, here are three things you need to know. Hailing a stock crash, Lyft shares are getting smoked as the company issued a big profit warning for the second quarter as it invests in driver incentives and marketing. Lyft co-founder John Zimmer told us moments ago he and his team are looking for ways to address fresh investor concerns. And booking a good quarter, Marriott joins rival Hilton in bringing back its dividend as its business continued to recover from the pandemic in the first quarter. The company also said today it saw strong demand in April and may begin buying back stock soon. We'll talk to Marriott CEO Anthony Capuano at the top of the 11 o'clock hour, so mark it down. And gobbling up Whoppers. Burger King grills up a big quarter overseas as diners become more mobile and reach for a juicy Whopper. We'll talk with the CEO of BK parent company Restaurant Brands in just a few minutes. Now let's get over to Yahoo Finance's Inez Ferre over at the Wi-Fi Interactive. And Inez, it's a whopper type of Wednesday.
It sure is, as we await for that Fed decision. So the markets may be mixed for right now, but oil is going up. Take a look at WTI. It's up 3.5% right now. And this is because of the situation in the EU. The EU putting out a plan to phase out Russian oil imports. So this is sending Brent crude higher to $108 a barrel, just above that. And take a look at natural gas, up 5%. In fact, I'm going to pull up a 1-month chart. Natural gas futures up 46% over the last month. Taking a quick look at where we're at with equities, as I mentioned, mixed markets right now. Over on the Nasdaq 100, we are watching Amazon down 3%. I'm going to pull up some of the outperformers being Starbucks, Airbnb, and AMD on the upper left side. And also you've got Datadog, CrowdStrike, these stocks that have been under pressure over the last couple of sessions. And over on the sector action, we are watching energy stocks that are outperforming right now. Consumer discretionary down more than 1%, guys.
So consumer discretionary staying there, that is one of the most shorted as of right now.
Yeah, that's right. And that's according to the S&P Global Market Intelligence. What they came out with was a chart basically of all the sectors. Consumer discretionary in April, the most shorted sector in the markets. And what's interesting is that it's a sector which, when you look at the subsectors, the shorted stocks in that subsector, you can see there. Home furnishings, followed by computer electronics and department stores. So home furnishings, that would include Bed Bath & Beyond, that would include Williams-Sonoma. And this would make sense because if we see higher inflation, people can spend less on these products if we do roll over into a recession.
All right, that looming over us, isn't it? Thanks so much.
Yeah.
Appreciate it, Inez. Also looming over us and very connected is today's Fed meeting. Of course, the Federal Reserve expected, as we know, to raise rates by 50 basis points. Our next guest thinks that'll be it. That might be the last hike we see for a while. He called it a contrarian take, the most contrarian take in a recent tweet. Yeah, I think that's accurate. Josh Wolf is with us now, Lux Capital co-founder and managing partner. Josh, good to see you. Lay out your case here. Why would this be sort of a one and done or one and done for now from the Fed?
You know, it's interesting. The last few segments you had, you were talking about ISM is down. You were talking about oil prices are up. Consumer discretionary is down. I actually think consumer discretionary is going to continue to go down, not so much for rising prices that people can't afford it, but demand was pulled forward during COVID, and people don't need their extra Peloton. They don't need more clothes. They don't need another computer. They basically pulled forward years of demand. Consumer staples were getting crushed. And these are the poorest people in the country who are the most hurting. And they've got food and fuel prices that are rocketing. And I think we've got a time where you've got, 11.5 million open jobs. It looks like we have full employment. The Fed's double mandate of price stability and full employment means that, okay, they're going to, try to attack inflation. But I think this is mostly a supply issue. I think this is mostly an issue also of a transferred wealth effect. For the past generation, you've had this Goldilocks expectation of soft landings every time the Fed gets involved. And mostly, even though they're supposed to manage price stability and employment, they've been managing the stock market. And the reality is they transmit this wealth effect. It adds collateral to borrowing and margin accounts. Companies and CEOs and boards are buying stocks back, and they're doing it at ever record valuations. All of this distorts valuations horribly. Everyone has had this Fed put mindset for the past decade, just buy the dip. And so basically the cost of capital was too low for too long. And the lower the cost of capital in my business, we were beneficiaries of this. So I'm being really intellectually honest here that, you'd have these 20-year far out fanciful ideas that basically became these 20-month frenzied projects. And now you see this sort of excess and exaggeration and the absurdity and the frauds that are starting to come out in the tech world. And you can see this, by the way, in the TV shows, right? You look at the Uber show, Super Pumped, and the WeWork, We Crashed, and then the Theranos story in The Dropout. Those were all excess, exaggeration, and absurdity. So right now you've got the Fed basically trying to land a plane. And the risk of oversteering, where you've got passengers in the back, some of whom are suffering from these consumer staples, and they need painkillers. They need rubbing alcohol to heal their wounds. And it's sort of a mixed metaphor here, but they need low rates. And they got to make mortgage payments, and they're taking out more credit, and they got to pay for basic food and fuel. And then you've got others on the plane who are basically partying, and they want the pills and the alcohol just for continued speculating. And so you have a situation where the Fed was too slow to act when the economy was growing, and now it risks being too fast to act when the economy is slowing.
Okay, and so for a Fed that was continually leaning into transitory for quite some time to the point of detriment, and then acknowledged later on how much that actually may have hit on their perception. If they did do a one and done, as you mentioned, how much would they continue to have to be concerned about that perception of how the Fed is navigating right now?
Well, part of this is how much does the Fed care about its credibility, and some of this, we're finding out maybe, Powell delayed some of the views that inflation wasn't transitory for political reasons. That aside, yes, 6 months ago in November, the Fed finally says, okay, inflation isn't transitory. It takes another 4 months from that point, just in March, to get its first quarter point hike, and then paring back the $40 billion of monthly mortgages. Now, I expect you're going to see 50 basis points today. Could you see something in June, maybe another 25 points? Maybe. But I really think that the pressure is going to be on between political pressure and just actual, even though we have lagging data, a really hit hard suffering consumer. You add on top of that quantitative tightening that's going to start in June of $90 billion a month between mortgage and other debt that they're pulling back. And so I think the market in anticipation has rightly been guided and has already taken rates up. We now got the 10-year at 3, even though we've got a flat curve across the board. The 2, 5, and 10-year are all approaching that. So the big question is, does the Fed keep going and then tip us further into recession? And I think they got a lot of criticism and will get a lot of criticism for not acting soon enough. And I think the new criticism will be that they acted too fast and too hard when all the signs are that we're about to hit a really hard recession.
Josh, as you mentioned, you're in the VC world. You got a lot of folks on the other side of this trade, as you well know, right? As you called it, it's a contrarian take. And most folks are very much in the other direction, that we're going to see multiple 50 basis point increases this year. Some folks even calling for a 75 basis point rise, at least one of them. If the Fed does what you're suggesting, you would then presumably get a tightening of financial conditions, which could then exacerbate some of the issues that you're talking about. So I wonder if the Fed is really going to weigh the risks in the direction that you're talking about.
Look, nobody has a perfect crystal ball. We'll know today at 2:00. We'll know again in June. My view is the conditions for tightening are already happening. You've got bond and stock market investors that are dumping, right? And so you're seeing a correlation between fixed income and equity, not usually correlated, just decline. People are basically saying this is not a time to be greedy and lean in and speculate and try to make money. You're going to have a whole camp of people that are basically like, now is a time to not lose money. So if we went from FOMO, fear of missing out, and then I coined this term SOBs, shame of being suckered, you didn't want to do something really stupid. I think you've got pull now, which is going to be either the pleasure or the pride of losing less.
SOBs, I like that. I will be using that somewhere at some point this week. Josh Wolf, co-founder and managing partner of Lux Capital. Always good to see you. All right, before we head to break, let's fire up a stock chart of Tinder owner Match. There is no love being shown to the stock as the company surprised Wall Street by announcing a new CEO. Current Match CEO Shar Dubey will hand off the baton to now former Zynga executive Bernard Kim. Perhaps the transition shouldn't be a total shocker. Match shares have plunged 47% over the past year. The company also said first quarter revenue at Tinder only rose 18%, slowing from a 23% growth rate in the fourth quarter. Coming up, trouble for Whole Foods. Julie is back with a look at this one and a few other headlines you need to know. We'll be right back.
A reach for the stars. Roku and private equity firm Apollo Global Management are teaming up in a joint bid for a minority stake in Stars. That's according to people familiar with the situation. In November, Lionsgate announced it was looking to spin off or sell Stars after acquiring it for $4.4 billion in 2016. We'll have to keep an eye on further developments on the matter. Apollo Global Management is, of course, Yahoo Finance's parent company. And Whole Foods is scaling back. Amazon-owned Whole Foods will close 6 stores across the United States, 5 slated to close by May 6th. The remaining store set to close in the coming months. This move comes after Amazon reported its first quarterly loss in 7 years. Whole Foods did not specifically indicate the reasons for these closings, other than that this decision comes after the company's regular performance and growth potential evaluations. And in Ohio, the competition heating up for the state's open Senate seat. Trump-backed candidate J.D. Vance defeated 6 other candidates to win the Republican nomination for U.S. Senate in Ohio, though Trump's endorsements will be tested, as this is only the first election in a string of primaries to take place across the U.S. in the coming months. Vance will now compete against incumbent Democratic Congressman Tim Ryan in the fall.
Switching gears, Elon Musk agreed to buy social media platform Twitter last month for a total of $44 billion, with the stated intent of taking it private. But now he says he wants to make it public again, just a few years after the acquisition goes through. Joining us with more on this is Yahoo Finance's Dan Howley. The ever-changing kind of nature of this acquisition, perhaps, Dan, what more do we know about?
Yeah, I mean, it really is strange just because this is something that he said he wanted to go against, more or less, because he wanted to be able to have less oversight, you would think, of the company than it has right now. And so what they were originally planning to do was go private, and then Elon Musk was going to do things, I guess. He's not even really clear on what he wants to do. I've mentioned this before, but prior to the full acquisition announcement, he had a TED Talk where he basically said, we're going to add an edit button. Okay, so that was worth $44 billion, I guess. So, I mean, now they're obviously going to go through with, all the pending approvals and have the company on his own. And I guess we'll just have to see what he does and then what that'll bring when it goes back into being a public company again. So, I mean, look, this is a social network that its growth has never been amazing. Its revenue has never been amazing. Everybody has always talked about how it's not properly monetized. But how are you going to monetize it? He's discussed things like, okay, maybe we'll charge people. Maybe we'll charge people for embedding tweets, which just doesn't make sense because you can quote a tweet. So it doesn't seem like he really understands what he wants to do here yet.
It's not unusual for a company that goes private to come public again, but still, you never know with him. Speaking of Twitter and other social media, you getting off it. Getting off Twitter. Are you getting off Twitter? Does that include Twitter?
I can't. So I've had it with social media, right? I'm writing a column this week where I'm basically just leaving what I can. I'll have you know that I've downloaded and deleted TikTok 5 times because, I have a problem. So I've decided that after sitting there laying in bed for like an hour and a half, sometimes just like scrolling through social media, that I probably shouldn't be doing that. So I've decided to take some limits here. What I'm doing is I've used the limiter that's in iOS to limit my Instagram usage to 20 minutes a day, which, by the way, is not a lot of time when you spend that much time on social media. I never use Facebook because, let's face it, I'm not, 80, because that's basically, I guess, the age for Facebook. And I don't want to use Twitter anymore during my spare time. And I talked to a couple of psychologists about this for my piece, basically going over, how these habits kind of evolve and how they aren't necessarily always bad when it comes to social media, because there are good sides to social media. People can meet people that they haven't seen in years, join up with new causes, find out interesting things in their lives. But for people like me, I think it was just a total time suck, and I could have been spending that time doing other things. So I'm going to try doing this. I have the limiter on Instagram right now. It popped up yesterday, and I swear I have instinctively swipe up to unlock my phone and move over 4 pages to Instagram and go to press it. and now it's locked, and I don't know what to do with myself.
Dan, how confident are you that you can maintain this? You've already brought back TikTok numerous times.
I know. Look, I'm trying. Twitter is just, like it's a hellscape. So I never really want to be on it, but I have to be on it for work. I have to look for, breaking news and things like that. So I'm not going to use that in my spare time. I feel like that's just, unless I really want to be depressed about something, then I'll either, watch, I don't know, a period drama or go on Twitter. But I do think that the Instagram thing is going to be a bigger issue. It kind of speaks to, I guess, my addictive personality, but also how these companies build their products. Right. And that this is the point of them, is to keep you using them and keep you stuck on them so you're engaging more, and then they can sell more ads against it. I'm saying no. I refuse to be a part of that system.
Well, the platforms have been built like casinos. There's such an eliciting of a psychological response and a behavioral response that they want you to keep coming back to. I mean, are we going to see a future ever where social media companies are being more forward about how they actually want to make sure that they're maintaining the mental health of their end users?
Well, I mean, right, that's exactly what legislators in Congress are looking at as far as Instagram goes specifically, because they had spoken about the impact that it has on young girls as far as body image goes. Frances Haugen, the whistleblower, had brought up how the platforms are designed this way, trying to get people to stay hooked as much as possible. And they do that by driving engagement through, negative interactions with people, the kind of stuff that really gets you going. For me, that's not why I'm on social media. I literally send my wife pictures of golden retrievers in a bathtub with ducks, little baby ducklings. It's the greatest thing in the world. Or baby cows and stuff from like this farm that I follow.
No, it's not. It's the worst.
It's the worst. It's the worst. It's the worst.
You gotta get off there.
And that's why I'm cutting down to 20 minutes a day. I feel like this is what smokers must have gone through. I feel like.
Dan, I have bad news for you because it sounds like you're going to miss my cow video later, overlaid with the latest rolling Limp Bizkit
Oh my
song.
God.
So I feel sorry for you, but look out for that post nonetheless. Hope you don't get hit by the limiter. Dan Halley, thanks so much, baby. Straight ahead, Whoppers and Timbits for the win over at Restaurant Brands in the first quarter. Restaurant Brands CEO Jose Sill stops by for your chat next. Burger King sales are still lukewarm in the U.S., but the brand is delivering Whopper-sized gains overseas as key markets recover from the depths of the pandemic. Sprinkle in another comeback quarter for coffee chain Tim Hortons, and you have the better-than-expected performance from restaurant brands seen in the first quarter. Restaurant brand CEO Jose Sill joins us now. Jose, good to see you as always. Let's start on Burger King overseas. Why is the brand hot over there?
Hey, Brian, great to see you. Great to see the whole team. Burger King internationally has been doing fantastically well. We had a really good quarter this first quarter. What we've seen is strong performance across all of our regions, Europe, Middle East, Africa, Asia as well, and Latin America picking up quite a bit. And what's happening to kind of simplify it for everyone, we've got really good, our teams are doing a good job on the marketing plans, on the menu innovation. Digital has been a really big driver of growth. And during the pandemic, we saw an increase in our off-premise capabilities and our business. So drive-throughs, delivery, digital rewards, loyalty, this is all quite strong during the pandemic. That's stuck. And what we've seen come back quite a bit with easing of restrictions and mobility picking up is the on-premise business. So dine-in getting stronger. And so the combination of the two has driven really significant growth, plus 20% for the international business in same-store sales and north of 30% from a system-wide sales standpoint. So exciting momentum in an international business.
I'd say a little bit of change of tone, Jose, on Burger King in the U.S. from you and the team. You noted you are chipping away at competition at Burger King in the U.S. What are you doing specifically to take the fight to McDonald's and other brands?
Yeah, so that was, look, it's not a victory lap. For us, growth and leading the industry is the goal. We want to create gaps, not close them, but it's a starting point of the turn. And that's why I thought it was important to share that yesterday at earnings that we're making progress. We made progress in the fourth quarter and continue to make progress here in the first quarter of 22. And what we're doing is we're really focusing on the core iconic flagship product of Burger King, which is the Whopper. We removed it from our core discount platform, the 2 for $6. We brought in new items into that platform, reduced the price to 2 for $5, and then really highlighted the Whopper as it should be as a core iconic flagship product of Burger King. We also brought in Whopper Melts and are limiting our messaging to fewer but more impactful messages and promotions. And so that's just the starting point. We've also gone through an agency review and made changes on our creative agency and others as well. And we think over time, the menu work, the marketing work, the communication work and brand work will be a key driver of growth in addition to operations, our digital improvements, and some of the work we're doing on image.
Within the work on Popeye's Louisiana Kitchen, noticing particularly that there's a little bit of a deceleration in the growth there. The chicken sandwich wars, we had seen that, of course, generate a ton of fanfare, go viral. Are we seeing that start to decline and pull back a little bit? And what does that mean in terms of the investments within that brand, too?
Yeah, the Popeyes has had a great run for quite some time. We shared yesterday that since the acquisition in 2017, we've added nearly 50% or just over 50% system-wide sales. Unit growth has been tremendously strong, and top line and unit economics have improved tremendously. And in fact, the first quarter of 2022 was the strongest quarter ever for the strongest start to the year ever for the Popeyes brand in the U.S. from a development standpoint. That said, we did have some headwinds from a same-store sales standpoint, and part of it has been, as I've mentioned, we've had some challenges from a staffing standpoint. Hours of operation have been somewhat impacted. We're getting a little bit better on that, and our franchisees are doing a good job of continuing to staff their restaurants and be open more hours to drive and address more consumer demands. The other piece is there's been a lot of competition coming over the last year on the chicken sandwich side from chicken players as well as broader QSR players. We think we have the best-in-class product, not because I say it, but because our consumers say it. And we this week we launched the Buffalo Ranch Chicken Sandwich to remind folks how great the Popeyes chicken sandwich is, and we're excited about the start of that promotion.
Hey, Jose, it's Julie. I want to ask you a little bit more about that staffing issue. I mean, we just heard from Starbucks and Howard Schultz, who is the interim CEO, talking about $17 an hour in average pay. Now, I know the majority of your restaurants are franchisees. They're not owned, so you don't have as much control over what they're paying folks. But What are you seeing out there in terms of pay? How much is it going up? What is the average pay? And how are they attracting and retaining people to keep those Popeyes open as much and as long as possible?
Well, we've seen increases in wages really throughout the country. It's the same here in Canada, which is where I'm at today. And so I think that there's a balanced approach here for improving staffing and hours of operation. I think the key is ensuring you have a really good employee value proposition, and it's one of the things we're working with our owners across the U.S. Our franchisees are coming together with our teams and building and sharing best practices and building game plans based on things they're doing in their restaurants to hire better, to have the right level of benefits for their employees, to create the right culture in their restaurants, and the combination of salary, wages plus benefits plus the right environment and the right culture. These are things that attract people to restaurants, and these are things that help folks retain talent and hopefully start growing their business that way. So it's a full court press in terms of being able to drive the right environment in the restaurants, and our franchisees are doing a good job, and we think over time we'll be able to address this and continue to grow the business through better staffing and better hours of operation.
Jose, Julia briefly mentioned Starbucks, and they came out last night and they said we're going to open up a lot more drive-thrus. That's your turf and the turf of your rivals. How do you think about Starbucks as a competitor, and because of their impending arrival even more into the drive-thru, do you see yourself making a bigger play in coffee?
Look, everybody's a competitor in my vantage point, right? If you're not part of the RBI family, you're a competitor, and certainly drive-thrus we've seen in the U.S. and in Canada and throughout the globe have become that much more important in light of the off-premise growth in the business through digital and also through the pandemic over the last 24 months. We have a really strong and ubiquitous presence in the U.S. With drive-thrus at Burger King. Popeyes is growing. With Tim Hortons, we have over 650 locations. We're one of the largest coffee chains in the country. We think we can be bigger. We've created a new platform for Tim's here in the U.S. from a drive-thru standpoint. So we've got our own growth plans for all three brands, and Firehouse as well. We've added drive-thrus as well for Firehouse. There's about 50 or 60 of them in the U.S. that have drive-thrus. So it's a strong and important part of the business. It's something that we do quite well. Our franchisees are really capable at that in terms of finding locations and developing drive-thru locations throughout the country. And we'll continue to grow using that platform and many others as well.
Well, as you know, just like Justin Bieber, I am very much a Timbits fan. We'll leave it there. Restaurant Brands CEO Jose Cil, always good to get some time with you. We'll talk to you soon. Great seeing you guys. Thanks so much. Have a great day. You too. Coming up, we have a few hot takes and results out of fast food giants Yum Brands and Wingstop. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. It's time for Sazi's Takes. We've been talking a lot about a slew of earnings reports all morning long. No surprise that Sazi's Take today is on Yum Brands. Okay, break this one down for us.
Yeah, I'm zooming in, as the 20-somethings would say, on profit margins within the fast food companies. Yum Brands out with earnings today, and really, by and large, margins, operating profit margins were under pressure. KFC margins, they were down in the most recent quarter, despite the introduction of those new Beyond Meat chicken fingers, which I like. Nonetheless, margins down. Taco Bell profit margins down. Pizza Hut margins were up, which is interesting, and I have to make a note and go back to that a little bit later and dig into it more, why that happened, because it was not the norm. Switching gears a little bit here, Starbucks, we heard from Starbucks last night, in addition to them rolling out drive-thrus and various other things, operating margins down 300 basis points year over year for Starbucks. And last but not least, and lost in the sauce, the sauce here is Wingstop. Its margins were down 480 basis points year over year, and you can see our team right there putting me holding a wing, and I am not surprised by that graphic at all. But there are a couple of dynamics going on here, more so than the pressures related to higher wages. There is increased training costs. You heard Starbucks CEO Howard Schultz talk about that on the call last night. They're investing more to better train their workers. Bonus payments. I think Schultz hinted at a potential bonus payment to workers on August 1st, something to watch out for. Higher transportation costs, higher ingredient costs. So margins are really under pressure across the board because of these factors, which leads me to my take here today is you just may want to eat the food, not the stocks, because for as long as margins stay under pressure, it is likely these stocks, which have been under pressure the past 3 months, they will probably stay under pressure.
There's one other thing that you didn't talk about, if I may. Usually you're very comprehensive, but there's one thing you didn't talk about, and that's China, which I don't think Wingstop is exposed. They don't have any stores in China,
No, they don't.
right? But the others do. And China was a big issue for Starbucks, Yum as well. We're seeing some weakness.
Well,
Yum China's separate, I guess.
Starbucks same-store sales in China down 23%.
Yeah.
And to your point, we've seen China being a weak point throughout many companies and, of course, fast food. And when that happens, you lose leverage over your sales. You're just essentially bringing less sales, and your expenses basically stay the same. Hence, you see profit margin pressure, like we saw at the fast food players. But I guess everybody wants to know, like, what is our favorite fast food? Like, what are we going to? I'm going Taco Bell. I'm going soft chicken taco supreme at 12 p.m. after 6 beers.
Interesting.
12 p.m. after 6 beers?
Or 7.
12, wait, noon. As of noon, you've already had 6 or 7 beers?
At midnight. Is that 12 p.m.? Drawing a blank.
That's 12 a.m.
All right, midnight.
Whew, I was getting a little worried about your after-show routine for a second there.
It hasn't come to that yet.
And what led up to it?
Brad, what do you got? Favorite fast food?
I'm going to go Popeyes, actually.
Okay, fair enough.
Yeah, because you can smell it getting off the train in Brooklyn.
I don't
eat fast food.
Fast
I knew you were going to say that. I knew it.
You know, I like
knew it.
Chipotle, but that's not real. That's fast casual.
Fast casual, yeah.
Yeah, exactly.
Oh, all right. Well, we got Sazi's take for the day and the fast food take as well. Everyone, coming up, we'll share our interview with the CEO of Qualcomm, where he discussed the company's latest partnerships and the future of the chip space. Not fast food related there after the break. Welcome back to Yahoo Finance, everyone. Qualcomm reported earnings last week. The company saw revenue pop a whopping 41% in the last quarter. Yahoo Finance's Ali Garfunkel caught up with the Qualcomm CEO, Cristiano Amon. Take a listen.
We were very happy with this earnings season. I know there was a sea of negativity, around there, but, we're very happy with the results. Our business is growing across all segments. In different drivers of growth. Handsets, we grew 50%, projected to grow 50% a year, 56% in a quarter. Automotive, we added $3 billion to our design win pipelines, now in excess of $16 billion. But then the broader theme of digital transformation is really driving our IoT segment, and 61% growth year over year. So all businesses are growing, and the diversification of Qualcomm is working.
And I want to drill down on a couple of things, but I'm especially interested in your move into auto. Broadly, talk me through what your strategy in auto looks like.
Yes. If I start from a very 30,000 feet level, we know that cars are becoming connected computer on wheels. And the car companies need a partner that can provide them all the digital technology so that they can compete with Tesla. And we look into that, and we created something very unique, which is the Snapdragon digital chassis. We really created a digital platform. We're one of the few companies actually that has capabilities across all the domains, connecting the car to the cloud, doing the entire digital cockpit experience of the car, creating a service platform because the car is going to distribute media, it's going to distribute gaming, it's going to have a lot of data for telemetry, and ADAS and autonomy all in one-stop shop. That's resonating well with the industry. If anything, it's one of the fastest, growth that we had, and we're now working with 26 of the global brands.
To that end, you recently announced a deal with Stellantis. I really like the phrase digital cockpit because that's what a Maserati is. It feels kind of like a rocket ship. So tell me a little bit about how that Stellantis deal came to be.
Look, it was a perfect match. It's a company that has a lot of scale. The merger of FCA with PSA, they have 14 different brands. Across every one of those brands, digital is important, and the ability to have a partnership that we can actually build a platform that can scale across the 14 different brands, multi-tier, multi-year. It was completely aligned with the direction they're going, and I think that's just the beginning of something big between Qualcomm and Stellantis.
Yeah, I was going to say, what exactly made Qualcomm and Stellantis a fit for each other right now, specifically?
They are a company looking really to build on their scale, streamline their operations, and actually transform with technology across all their brands. And Qualcomm is a company that can provide an open, scalable, flexible platform that meet that needs. And the other part of it is two companies that are committed to innovation.
Mm-hmm. So tell me then a little bit about deal making in general. How do you approach it, particularly when it comes to auto, but also more broadly?
This is one thing that is very unique about Qualcomm. Qualcomm is really a company that's built on partnerships. And can we create value for our customer even before we can create value to ourselves? And I think that leads to win-win partnerships that both companies will benefit from the technology, and we are a company focused on long-term customers and relationships, not short-term.
And tell me a little bit about, the Stellantis deal obviously is a big moment, but should we expect to see more deals like it?
Stay tuned. I think you're going to see a lot of news from Qualcomm recently. The digital cockpit, the connectivity of the car with the cloud, ADAS and autonomy, all of those elements of the digital chassis is winning. And we're very proud of what we accomplished. And we expect to be able to talk about more partnerships in the near future.
Yeah, I want to go back to actually something you said that I think is really interesting. You said that Qualcomm really looks for long-term partnership, which I assume for Qualcomm, a company that's been around for a very long time, is years, decades. How do you go about picking your partners? Whether it's in handset, auto?
That's a great question because Qualcomm is expanding. We used to count our customers on the handset industry in two hands and then one hand. If you just look, for example, our industrial IoT, we have in excess of 13,000 new customers. And the process really is, can we identify customers that we really help them solve problems with our technology? Can we make them a better company? And then in the process, they can make us a better partner.
And to that end, I'd like to pivot just a little bit. I'd love to talk about your mobile chip strategy. Broadly, what is that strategy moving forward?
The strategy for mobiles now is very clear. Our strategy for mobile is to be focused on premium and high-tier Android. We want Snapdragon to be synonymous with a flagship experience on Android, and that's what's happening right now. As a result of the focus on really setting the pace of innovation in the Android ecosystem, you just saw in this quarter, we expanded our relationship with Samsung. We used to supply about 40% of the Galaxy platform. With the Galaxy S22, we're now north of 75%, and that shows the strategy is working.
And then tell me a little bit about competition. You know, we're seeing a lot of companies get into the space that previously weren't. You know, Apple, Google, Amazon. How does Qualcomm continue to compete? How is Qualcomm approaching that? And does Qualcomm beat everybody out?
Well, I would say Qualcomm always win with technology. If the elevator pitch in the company, we're about everything wireless. It doesn't matter, cellular, Wi-Fi, Bluetooth, position, location, everything high-performance computing for a low-power device, whether CPU, GPU, artificial intelligence, camera, etc. And we strive to be the best of each one of those technologies. And that's how we think about competition. We're always going to win with technology at the end. However, I'll answer your question a little bit different. You can look at Qualcomm as a company has been in mobile for a long time. But the company's really changing. It's not about a communication company for the mobile industry. It's really a company that has connected processor for the intelligent edge. And for all of those new markets, auto IoT, we're actually the new entrant. We're the challenger. We're the one competing with the incumbents and winning with technology.
So how do you approach being a new entrant then?
We have to be nimble, we have to be aggressive, and we have to be disruptive. And I think you saw the results of that, or what's happening with Qualcomm and Auto.
And I wanted to also ask about the metaverse. You know, speaking of things that are disruptive, kind of cutting edge, one of the things everybody's been talking about is the metaverse. What's kind of your take on the metaverse and what its relationship may or may not be with Qualcomm? It's real. It's going to be a very big opportunity. We started investing in fundamental technologies that allow the merger of physical and digital spaces over a decade ago. It's no secret that because of those early investment, for the over 40 virtual reality and augmented reality devices that exist in the world, all powered by Qualcomm Snapdragon XR. One of our biggest partnership is with Meta. We have been a very successful partnership with them for VR with the Quest and the Quest 2. We announced at CES that we're now doing a custom chip for augmented reality with Microsoft as the Microsoft HoloLens get ready to scale. And we announced a partnership, for example, with ByteDance for the VR for TikTok. And we have a number of different developments to eventually be able to create companion to your smartphone with fully immersive augmented reality glasses that actually is going to look like this. And I think that's a big opportunity. It could be as big as phones. And should we expect to see more partnerships like that then?
Absolutely. I think we're just at the beginning of this growth for the metaverse.
And last question I wanted to ask you, you've been at the helm for about 9 months, and one of the things you talked about a lot when you started was the diversification of Qualcomm. There were so many areas you could operate in. How is that strategy going?
It's working. It's great. I think the fundamentals of our strategy are all in place. I think it's reflected in our financials. Actually, diversification has been responsible for the outperformance of Qualcomm. We saw that in auto. We saw that in IoT. And the new mobile strategy also working. We're growing in mobile as well. So very proud of the accomplishments of the Qualcomm team, and we're just going to keep marching forward.
And how did you know that was the strategy when you took the helm, out of curiosity?
It was natural, it was the right thing to do. It's about seeing demand for technology in a number of different industries, and they hold to this whole topic that we talk about. It was my Milken panel earlier. Digital transformation is happening at virtually every industry.
Well, as we await the Federal Reserve decision this afternoon, we are watching markets closely. We have seen the Nasdaq in particular accelerate to the downside, off by 1.25%. Thanks for watching today, folks. We'll be back tomorrow. Akiko Fujita and our Brian Sazi, he's going to be back. He's going to speak with Marriott International CEO Anthony Capuano on the state of the hospitality industry. That's coming up in the next hour.
Welcome to Yahoo Finance Live. I'm Akiko Fujita. It is 11 a.m. here in New York City, and we are seeing stocks pointing to a mixed picture right now. The Dow up about 43 points. We've got the Nasdaq, the biggest laggard on the day, down about 1.2% there. Stocks moving here, even as the Federal Reserve is set to make a decision today in its FOMC meeting. Investors widely expecting the central bank to hike interest rates by 0.5 percentage point. We've seen the yield on the 10-year Treasury note moving on that, although now it is below that 3% level ahead of that decision. A slew of earnings also out, driving the markets with big declines in the ride-hailing space. Uber and Lyft both down in a big way today. Uber showing recovery in the first quarter, while Lyft posted better than expected results but offered disappointing guidance. Let's dive into those numbers with Yahoo Finance's Emily McCormick standing by for us. Emily.
Well, Akiko, it's the tale of two ride-hailing giants today. I'll start off with Uber, which, as we can see, these shares are moving lower by more than 11% intraday, and that's even after Uber topped consensus expectations on most major metrics. Now, just running through some of these numbers here, revenue came in at $6.85 billion, much better than the $6.1 billion expected. That was also more than double what the company posted in sales in the same quarter last year. Now, gross bookings of $26.45 billion were also a beat, and within bookings, we saw that food delivery contributed more to the total at $13.9 billion in bookings, though mobility, or that core ride-hailing business, did grow more year over year, rising about 58% to $10.7 billion. Now, Uber's adjusted EBITDA outlook and gross bookings outlook for the current quarter were also ahead of estimates, but even still, again, seeing this decline in the stock price on an intraday and also for a year-to-date basis. You can see that stock is down about 37% so far in 2022. Now, shifting gears here, taking a look at shares of Lyft on an intraday basis, seeing a massive slide today, down more than 34%. You can see the magnitude of this decline over the past 2 days as well, that sharp decline coming after the company reported results yesterday. Lyft's outlook showed that it expects revenue of as much of $1 billion in the second quarter and adjusted EBITDA of as much as $20 million. Now, both of those were below estimates, as the company said it's going to be investing in its driver supply, given the shortages that it's still seeing on the labor front. But we did have Lyft's co-founder John Zimmer on the show earlier. Let's take a listen to what he had to say about these investments.
We are focused on increasing shareholder value over the long term. That might sound like a soundbite, but it's the reality. And so we question all the decisions we make when we see something like that. We take our investor feedback. We talk to our investors. We take it extremely seriously because ultimately we intend to drive a significant return on investment in the stock.
Joining us now, we've got Bernie McTiernan, his Needham Company Managing Director. Bernie, let's start with the stock move, specifically on Lyft. The worst single-day decline that we're seeing today, down nearly 34%. How much of this do you think is overdone?
Yeah, thanks again for having me. Look, the problem that Lyft is going through right now is just the investment levels were a lot higher than what the street was anticipating. Both happening on driver supply, which I guess we could have guessed was going to be happening, but then they also introduced new areas of investment that we weren't expecting in some OpEx line items that are going to be going up on a sequential basis. So that's R&D, G&A, and sales and marketing expense. So admittedly, after a 33% decline in the stock, shares are getting a lot cheaper here. On a valuation basis, the stock's trading at less than 10 times EBITDA. The only problem is there's just a lot of uncertainty in that EBITDA estimate in terms of, there's a lot of pricing inflation that's supporting that revenue and those bookings numbers that the company reports, and then how much the company is going to have to invest in driver supply and other areas of the business too to just harvest. Again, Lyft has come out a much more profitable company because of the pandemic. They are EBITDA positive. Even the 2Q guidance, which was disappointing, it is for positive. Remember, this was a company that was over $300 million loss in 2019. So the company has made a lot of strides. The market's digested that. And now, so it's, what have you done for me lately? And it's that, the investment levels are just greater than we expected.
So, Bernie, when it comes to these investments here for Lyft, especially on the driver supply side, do you think these are the right investments to be making for Lyft to drive long-term growth, even at the expense of near-term profits?
Yeah, it's interesting. Both Lyft and Uber pulled up their earnings call. They were supposed to report today after market close. They moved it up to before market hours, given the results that Lyft reported in the stock market, in the stock reaction to that as well too. And so, are they the right investments? It's interesting because Uber was talking about how they really think we're at a new normal here for pricing. And that, getting pricing back down to pre-pandemic levels just doesn't seem like it's going to be happening over the near term. So, I think that's a major area where Lyft, you need that two-sided marketplace. It seems like Uber is there and has it. Dar spoke about some really encouraging commentary in terms of how much their drivers and earners on the platform are up year over year. They would describe a lot of that to not only the investments that they have been making over the past year to driver supply, but then also what they're doing on the technology side too, to make just a better environment for earners to earn on their platform. So I think they would argue that, Lyft was falling behind in harvesting for profits last year when they should have been investing like Uber was.
Yeah, I mean, Emily called this a tale of two companies. When you look at Uber specifically, I mean, they say they've had more drivers than at any point in the pandemic. Lyft is struggling a bit more, but when you look at the overall quarter, Uber still posted a loss of $5.6 billion. How do you think investors should be looking at that number, given that a big chunk of that came from their holdings in Didi?
Yeah, so we're really focused on what the EBITDA of the company is. It's worth noting too. So the company's going to be generating over $1 billion of EBITDA this year, I think. And they, as I said, they expect to get to free cash flow positive. So I think that's a metric that, as we expect bookings to continue to grow in 23 and 24, the incremental margins that the company has spoken about, the 5% on delivery, 10% on mobility, plus freight had a really strong quarter. This time around, corporate expenses were less than we expected. So I think that we'll be talking about that conversion of EBITDA to free cash flow more and more, and then what the company can do to start getting some value for that cash or free cash flow generation in their business. You mentioned their minority investments. I would say that the market's probably ascribing little to no value to them. Granted, the value of those investments has really come down over the past 6 months. It's still worth a couple $2 billion. So whether it's a buyback or what the company can do to really start to get value for that free cash flow as they're really cemented as free cash flow positive, I think will be interesting to see how that transitions over time.
And just thinking about the macroeconomic backdrop, everything else going on in the world, I'm wondering how much of a boost, if any, do you see Uber and Lyft potentially getting this quarter from the fact that gas prices in the U.S. at least have started to stabilize from their March highs?
Yeah, it's interesting. Both companies really played down the gas price impact. We have a mobility supply tracker where we measure, we have 3,600 data points going back to Labor Day, where we're tracking Uber and Lyft against each other for pricing and wait times in the head-to-head matchup. And, I guess no surprise is that wait times and pricing remain elevated and back to really the post-Labor Day highs. And so part of that, we've heard anecdotally, there's been articles written that gas prices are playing an impact. The companies were certainly downplaying it. And Lyft in particular was talking about how, they're investing in driver supply because demand reacted early post Omicron, and then it just takes longer for supply to impact. So that's where they think that they're making those investments. Neither company commented that. I believe that the gas surcharges that consumers are facing right now, even though they're relatively modest, they run out, I believe, in about 11 days for both companies. So not sure if those will continue at all either. But really what these companies are benefiting from is just inflation on the platform, where earners are making a lot more money and consumers are paying a lot more money for these services. And I don't think that's going to be changing anytime soon.
And finally, Bernie, another stock that is moving in the other direction. We're talking about Airbnb, really another strong quarter for them. It does feel like this company has found the right mix, whether it is for the short-term stays, the long-term stays. They've kind of been able to position themselves across the spectrum on travel and work from home. You've got a price target of $220 a share, certainly more upside that you see. But I wonder if we flip the question and say, what's the one thing you think that could derail the momentum for this company?
Well, I think it is a really encouraging story. One of the major pushbacks that we get or two major pushbacks. Let's go there. One is valuation. The stock's trading at a double-digit revenue multiple. Those were commonplace for my coverage 6 to 12 months ago. Now I think they're the only company I cover that's still supporting a double-digit revenue multiple. So I think that's an area for the bears. Their bears are focused on. I would counter that. We just raised our EBITDA estimates by 13% this for 2022. That means that the stock's trading about 30 times our EBITDA estimate. I think that's not quite as a lofty valuation as you get when you look at it on a revenue basis. So that's one. And two is ADRs. Company posted plus 5% ADRs in the first quarter. We had them down 1% for the year. At some point, as urban comes back, that should be deflationary towards ADRs. So we had them falling off again in 23. I think that's something where bears are focused on. And then maybe the third area where bears are focused on supply, and that's especially coming off Expedia's earnings call earlier in the week when they said Vrbo was supply constrained to an extent. On the positive side for Airbnb, they said they are not supply constrained. That's the volume and diversity of their of their supply on their platform, plus the innovations that they have. They called out this I'm flexible feature, which I've explored, and it's actually pretty cool. But and it's been used over 2 billion times. But the point of it is that they can move supply from constrained areas to less constrained areas. It really helps their utilization rates on the platform. So those are the three areas that that the bears are focused on, and kind of my rebuttal. So sorry, I didn't really take the bait there, but those are the areas where the bears are focused.
Yeah, the stock today up about 1.7%. Bernie, it's good to have you on today. Bernie McTernan, Needham Company Managing Director, and our thanks to Emily McCormick as well. Well, coming up, travel rebound. Marriott seeing a big pop on a surge in global demand. CEO Tony Capuano is going to be joining us to discuss the company's latest results. That's coming up after the break. Well, shares of Marriott getting a healthy pop in this session, up more than 2% this morning after the company posted a beat on Q1 earnings and revenue thanks to strong travel demand. Let's bring in the CEO of Marriott International. We've got Anthony Capuano joining us alongside Yahoo Finance's Brian Sozzi here with me at the desk. Anthony, certainly a very strong quarter for you. You said the largest surge in global demand since the pandemic began. It certainly feels like people are starting to feel a little more comfortable traveling, even with COVID in the background. But what do you think has been the biggest driver?
Well, we've seen the recovery led by leisure, and leisure continues to be exceedingly strong. In fact, in the quarter, we were about 10% ahead of where we were pre-pandemic. But I think what's really driving these results is parallel recovery in the other two business segments, business travel and group, both of which made meaningful progress during the quarter.
Anthony, how would you characterize what we might see this summer in terms of travel demand?
I think it's going to be a blockbuster summer. I was in Europe just last week, and our teams are ready. When they look at the forward bookings going into that peak summer travel season, we think it's going to be a terrific travel summer for us.
Yeah, I mean, it feels like people are just itching to travel again, but there are some headwinds we're seeing, at least on the macroeconomic front. A lot of consumers having to deal with the price pressures that have been building. How have you seen that reflected in some of your stays and the data that you have?
Well, Akiko, one of the most fascinating things when we look at the manner in which the recovery has unfolded, if you look at the last two big shocks to the travel and tourism sector, post 9/11 and the Great Recession, across the industry, it took between 4 and 5 years for pricing power to return. We're already achieving average daily rates meaningfully ahead of where we were pre-pandemic, just 2 short years after the start. And so that I think that pricing power really illustrates the sheer volume of pent-up demand for travel.
Anthony, the outlook in China, or just the business conditions in China, continue to be under pressure, not just Marriott, a lot of other big companies. Do you think first quarter was the low point?
We hope so. The zero COVID policy that's in place in China has created tremendous headwinds in terms of recovery. You'll recall, Brian, I think one of the last times we spoke, in the second quarter of last year, China was the bright shining star in terms of the pace of recovery. And so the current COVID policy has certainly had a significant dampening effect. The great thing about our business, as you well know, we reprice and relaunch our inventory every day. And when we see some of these lockdowns open up, in real time, we see pretty significant spikes in demand.
I mean, even with that said, the zero COVID policy, as you well know, it feels like it really comes, you know, there's one case, a few cases, and there's a lockdown there. There's no indication that the government is going to back off from that. So how do you navigate around that? I mean, what assumptions do you operate under when you know that policy could shut things down at any moment?
Again, I think the advantage we have is the fluid nature of our inventory. We can modify pricing on a dime, but it is most certainly challenging. The good news is there continues to be strong domestic demand across Greater China. And I think what we look forward to with great optimism is when that country starts to open, the volume of cross-border travel we think is going to give us tremendous momentum. In fact, on a global basis, pre-pandemic, almost 20% of our global room nights were cross-border travel. In the first quarter, we saw about 100 basis point improvement, but we're still only at about 14%. So when we think about the runway we have in front of us for continued improvement, growth in cross-border travel gives us a lot of optimism.
Last time we talked, Anthony, you mentioned, or you signaled, at least to me, that you were likely to bring back the dividend soon. So you delivered on that. You brought back the dividend this morning, and you hinted at share repurchase activity being the next component to driving more shareholder returns, potentially returning soon. What type of signal are you trying to send to the investor base?
Well, I think what we're sending is We're reminding them of our commitment to getting our ratios back, our debt ratios to between 3 and 3.5. We're demonstrating our confidence in the progress we've made in pursuit of that objective. And I think the reinstatement of the dividend really speaks to our confidence about the continued and sustained recovery of travel around the world.
Lastly, Anthony, how long do you think before occupancy levels at most of your brands resemble something like they were in 2017 to 2018?
Well, the unpredictability of the pandemic has caused us to be quite thoughtful about when and if we'll provide guidance. But I think the best answer to your question, Brian, is what we saw in April, where RevPAR in the US and Canada, our largest market, was back to 2019 levels. And that was really encouraging and I think milestone sign as we work through the recovery.
Marriott International CEO Anthony Capuano, it's great to have you on today, and our thanks to Brian Sozzi as well for joining in on the conversation. Let's do a check. One of our trending tickers today, Moderna, now down about 1.3%. This following a blowout quarter for the company, though. The gains in revenue driven by strong sales in its COVID vaccine. First quarter vaccine sales more than tripled from the same period last year, raking in $5.9 billion. We spoke to CEO Stefan Bancel earlier this morning about the momentum the company saw in the quarter.
Well, I think first is strong sales. If you look at the sales compared to last year, we've increased the sale by 3x, 6.1 billion. Last year, 1.9 billion for Q1. And then I think also the operational leverage that we have on volume. Moderna is a pretty efficient company. We started, as we built it, to be very digital across the board, very industrialized. So as we get more volume, we get a lot of economies of scale. We're able to increase, net income by 3x as well.
Well, coming up, investors are closely watching the Federal Reserve as its pivotal meeting wraps up today. Our very own Brian Chung joining us live from Washington, D.C. Stick around. We'll be right back. Well, the Federal Reserve is wrapping up its two-day policy meeting today. The central bank widely expected to announce a 50 basis point rate hike. And our very own Brian Chung, live for us in Washington, D.C. today. By the way, Brian, we should mention this is the first in-person press conference you're going to be attending since the pandemic began. The messaging so key for Jay Powell. What are we expecting?
Yeah, absolutely. First time we are going to be back in person. No more of the Brady Bunch boxes. I had to actually stay at a hotel. I brought my slippers with me to make my trip down here. Obviously, the Federal Reserve very much in focus as we do eye that 50 basis point increase from the central bank. It seems like all signs are a go for the largest interest rate increase that we've seen since May of 2000. So actually no surprise expected in the policy statement when that does kick off at 2 p.m. But that doesn't mean I don't have any questions, which of course, Akiko, brings us to our FOMC3, the three things that I'm watching for in that meeting. So 50 basis points today. The big question, naturally, could there be 0.75% moves later this year? You see some like Nomura, for example, calling for that. St. Louis Fed President James Bullard also advocating for more aggressive moves later on this year. Very much going to be interesting to see if the Fed chairman wants to bite on whether or not even more aggressive moves, a gigabump perhaps, could be in the cards later this year. My number two question, though, is how low can you go? Not necessarily the cha-cha slide here, but really asking the question about the balance sheet. Again, the Fed has $9 trillion in assets, a lot of it accumulated during the depths of the pandemic when they were trying to message to markets its significant support. Of course, the Fed wants to begin the process of actually actively shrinking its asset holdings by allowing some maturing assets to roll off. Now, a preliminary discussion in March detailed a perhaps $95 billion a month plan to do so. We're expected to get the finalized detail on that in today's meeting. But my number one question is the number one question everyone's asking, which is, look, at the end of the day, when does inflation moderate? That's the whole purpose for the Fed tightening itself. The Fed very clear, at least in the messaging over the last few weeks, that inflation won't go back to 2% on an annual basis, at least this year. But if the Fed gets more aggressive, could they maybe pull forward expectations for inflation to come down? We will have to see in that press conference from Jay Powell, which is going to kick off at 2:30 p.m., which, of course, the full coverage of right here on Yahoo Finance.
Yeah, and you certainly are going to be in the room with the Fed chair. You know, Brian, we were talking about this yesterday. It is such a delicate balance that Jay Powell has to navigate right now. You've got, obviously, him having to come forward and make it pretty clear that they are moving aggressively to tame inflation, and yet not too aggressively that it pulls back growth in the economy overall. I mean, how do you think he finds that balance?
Well, I mean, this is kind of the issue that they don't want to acknowledge, which is that the risk of recession is very much real. And I don't think that you should expect to see the Fed chairman acknowledge that it's possible Fed tightening could happen too rapid of a pace that could actually tilt the economy into a recession. You're already seeing some concerns just off of the stock market moves and the bond market moves over the last few trading sessions, over the last few weeks, over the last few months, over a possible recessionary outcome in 2024, perhaps. But the Fed chairman is going to say, look, at the end of the day, the primary goal here is to make sure that it's not inflation that's going to be the issue here. And when it comes to trying to tamp all that down, the Fed has acknowledged that it has to get more aggressive, hence the unprecedented rate hike of the size that we are expecting to see at the conclusion of today's meeting. But of course, naturally, the question is, even if that avoids a recessionary outcome, at least today, if the Fed has to continue to ratchet interest rates, can they get up to a 2.5, perhaps 3% short-term interest rate by next year without abruptly ending this recession and killing economic growth? We already saw that negative print on Q1 GDP, very much a warning sign for the Federal Reserve officials down on Constitution Avenue.
Okay, we will be watching very closely today, 2 p.m. Eastern. Brian's going to have live coverage, and of course, I know you're going to be in the room when that press conference begins at 2:30 p.m. Eastern. Thanks so much for that, Brian. Well, Starbucks is hiking wages for employees to counter growing momentum to unionize at their stores. The coffee giant announcing it is investing $200 million in its stores and employees, but interim CEO Howard Schultz saying those investments won't apply to stores that vote to organize. Let's bring in Yahoo Finance's Brooke DePalma with me here at the desk. So let's talk about the $200 million investment first. How does that break down?
Absolutely, Akiko. So to note that $200 million investment is part of a $1 billion investment that will happen this fiscal year. But just to begin here, raising wages is really the main play here. Of course, for those company-operated stores, you have to specify that. So to begin, this will take effect August 1st. It'll move the hourly wage to $15 per hour. That was announced last October. So now we're just getting that August 1st date for it to be implemented. But on top of that, all partners hired on or before May 2nd will get a 3% raise or that $15 per an hour, whichever is higher. And also here, they're rewarding tenure, rewarding a length of service for baristas, store managers, shift managers, and supervisors. So between 2 to 5 years of service, they'll receive a 5% increase. Partners with 5+ years of service, they'll receive a 7% increase. Now, just to add on that, some things that they heard during these collaborative sessions is that these baristas want more training. And so they're implementing that on June 21st. There'll be additional and more effective training, they're calling it, including doubling the amount of training for baristas. Then in August, they'll double the amount of training times for these shift supervisors. Now, some of those other more larger plans this year is launching an internal communications app. Howard Schultz on the call saying that he hopes that this intends to extend those collaborative sessions that are happening. And then also, as a direct result of that feedback, they plan to provide opportunities to increase sick time, implement a new financial stability toolkit, and introduce new tools to help partners refinance student loans. And some other things that they heard include credit and debit card tipping by the end of this year. They plan to implement that. But of course, Kiko, as you noted, these new benefits will not legally, as Howard Schultz say, be allowed in those unionized stores.
Yeah, I was looking at the wording here. Howard Schultz said federal law prohibits us from promising new wages and benefits at stores involved in union organizing. So what's the reaction from the union side? I mean, I'd imagine they would argue, look, we've been asking for this in negotiations.
Absolutely, Kiko. So I reached out to Starbucks Workers United Organizing Committee. They're, of course, behind this major unionization push that's really quite literally sweeping the nation. According to the organization, more than 250 nationwide stores have filed petitions as of Tuesday, and there are more than 50 unionized Starbucks stores currently across the country. But they said that many of these proposed benefits have actually been proposed at the bargaining table in Buffalo, where it began. They said more specifically, Starbucks Workers United has already filed charges over Starbucks threats to exclude those unionized stores from receiving these new benefits. This isn't how labor law works, and Starbucks knows that. So, of course, lots of back and forth between these unionized stores. And Howard Schultz really saying that these young workers just want more. And he said that this is part of a larger trend, not unique to just Starbucks. But, of course, Starbucks always trying to be at the forefront of conversation here. But compared to a year ago, shares are down nearly 32%. Of course, up today. But it'll be interesting to see how this plays out for both Main Street and Wall Street.
It's interesting in so many of these earnings calls, you know, you look at a company like Amazon that has gotten pushback on unionization. They've talked about the additional costs they're likely to incur from labor. There's other companies that have addressed this as well. What did we hear specifically from Starbucks on what this means for them from a cost perspective?
Of course, Akiko. Well, you know, with more higher wages and more training, it's certainly going to incur costs. Of course, you know, initially that $200 million investment, that's a roundabout number that they're expecting from all this new opportunities that they're going to provide for those company-operated stores. That $1 billion spending estimate in this fiscal year 2022 alone is certainly just a number that they're putting out there. What it actually is going to cost the company, and as far as, you know, supply and demand goes, they're saying that demand is strong amongst the consumer population, but whether or not they'll be able to keep up with that demand, or whether or not they'll be able to hire to meet that demand, as some people are saying that maybe they wouldn't go to Starbucks if they weren't able to work with those unionized stores. So really, it's a play here, but Starbucks confident, as always, that they're going to make their way through this.
Yeah, it's a conversation that's happening in so many corporations right now, especially with this momentum around unionization. Brooke, thank you so much for that. We're off for another break, but coming up, U.S. electric vehicle charging company Blink expanding its footprint. We'll break it all down for you with Blink Charging CEO and founder next. Welcome back to Yahoo Finance Live. Well, we know Elon Musk plans to take Twitter private once the deal is officially closed. But now the Tesla CEO reportedly telling potential Twitter investors that he could make it public again in just a few years. That's at least according to a report out from the Wall Street Journal. Let's bring in Yahoo Finance's Dan Halley with me here at the desk. So Dan, it's not unusual for companies, for CEOs, we should say, who acquire a company, take it private to restructure, and then go public again. What more do we know about the plans Elon Musk has to restructure Twitter?
Yeah, it's really still very much up in the air. This is something that he's basically kind of said, I want to have less censorship and ... That's basically all we know so much as far as his plans for Twitter. And, that's been an issue that I think a lot of people have taken kind of in one way or the other. Either it's going to be very good if you're a Elon Musk supporter and you don't believe that there should be content moderation, or it's going to be very bad if you believe that, there should be content moderation. As far as what else he wants to do, he says he's wanted to at one point, he's speaking out of both sides of his mouth here. At one point, he said it's not about making money. And on the other side, he said he's going to improve revenue and has potential ideas for that, such as, charging for quote tweeting or things along those lines. And, that just seems untenable to me. I don't know how much more they could kind of get out of Twitter outside of being very ad focused or going towards a subscription model. Then I do have a small subscription service right now. He has said, Elon Musk, that he wants to get away from the advertising revenue model, which I don't know how that's supposed to help the company, but that seems to be really his plans for now. And I mean, look, this is a company that's not nearly as big as TikTok or Snap or anywhere close to Facebook. And it really is one where engagement isn't as intense as something like a Facebook, an Instagram, a TikTok. It's you see someone's little post and then that's it. You kind of move on unless there's a very long thread. So I don't know how he's going to get more out of this.
Well, there were those reports that he is considering charging some companies as well as lawmakers to use the platform too. I mean, how much of that can be a revenue driver if you're not going to go through advertising model? Yeah, I mean, and that's not going to be a massive, massive amount of users, right? So I think part of it is trying to get, Twitter is just very opaque to begin with, right? If you're an early user, it's hard to figure out how it works. And I think that was part of Snap's original problem. They've seemed to work that out. Twitter just never really did. And so it's still a difficult service to get your head around, especially when it comes to uploading images, things like that. The lack of being able to edit, again, that's a big problem, though that seems to be something that Twitter says they're working on and will soon introduce. But I do think that it's still just a service that it doesn't really resonate with very many people, whereas something like a TikTok or an Instagram does. The algorithm is the algorithm, the feed is the feed. It's just going to be that way. Well, TikTok just seems like a happier place to be, right? It depends on where you are. I guess my algorithm is a happy one. Did I hear that you're getting off Twitter? Is that what I heard this morning? I'm not getting off Twitter. I'm getting off Instagram, 20-minute limit every day. And I'm not even on Facebook because I'm not. I've got a 10-minute limit. I get the warning, and then I just keep walking. I've deleted TikTok 5 times. I think there are bigger issues we need to talk about, Dan. Yeah. Dan Halley, thanks so much for that. Well, coming up, electric vehicle charging company Blink expanding its footprint. We've got the CEO and founder on the other side after this break. Blink and you'll miss it. EV charging provider Blink Charging is expanding abroad, acquiring British rival EB Charging in a $23.4 million deal. The move gives Blink an overseas footprint overnight. The question is, does it help shore up its market share here in the U.S.? Here to talk about the deals, Michael Farkas. He's founder and CEO of Blink Charging. Michael, it's good to talk to you today. Talk me through the thinking behind this deal. How much of this is really about acquiring these assets to keep up with what feels like an increasingly global race, a rapid race towards EV adoption?
Yes, the assets in the UK are extremely important for us. It gives us an opportunity to expand into that area, having a foundation there, boots on the ground without having to start from scratch. EV has right now about almost 1,200 charging stations deployed or in the process. They have over a 13 million pound pipeline order book for this year. And the actual acquisition was roughly about $13 million with the earn-out potential of another $10 million based upon performance. But what it does is it gives us a foundation in the UK where we can expand. And today there's going to be a lot of subsidies, grants, rebates available in the UK to deploy charging infrastructure, and that's what we do.
It does feel like this is a global arms race when it comes to this rapid transition towards EVs. The UK obviously has more aggressive targets than here in the US. But let's pull back a bit here and talk about what it is that you're seeing, how rapidly things are shifting, and where do you see Blink in that race?
The numbers speak for themselves. Today, if you look at estimates, we have roughly a couple million charging stations deployed globally. There are a lot of them that are not viable chargers prior technology. But let's just say we have a couple million chargers. By all estimates, you're looking at needing between 120 and 150 million chargers by 2030. So really, this is the beginning of the process in this industry. You know, people talk to me about, is it in its infantile state? And I go, no, it's actually at its embryonic state when you look at the numbers. And it's important for us to have a presence everywhere because of our offerings, because of our network, our back end. We have a network that's global in nature. It's multi-currency, multi-language, and you know, putting chargers in different areas. When you have that back end that really is built and structured from a global perspective, it's just adding more points of sales. And by buying EB, it gives us an opportunity to have boots on the ground to be able to deploy quickly in the UK.
Let's talk about the goals here in the U.S. You've obviously got an administration that has set out this goal of basically cutting in half the number of new ICE vehicles that are sold by 2035. What's your assessment on how many chargers need to be built out, need to be installed in order to meet that goal and meet that market? And how much of that market share do you think Blink can take?
Well, it's important to note that 2035, while the U.S. wants to have half their vehicles sold being EVs and non-ICE vehicles, most of the world are mandating that by then there are no more ICE vehicles being sold in their areas. But it's a good step, you know, in the Biden administration, and the amount of money, the $7.5 billion that they're earmarking towards charging infrastructure is going to make a tremendous difference. We are one of the largest players from an own and operate perspective. By scale and size and footprint, we are the largest owner and operator of charging infrastructure. We plan on maintaining that position and even growing our sales model. We have an amazing portfolio of equipment these days, from level 2 charging stations all the way to DC fast chargers on the platform side and back end. I believe we're second to none, especially with some of the stuff that we previewed during CES earlier this year that are now going to be released throughout this year and through the summer. We have just amazing product for each and every different type of location. So we believe we're going to be a major player. And as you've seen us growing through acquisitions and throughout our entire history, we were one of the consolidators of the industry. We plan on maintaining that position.
There's a larger debate that's happening about what this transition to all electric will mean from an infrastructure standpoint, whether that's about the strain it's likely to put on the power grid, and whether, in fact, it could add more emissions if it's not 100% renewable. What does the energy mix look like for Blink right now?
We focus on, you know, the EV environment. We ultimately believe that all of the shortcomings that there are with grid production, those will be solved. The world, you know, whether it's consumers or more importantly, the governments at large, they've chosen EV as the future of mobility. There's ways for us to add solar, wind, renewables, even nuclear. There's a lot of different ways to power electric vehicles. The good thing about having an electric vehicle is we become agnostic as to fuel source. You could turn anything into electricity, so we're not going to be dependent on any sole fuel source. That's the great thing about having EVs. Ultimately, I believe that there's going to be a lot of incentives globally, especially to alleviate with what's going on with Russia and the dependence upon their fuels, where we're going to be producing a lot more renewable energy in the near future.
Finally, Michael, I have to ask you about the stock move. I know CEOs don't like to say they don't watch the stock, but there does seem like a real reckoning that's happening with high growth companies that aren't necessarily profitable. I wonder how you think investors should be looking at Blink specifically, and what do you make of some of these big sell-offs that we've seen in these names, especially, I would argue, in EVs, where investors are being a little more critical, scrutinizing a little more of the actual numbers with the products in place?
I think it's unrealistic when you're looking, especially in the U.S. market, when we're still at the mid-single digits of EV penetration, to expect profitability today. This is a growth industry. This is about land grab and growing out your footprint and investing in infrastructure, especially Blink. We own a lot of our charging infrastructure. Some of our competitors, they just sell the hardware. They sell some networking services. Our business is about the future, about selling the fuel of the future to power transportation of the future. So it's not going to be profitability tomorrow. If that's your expectations, then this is not the industry for you. But if you're looking to go ahead and participate in an industry that's ultimately going to take over transportation, now's the time. If you look at the past, you see and you look at the values of, let's say, automotive manufacturers or those that have fueled the transportation of their local areas, it's always been on the fuel side where you're seeing a lot more performance for their investors. Most automotive manufacturers, almost 99+% of them, have gone bankrupt. But if you look at the companies that have fueled those vehicles globally, whether it's in America, China, South America, all over Europe, it's typically those fuel providers that are the ones that have the ongoing revenue model and have been for the last decade or so, outside the last few years with the technology companies, have been the most valuable companies on any exchange, in the top 1, 2, 3 companies worldwide. Ultimately, we're going to see the transition from the fuel, which is fueling internal combustion engines, convert to what we're doing. And whether it's Blink or other companies in the space, we're ultimately going to be powering transportation. That's what we do. And I believe the rewards will be there in the future. It's just a matter of having a long-term perspective. A lot of investors today, look for the short term. You got to really look for the long term.
Strap in for the long haul. Michael Farkas, it's good to talk to you today, founder and CEO of Blink Charging. Well, coming up, NFTs Explained, we're going to break down what exactly non-fungible tokens are. We'll be right back. Well, from Tony Hawk's first 900 to John Lennon's clothing, we have heard about all kinds of things being turned into NFTs over the last year. But what exactly is a non-fungible token, and what are they used for in the crypto space? We've got our very own Brad Smith here with the explainer in this week's Yahoo U.
That's right. So, Akiko, basically, breaking it down off at the top here, by now you've heard of the acronym NFT, and so non-fungible token. Basically, it just means that it can't be fungible. One Bitcoin equals another Bitcoin. One NFT, though, that does not equate to the same of another NFT here. So essentially, it is a token that is a unique digital identifier, cannot be copied, substituted, or divided. Now, one of the advancements that NFTs provide is a true source of authenticity. The existence of the token on the blockchain, it allows for an irrefutable ledger of origin and ownership.
So here's the big question. What are the most practical uses of an NFT? Because it seems like everybody is attaching their name to some form of NFT right now.
Yeah, that's exactly right. And so art, we've seen rare collectibles, memorabilia, they've all become the most immediate use cases for tokenizing assets, even concert tickets or exclusive offerings. Popular art auction houses such as Christie's and Sotheby's, coming back to the fine arts equation of this, they've launched their own metaverse targeted divisions that focus on digital art featuring exclusive NFT blocks. Further, in an effort to attach rare physical products to non-fungible tokens, limited edition resale exchanges like StockX, they've minted tokens on the Ethereum blockchain, and then they store the corresponding physical item in a secure facility. The company then allows the owner of the NFT to take possession of the physical item. That would then add a layer of data to that token that the physical item, it was removed from the facility, no longer perceived as factory sealed condition. So the real estate transactions, that's another space that we've seen NFTs growing in popularity. And then NFTs also can be beneficial in cases of healthcare in the future, as patients who tokenize their health attributes and personal data, they would have more insight as to where that data is changing hands versus the current mystery that is right now.
I feel like you're going to have to do this one every month, Brad. The growth is so incredible in this space. Thank you so much for the explanation. Let's do a final market check before we let you go. Of course, we are counting down to the all-important Fed decision. 2 hours away, 2 p.m. Eastern is when we're getting that decision today. And looking ahead here, investors kind of in a holding pattern right now. The Nasdaq seeing the biggest declines on the day, down more than 1%. We, of course, will have live coverage for you of the Fed decision. Our very own Brian Chung out there in Washington, D.C., kicking off our coverage at 2 p.m. Eastern. And, of course, we will have the 2:30 p.m. Press conference with Fed Chair Jay Powell as well. That does it for me on this Wednesday. We'll see you tomorrow.
finance editor-in-chief Andy Serwer sat down in a wide-ranging conversation with media mogul Byron Allen, and first asked him about the decline in Netflix shares since the company's most recent earnings report.
I don't think Netflix has crashed. I think there's a price adjustment on the valuation of the company. The company is still phenomenal. Over 200 million subscribers. So what happened? You know, they had projected and hoped that they would hit approximately 2.4 million subscribers, and it was negative 200,000 subscribers, if I'm getting the numbers right. But by the way, what I think people have conveniently forgot is that 900,000 subscribers were lost when Netflix pulled out of Russia. Now, if Netflix had not pulled out of Russia, they would have been positive 700,000 subscribers. For me, that's a win. Quite frankly, I think the market has overreacted to Netflix. I'm sorry, you have over 200 million subscribers. If you didn't pull out of Russia, you would have been positive 700,000 subscribers. There's nothing to apologize for. There's nothing to worry about. There's nothing to be concerned about. All businesses, look, businesses are like a flight, an airplane flight. You take off, you ascend, it plateaus, and then you kind of like keep cruising. They're in that cruise level. There's nothing to apologize. Netflix is a phenomenal brand. They're going to continue to grow. And by the way, I think it's a great buy in this category. They're going to always trade, in my opinion, in that 15 to 20 multiple. And right now, they kind of live in that 15 to 20 multiple. And they're going to start, if I had to guess, start doing acquisitions that are going to be transformative.
Right. Well, I think that's probably good news, music to the ears of Reed Hastings.
Well, no, I mean, look, I think Reed and Ted Sarandis have done a phenomenal job. They are excellent at what they do. And I think the markets have a way of just overreacting.
Let me ask you about Black News Channel. I know you're a champion of black-owned media. That business,
which was not black-owned,
right?
But black targeted. But let's talk about it.
Good. Let's start with that. Recently shut down. Let me ask you about your thoughts on that.
Right. Come on, Andy. Filed bankruptcy.
Okay. So still operating, but filed bankruptcy.
Yeah.
Okay. Go ahead. Tell me about it.
Well, you know, listen, that's an atrocity. Where, you know, America, that's a shameful mark on America. I've always said the greatest trade deficit in America is the trade deficit between white corporate America and black America. And until we close that trade deficit, we cannot achieve one America. Now, when you look at the Black News Channel, it's shameful when you think about, okay, CNN, phenomenal. They take in, every time you pay your cable bill, they take in about $1 a sub. Same thing with Fox News. They take in well over $1 a sub. The Black News Channel got zero from the cable operators when you paid your cable bill. Not even a nickel? If you had paid them a nickel, if you had paid them 10 pennies, they wouldn't file bankruptcy. Now, the Black News Channel had to live off of ad dollars. Now, Andy, if you look at the compensation package of all of the CEOs of the Fortune 500 companies in America, their personal compensation is more than what the Black News Channel took in all year. And so when you have those economic dynamics, then guess what? You're going to pink slip 250 to 300 black journalists. And that's shameful.
Right.
That's institutionalized racism.
Right.
What is it about corporate America that corporate America couldn't come up with a sub fee for the Black News Channel to grow this platform, and advertisers couldn't lean in and sponsor it? That's the trade deficit. That's the institutionalized racism. And we have a lot of these white chairmen and CEOs. They stand on stage, Black Lives Matter, and we're going to provide economic inclusion. But when you actually look at the numbers, there's zero economic inclusion. Right. And we can't achieve one America until we close that trade deficit and that education gap. And I'm here, you know me, I'm here to help us achieve one America.
Right.
One America.
You own what, about 5% of the TV stations in America. So how's that business going?
Well, I don't own 5% of the TV stations. My footprint is approximately 5% of the U.S. homes.
Okay.
I am the largest owner of ABC, NBC, CBS, and Fox affiliates that's not publicly traded or multi-generationally owned.
Right.
So I love that business. I've invested about $1 billion buying those stations over the last 2+ years. local news matters. We need local news.
Right.
When COVID hit, some of our television stations were doing a 90 share. 90% of the people who had their TV sets on were watching our news.
Right.
Local news is important. Weather is extremely important because weather is local. Weather is not national. And you need to have that weather information. That's life-saving information.
Right.
So I love owning local television stations. And by the way, we have NFL football out to 2033. Did I mention we have NFL football out in a $110 billion deal? We love the NFL.
Yeah, and I want to ask about the NFL. Well, let me go right to that. Where do things stand now with your bid for the Denver Broncos? I can see the color of your sweater. Is that something? How do things stand there? What's going on?
Well, you know, people have been asking if I've made it to the second round, and I appreciate that. And I'm under NDA, so I cannot confirm or deny, but I can say this. I'm smiling.
And you're wearing a sweater. That's a certain color.
You know, I love the NFL.
Okay.
And I think the NFL is I think the NFL is the best managed business on planet Earth. I think the way they manage their brands, that I think they are phenomenal at what they do. And I really appreciate Roger Goodell. He's underestimated. He's been there for over 40 years. I love a number of the owners, especially Bob Kraft. And I believe them when they're sincere and that they want to achieve something that hasn't been achieved in their 100-year history, which is to achieve the first black owner of an NFL team, which in my humble opinion is long overdue. Did I mention our Big Four network affiliates have NFL football out to 2033?
You
Okay,
did.
Thank you.
But thank you for accentuating. I want to ask you about, shifting gears here, by the way, I want to ask you about Elon Musk and Twitter.
Yes.
Any thoughts on him buying that?
Listen, if he's going to use it, buy it, right? I think that it's going to be there. It's going to be around. It has significant influence. I hope he uses it for the greater good. You know, I buy media to be able to amplify and campaign for that agenda of one America. And listen, we have to remember that America's a small village. We're only 330 million people out of a global population rapidly approaching 10 billion. And as we achieve 10 billion people on this planet, we do not have enough resources to support 10 billion. The bottom 5 billion will perish. And we must get our American tribe to the top of the pyramid. And we have to understand that we are stronger together. There's no black America, there's no white America, there's just one America, one tribe. And we have to pursue that. And what I hope is that Elon uses his power, his platform. I call it going after the 5 E's. Make sure every American has a great education. Everybody, that's the first one. Everybody has equal justice. Everybody has economic inclusion. Everybody has environmental protection. And that 5th E, empathy. That we have to have empathy for our fellow Americans, our fellow human beings. Make sure, stop acting like we don't see the food insecure. Stop acting like we don't see the homeless. Stop acting like we don't see the mentally ill. Mental illness is the greatest epidemic in this country. And Andy, when we master and achieve the 5 E's, we can achieve heaven right here on earth.
Is the 6th E Elon going to do that, though?
Well, I don't think he should be the 6th E. Elon's going to do what he's going to do. But at the end of the day, hopefully he is using that platform to bring us together and not divide us, because there are plenty of media companies out there that work to divide us, and this country's too great to be divided.
And last question, Byron. I want to ask you about what you're doing here at Milken. Are you speaking up about these inequities in America that you just discussed here to the platforms?
Yeah, listen, I'm always speaking up and saying we must achieve one America. And today is our 40th anniversary of the Weather Channel. I'm very proud of that. And to celebrate that, we launched this morning the very first and only the Weather Channel in Espanol, the one and only 24-hour weather news platform in Spanish, because this is life-saving information, and I don't want language to be a barrier, and I'm very proud of that. So we're going to always do it, and we're going to always make it accessible to you, and I'm going to always campaign to make sure we achieve one America.
We have been checking in with folks at the Milken Global Conference out on the West Coast. And one of the people who's there is the Austin Mayor, Steve Adler. I caught up with him in Austin. Now I get to catch up with you again, Mr. Mayor. Thank you so much for being with us. I know that you're talking about the big economic growth that Austin has seen out there, but I do want to ask you about something else, an item that is in the news first, and that is this leaked draft of the opinion from the Supreme Court that looks like it could be poised to overturn Roe v. Wade. And I'm asking you about it because, as we've talked about before, Austin is sort of a liberal island in the sea of Texas. Texas, one of the states that's poised to overturn Roe v. Wade, or poised to act on that overturning if and when it does happen. So I would ask you, sir, how seriously should we take this report? And is there anything that you're sort of poised to do about it?
First, thank you for the opportunity to be with you again. I think that everybody, most of the people in our city are real concerned about this leaked opinion. First, substantively, if Roe is going to go away, that seems such a horrible thing after being law for such a long period of time. Our city has done everything that we can to help protect that right for women. And to help everybody in our city be able to take advantage of this constitutional right. I tell you, I am real disturbed about a leaked opinion. I've never seen such a thing happen this early in this process. And it just seems to be just another hit to our democratic institutions. As we lose more and more trust in our basic democratic institutions in this country, I think that's the biggest threat to democracy generally. So the way that this happened is also incredibly disturbing.
I would also ask you, Mayor, Texas, leaving aside what's going on in the Supreme Court, Texas is one of the states that has been working to restrict access. Is there any recourse you have in a municipality within a state that is making those kinds of changes?
Well, the state's trying to make it as hard as it can for anybody to be able to assist anybody taking advantage of this right. But in Austin, where Roe v. Wade is so significantly supported, we've done things like supporting our area clinics by providing support for women so that they can take advantage of their legal right, helping them with logistics and costs. So we're doing everything we can as a municipality to make sure that this right not only exists, but is one that people can take advantage of. It's still the law right now, and we'll continue to do everything we can, but we live in a state that is trying to make it harder and harder all the time.
I want to talk about the return to office as well. When you think about the number of companies, major tech companies occupy the largest amounts of office space in Austin. So when you have more tech companies that are continuing eyeing the area, what is the selling point, the proposition that you're continuing to discuss with them, especially in the face of some of the legal fronts that are taking place in the state too?
Well, I believe that the positions that are being taken by our state leadership with respect to abortion, with respect to transgender children, make it harder for us to attract businesses, make it harder, more difficult decision for people to decide to live here. But in Austin, we try to stay true to who we are, and we recognize that what makes Austin ultimately attractive are the people that self-select to be here. There's a different culture, there's a different way that people view the world and each other in this city, and it's real important that we maintain that and nurture that. It's an innovative, creative city with an incredibly high tolerance for taking risks, and I think that's a real differentiator and one of the reasons why these companies want to come to our city. The people they want to have work for them want to live in this city, and this is a great city for innovation.
Mr. Mayor, one company or business you've attracted to Austin is Tesla and CEO Elon Musk. Now, he's had a lot of good early success there in Austin with his new factory. He has recently made a bid to buy Twitter, and he has floated the potential of closing down that San Francisco headquarters. Do you want to roll out the red carpet to get those Twitter workers?
Well, there are a lot of Tesla workers that Elon Musk could bring to Austin that are exactly the kind of jobs we want. Those are the middle skilled jobs, the jobs that are paying $50,000, $60,000, $70,000 a year that are in his factories. And I want to do everything I can to help encourage him to bring those jobs, because in our city, that's what we need in order to be able to maintain the people, the diversity. We have an affordability issue, and we need to make sure that we don't lose the diversity and the people that create the friction that drive the art and the culture in our city. I'm happy to have Twitter workers come here too. I want Mr. Musk to help us with those middle skill jobs.
And then additionally here, thinking through all of the movements that we've seen in trying to bring more chip manufacturing, and especially into the Southwest, we've seen much of those projects be started out. Where are some of the talks taking place in Texas, in Austin specifically, and adjacent areas to get some of that chip manufacturing? I believe AMD is one of the companies that also holds a lot of space within Austin.
And that's true, and we know that Samsung just announced their $15 billion plan immediately outside of Austin. Those kinds of jobs are great too. Again, we're really lucky in the city of Austin that we have lots of $150,000 plus a year jobs. But if we're going to preserve the people, the breadth of people, the diversity of people, we have to make sure in a city where prices are going up, home prices, it's getting more and more expensive to live in this city. We have supply issues, and we have to increase housing supply. But we also have to increase the number of jobs that will enable somebody to be able to stay in this city when costs are going up. And the chip manufacturing gives us a real opportunity, both with those companies and then the satellite companies that form all around them, to have those $40,000, $50,000, $60,000, $70,000 a year jobs that someone can get without a 4-year degree, sometimes without a 2-year degree. That's really the hole in our city, and that's why we're so hot on that kind of clean manufacturing.
Paramount handily beat analyst profit forecasts as it saw a jump in subscribers for its streaming services, but shares are under pressure right now. Joining us for more is Paramount CFO Naveen Chopra. Naveen, great to get some time with you here. As I just mentioned in the opening, the non-Netflix quarter. So Paramount Plus added 6.8 million subscribers in the most recent quarter. Netflix lost subscribers. Why do you think that disparity exists?
Yeah, hey, Brian, it's good to be back with you. And I like the way you framed our quarter. Definitely a very different outcome than Netflix, adding 6.8 million subscribers to Paramount Plus. And I think it's a sign that despite a lot of the conversation following Netflix results, consumers continue to be very excited about streaming, particularly streaming services that can bring very high quality content that appeals to diverse audiences, which is exactly what we're doing with Paramount Plus. I think it's proof that our strategy is working. That strategy is working because it's differentiated. And it's differentiated because we have the ability to combine our traditional business with our streaming aspirations. And that yields a broader model. It's a model that is broader both in terms of content, broader in terms of business model, broader in terms of the platforms that we distribute on, and broader in terms of its geographic footprint. So when you put all those things together, we think we have a fundamentally different model and a competitive edge relative to a lot of legacy streamers.
Naveen, you sound like a guy readying to take some major market share from Netflix. Now they're out there cutting costs to try to make their next quarter. What do you think that means to Paramount?
Well, we're very committed to our plan, which we laid out on our Investor Day earlier this year. As you know, Brian, we continue to be very bullish about the opportunity in streaming. We see a very large and growing TAM across both the subscription side of that business and the ad-supported components of it. And we're continuing to invest aggressively to capture that. That being said, we have from day one thought about streaming as a business that needs to and will generate healthy margins over time. And we're going to be smart about how we balance investments in growth versus profitability over the next few years. And I think that's something that investors are obviously counting on us to do.
You know, in addition to what Saz was mentioning on the Netflix front and the broader entertainment industry, especially in the D2C space right now, looking towards where advertisers can create even more revenue opportunities, you know, what is that net effect to advertising for Paramount if you see even more of that competition in the landscape on the advertising front?
Well, we've been big believers in the role of advertising in streaming for a long time now. And it's a big part of obviously what we're doing with Paramount Plus and also the success that we've had with Pluto, which is our free ad-supported streaming television service. And, you know, the fact that others are starting to get interested in those elements of the business, we think is validation of our strategy. But I'd note that we not only have a significant first mover advantage here and a large leadership position, the fact is we bring things to that equation that are very unique. The ability to both sell, deliver, measure advertising across broadcast, cable, and digital platforms is very unique. And it's not trivial to stitch together all of the systems and services that you need in order to do that in a really seamless way for advertisers. We also have really proven that we can drive a lot of advertising growth by combining the direct sales channel, where we have deep relationships that have been cultivated over many, many years, with the programmatic and indirect channels. And that's a key part of delivering the kind of advertising growth that we've seen in our D2C business, which I point out was up almost 60% in Q1. So we think we're in a very, very strong position there, even as others get interested in what is a very exciting opportunity.
Naveen, everything sounds great, but your revenue did miss estimates and the stock is down. So, you know, I get what you're saying about this diversification of the business, the streaming kind of cushioning when other things slow down and vice versa. But, you know, we've seen not just from Paramount, but really across the industry and not just in not just in media, but in social media and in tech, that advertising generally is slowing down. What do you do about that for the remainder of the year?
Yeah, we feel very bullish about the long term, and I think that's really our focus in the advertising market specifically. There has been some choppiness of late that tends to be mostly focused on segments that have exposure to supply chain issues and things of that nature. But there are certainly other segments where we see some real strength, whether that's things like travel, entertainment. We're looking forward to the political season at the end of the year, which we think will be a nice tailwind for us. So longer term, we feel good about the advertising opportunity. We think we're very uniquely positioned in terms of both what we bring to the table on the traditional side of the business, and as I talked about, being able to combine that with streaming. So over time, I think there will continue to be a lot of growth potential in the advertising world.
Naveen, I've had some folks tell me that this year and next year combined, Paramount will spend more than $40 billion to develop original content. Is that about right?
Well, we've talked about our streaming content investments, which is the main place where we are looking to increase what we're spending. I've noted previously that we spent about $2 billion on streaming content investment last year, and we're on our way to spending roughly $6 billion in 2024. That is going to be combined with continued investment in the traditional linear side of the business, but there is some remixing that will continue to occur between traditional and streaming. We are a major player in both of those markets, and we will continue to invest in content to get there, but we do it in a very smart way that allows us to leverage content from the traditional side of the business to help power some of our growth in streaming as well. And I think that's one of the big differentiators that we have versus pure play streamers.
Perhaps for my own edification, what do you mean by remixing, and how would that show up in some of the costs, the allocation for producing series in one platform versus another?
Yeah, sure. Well, one way to think about it is that we have a lot of content that does what I describe as double duty, where we use the content on linear, and then we also use it on our streaming services. You can think of sports like that, or you could think about many of our movies in a similar fashion, because we capture box office or theatrical revenue and then move those to streaming. And when we do that, we allocate the cost between both the traditional segment and streaming. And as consumer behavior moves more in the direction of streaming, then obviously we will allocate more of those costs there to represent how the content is being used. But on a total company basis, what we like about that model is we're able to capture revenue in both segments without taking on any true incremental cost. So it's a very efficient model.
We are watching shares of Hilton fall in the session this morning, down nearly 4%. The hotel chain reported a revenue miss and disappointing forecasts. Let's go deeper into those numbers. We've got Kevin Jacobs, Hilton CFO. We've also got our very own Brian Sazzi here with us at the desk. Good to talk to you today. Let's start with the guidance, because that seems to be where investors are concerned. If you look at where the stock reaction is, talk me through some of the headwinds that you're seeing in the quarter.
Yeah, thanks, Akiko, and thanks. It's great to be on with you all again. And it's actually great to be here talking about the things we've been talking about, like, growing demand for travel across the globe and actually giving guidance again and doing things like returning capital. And so we're not really seeing headwinds in our business. We've given guidance for the first time since the pandemic. Our guidance at the midpoint, I can't really comment on how that relates to what the market's expectations were, because we haven't been giving guidance and they've been setting their own expectations. But we're giving guidance that at the midpoint of our adjusted EBITDA is back to 2019 levels. It's actually right about flat to 2019. And so we feel really good about the growing demand for travel across all of our segments. It's largely been, throughout the pandemic, a leisure-led recovery, and leisure demand remains quite strong. And now we're seeing actually significant strengthening in both business and now group demand. And so we feel really good about the prospects of the business, and we're not seeing headwinds, we're seeing tailwinds.
Kevin, Brian here, good to see you. Within that guidance that you provided, have you baked in a summer travel boom?
Yeah, we think this summer is going to be, after setting records in our business for travel demand and revenue last summer, we think this summer is going to be another sort of all-time record. And so, yes, that's baked. That's all baked into our guidance as a really strong summer season. But again, following up later this year with improving trends in corporate and then group in particular, we think is going to come back over the back half of the year to the point where we think corporate business travel by the end of the year will be flat to 2019 levels, and we think group will be about 90% of 2019 levels.
I've talked to a lot of folks in the hospitality industry right now, Kevin, and they're all telling me that it's still hard to find workers, whether it's someone at the front desk, whether it's someone to put food in the buffet section. How are you addressing this?
Yeah, look, we're getting really creative in terms of attracting talent. Look, we have a great business in hospitality, and it's a wonderful place to work, as evidenced by us being named the #2 great place to work in the U.S. just very recently. And people can have great careers in hospitality. And actually, it is tough to get labor still, but it's not as tough as it was. It's getting better almost by the day. And as some of the dynamics that were going on during the pandemic, whether that was because people didn't feel safe going to work, or whether there were better alternatives out there in terms of, not working versus working, they're now coming back to work. And again, we're a really attractive business, and there's strength in our business, and demand is growing. And so we're actually having a lot more success in bringing people back to work at the moment than we had been. But it's still tough out there, no question.
Hey, Kevin, it's Brian Chung here. I wanted to ask you just about your portfolio of brands. If you kind of take a step back and compare the Hilton portfolio now compared to pre-pandemic, is it larger? Is it smaller? I know you opened, 76 new hotels just in the first quarter. Has that also coincided with rearranging or closing certain types of properties? I mean, is it bigger, larger, more skewed towards one demographic over the other compared to where it was prior to all of this?
No. Yeah, no, it's the same portfolio of brands. We had launched a couple of brands, relatively recently up when the pandemic started. But yeah, we've actually grown net units at a rate that has exceeded, we grew net units 5.6% last year. Our guidance for this year is that we're going to grow net units 5%. And we think that over the next few years, we're going to get back to growing at the rate we were growing pre-pandemic, which is about 6 to 7%. So we feel really good about the prospects for growth around the world. We love our portfolio of 18 great trading brands. They all drive significant premiums to their competitors in terms of the indexed revenue that they produce for our owners. And so it's a really great portfolio of brands, and we're growing at a rate that is comparable or exceeds any of our competitors.
Kevin, you touched on corporate travel earlier, and yes, we've heard that it is coming back. I wonder if you can take away anything from what you have seen in terms of the bounce back so far. Are we seeing, people travel for business as frequently as they did pre-pandemic? I mean, what are you seeing in terms of how behaviors have shifted on that front?
Yeah, they're getting there. I mean, I think I said, earlier in the segment, we think that corporate business travel will be back to pre-pandemic levels by the end of the year. And a little bit of the dynamic has been throughout the pandemic. We've been accommodating more small and medium-sized businesses. When the big corporate accounts, at one point were down sort of 90%, right, at the height of the pandemic. Those big corporate accounts, by the way, were only down 12% in the first quarter. And small and medium-sized businesses are out there traveling to a level that they were, in 2019. Overall, in the first quarter, our business mix, which normally pre-COVID would have been about 55% of our mix would be business transient. That went down all the way to about 35% during the pandemic. And that's now almost just about halfway back. It's about 45% of our travelers. So that segment is growing. And we think that in the end, when it's all said and done, there might be some slight differences in the way people move around. And there's a lot of debate about, digital nomads and will people go back to the office or not. But we think largely when it's all said and done, our mix might be slightly higher leisure versus business, but it'll look an awful lot like what it looked like pre-pandemic. We think that people's travel patterns are largely going to go back to normal.
And Kevin, you've long been the hotel development guy also at Hilton. How will higher interest rates be a deterrent to growth over at Hilton and the lodging industry more broadly?
Yeah, look, rates are up a little bit higher, but again, in the context of where they've been historically, rates are still relatively attractive, and so it is a little bit of a headwind to new development. But what's a massive tailwind to new development is demand for travel, right? And people feel really good. Our owners feel really good about the prospects for travel. We expect our signings to be up in the mid to high single digits this year in terms of signing new deals, and what that's reflective of is a little bit higher input costs, including the cost of the developer's capital, but a lot of optimism for growth in the future. And so along with higher interest rates has come a little bit more inflation, and we reprice the rooms every night. And so inflation is a tailwind both for our business on a same store basis, but also for our hotel owners and developers, and they can see that. And so they feel good about the future. And, in any given deal, it gets a little bit tougher when rates go up. But in the end, hotels are pretty profitable businesses. They provide really good cash on cash returns. And so even in a slightly more elevated interest rate environment, we can still do quite well and our owners can still do quite well. And thus is why we think we'll return to a growth rate of 6 to 7% over the next couple few years.
All right, Hilton CFO Kevin Jacobs, thanks for joining us. And thank you to Brian Stasi as well.
Well, let's bring in Frank Sorrentino. They're the CEO of Connect One Bank for more on what's been happening. So, Frank, we did believe that the markets had priced in this 50 basis point hike coming this week. But after such a late start in battling inflation, coupled with some of this economic data we're getting, how aggressive does the Fed have to be right now?
Well, I think the market's actually priced in more than just the rate increase that they made and the one that they're anticipated to make. I think the market's pretty much priced in all of the Fed increases that are going to occur over the next year or so. You've got the 2-year is trading in the mid twos already. So I think the market, as the market always does, is getting it right.
Now, given the unprecedented nature of this recession, obviously no one saw COVID coming, and then you also didn't see the Russia-Ukraine invasion coming. How might the recovery and the strategies needed to support the economy be different this time versus other recessions that we've witnessed?
The big thing that I see that makes it difficult to really look back in history and try to find an answer for how this recovery will go is the enormous amount of liquidity that's in the marketplace today. The Fed, pumped the economy with over $4 trillion of additional stimulus in 2020. And a lot of that is still floating around in the economy. We see that today in people's personal savings accounts. We see it in business coffers. And so we see a lot of cash on the sidelines moving its way into the economy. We've seen a lot of assets been priced at, I would say, exorbitant levels. And so how all of that liquidity is either removed from the economy or how it makes its way through the economy is something that I don't think anyone can say with certainty that they know what is going to happen. We know what happens when we raise interest rates. We don't know what happens when you take $4 trillion out of the economy if they decide to take that much away.
And have we gotten an indication perhaps of how aggressive they might be with this monetary policy tightening and how we might see that play out? Because obviously the Fed very focused on inflation and also the job market, don't seem to be as worried about things like the equity markets.
Yeah, I think I don't see it all just in the equity markets. There's many other assets that have been priced up to unrealistic levels. But certainly, interest rates are the easiest way to slow down the economy. But when we look at things like unemployment, it's at near historic lows and potentially will go even lower. And interest rates, even if the Fed moved fairly aggressively through this year and got us to what they believe is the neutral point, those would still be historically very low interest rates if you were to look back over the last 20 years or 25 years. So I think the Fed has a real challenge on its hand. I think they are gearing up for a soft landing. I think we're seeing that with our clients and how they're reacting to what's going on in the marketplace. People are still reporting that things are quite robust. Home sales are up. Apartment rentals are tough to find. Materials are tough to find. Folks that are clients of Connect One Bank are seeing a fairly strong economy, even at this point in the cycle. And I don't see too much that's standing in the way. I know there's two tails here of whether we're headed into a recession or not. But I see the Fed managing some level of soft landing.
And as you mentioned there, obviously you have an inverted yield curve pointing towards a recession, but then you have, some strength that we're seeing in the economic fundamentals. But then you also saw this 1.4% GDP growth coming in, surprising. So where do you look then for clear signals about whether there will be a recession and how soon it might come?
Look, we like to speak to our clients. They are mostly small and medium-sized businesses that bank with us at Connect One. They're located on Main Street, and I like to talk to them. I like to understand what's happening. We're definitely seeing issues with supply and demand. It's difficult to get materials. It's difficult to get any sort of electronics. I think part of the GDP reduction was because of the fact that we had to buy a lot of goods and services from abroad because we just can't produce it fast enough here. So I think there are things that really we have to peel the onion back and truly understand what's happening in order to fully bake in what our expectation is for the future. I think, the economy for the last 2 or 3 years here has been a solid green light. It was put your foot on the gas and go. I think we got a flashing yellow now, which doesn't mean to stop. It just means slow down, take a look before you step on the gas again. And I think that's what our clients on Main Street are telling us.
So for some of these small businesses then, what are their top priorities as they look ahead to the rest of the year? And what are their biggest concerns?
Their biggest concern, that the ones that are, communicating with us about what are issues, finding good quality labor is probably job number one. The labor market is so tight right now. And that's one of the reasons why I lean more or less towards a recession. There just aren't enough people to fill all the jobs that are required from now to as far into the future as we can see, and as far into the future as the clients of Connect One can see. So that's number one. Number two is, I think, really understanding this neutral point in interest rates. I think people are accustomed to very low, 0 to very low interest rates. And going from very low interest rates to just low interest rates is concerning to a lot of folks. That concern is not so much. And then third is, of course, the supply imbalance, the ability to get the supplies that you need in order to run your business, whether it's the raw material or whatever it is you need. Especially Connect One does a lot of construction lending, building supplies. That's one of the biggest biggest contributors to the economy is the building sector. Very hard to get supplies and labor. So I think those are probably the three most important things that people are focused on.
So just quickly, as we're running out of time, about 30 seconds, if you had to give 2 tips for companies in terms of the best way to assess the health of their business so that they can try and move forward in this climate, what would that be?
I would say keep an eye on your liquidity. Make sure you have dry powder for the future. Do not overextend yourself here. This is not a place to get overextended in this economy. Keep an eye on your business. Don't let all the noise that's going on around you affect what decisions you make. There are some really great businesses out there that are doing quite well and will continue to do quite well, notwithstanding what happens to interest rates or any of these other things that we're discussing.
All right, well, I do appreciate you joining us today. Frank Sorrentino there, the CEO of Connect One Bank.
We want to continue talking about this and exactly what this means for businesses, how corporate America is handling this landmark case. And for that, we have Neeru Paharia, associate professor at Georgetown University. And Neeru, it's great to see you. We've heard from a number of companies ahead of this leak, Yelp, Citi, Amazon, just to name a few of them, laying out some plans just in terms of what they plan to do for employees if, in fact, Roe v. Wade is overturned. But my question to you, though, is talk to us just about what this means for companies and the pressure that businesses are facing these days to take a stand on an issue like this.
Yeah, it's uncharted territory we're in right now, and in this particular case, companies are really going to be forced to take a side. You know, you have to pick one side of the fence to be on, especially if you operate in one of these states where they're predicting the law is going to change. And so, you know, not only, I mean, we can think about the benefits they're offering their employees and the access to these kinds of services and helping employees travel across state lines in order to meet their healthcare needs is one thing. But, you know, there are other things as well. You know, are you going to open up a new factory or a new office in a state or not based on these kinds of healthcare policies? Because these companies are thinking about their employees and they're thinking about their customers, and the sort of political alignment of both of those constituencies matters tremendously to these companies.
And obviously, we're already in the middle of a labor shortage here in the United States. If you're one of these bigger companies, you're perhaps better equipped to budget for some of these travel expenses for people who want to travel. What do you think this might mean, though, for smaller companies who perhaps can't afford these things?
Yeah, I mean, in that case, you're definitely kind of stuck, right? You know, if you think about it, if you're a small coffee shop in the middle of Texas, what can you offer? And so I think in that case, you know, maybe you can speak out publicly against some of these things. If you have the resources to offer those kinds of services to your employees, you can do that as well. But there are other ways to kind of make your political position known. And, you know, that's just one side of the issue, right? There are also a lot of people who are anti-abortion and would be happy to see these laws change. But either way, it's going to be hard to stay neutral, especially as a larger company.
Very difficult. And if there's been a fire drill the last couple of weeks, Neeru, it's of course been Disney versus Ron DeSantis in Florida. What do you think CEOs across the country ought to have learned from what happened in Florida?
Yeah, I mean, that is like truly unprecedented. There were some grumblings of similar things happening in Georgia post the election with Delta and a few other companies. But in the case of Florida, it's unprecedented that a government would retaliate against a company for taking a political position. And in the case of Disney, you know, they kind of were stuck between a rock and a hard place. Like their employees were really pressuring them to say something about the Don't Say Gay policy. And so they had to, they were trying to stay out of it, but their employees kind of pushed them into making a statement. And then and now they're being sort of penalized by the government. So that's a line that was recently crossed, and I'm sure executives are thinking about that.
Yeah, and you were just digging into that a little bit deeper. I guess if you were to be advising some of these CEOs, if you were telling them exactly how or the best way to go about handling a situation like this, like you said before, it's impossible now for companies to stay out of something like this. What are the one or two things maybe these executives could focus on when they're determining how to address this issue?
Yeah, so if you can't stay out of it, then you do have to pick a side. You know, if staying out of some of these you know, very polarizing political issues is an option, you know, that might be something to really consider. But in the case where you don't really have a choice, then what do? So here you want to think about acting early. Acting early is a sign of authenticity. So if you're the first person to make a first company to make a decision, you know, one way or the other, that resonates with consumers as opposed to you're like the 10th or the 20th company. Because when you get to that point, you're kind of stuck. Like if you're going to get in trouble if you don't do anything, and you're going to get in trouble if you do something. So it's better to act early and to kind of get ahead of these things.
And I know you talked about employees, but you also have, investors like Warren Buffett, who says, look, I have shareholders who perhaps may not share the same beliefs as me. So he tends to not speak out on some of these political issues. What about some of these publicly traded companies? Does the CEO perhaps owe them silence, or do they have to take a side if they're also having to worry about perhaps the well-being of some of these companies and shareholders that rely on them?
Yeah, it's incredibly complicated. There's so many different stakeholders, your employees, your shareholders, your customers, and we live in a very politically divisive world. So it's a tightrope to walk, and all the constituents. You have to think about all the constituents.
How do you expect that future business decisions will be made in regard to this? You hinted this earlier: new buildings, expansion, hiring new employees. Will this impact the greater economy?
I personally think so. Yes. I mean, when you're making these decisions about what state to locate your business in, where to hire more employees, where to expand your operations, you think about the tax climate, but now you have to also think about the political climate, because it is something that matters to your employees, and especially in these knowledge-intensive industries, the employees have, strong opinions, and particularly often on one side. And so, you may want to locate in a particular state because they have a low cost of living and low state tax rate. But then you also kind of have to weigh that against your ability to attract and retain your employees, and whether, that's a location that talented employees will want to actually be in for these kind of political issues.
And it is sure to shake up the midterms. Neeru Paharia from Georgetown, thanks so much.
In this episode of Influencers, Dice founder and CEO Phil Hutchin, along with Tony Fadell, Dice board member, Nest founder, and inventor of the iPod.
Humans need to be around other people. I mean, it's one of the things that make us human, and seeing an amazing performer is one of the things that you remember for the rest of your lives.
There's always unintended consequences in everything, and technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Phil Hutchin, the founder and CEO of Dice. Also, Tony Fadell, a board member at Dice. Tony, as you may know, former Apple executive, iPod inventor, iPhone co-inventor, also Nest founder, and a principal at Future Shape, which is an investment and advisory firm working with engineers and scientists, developing foundational deep technology, I should say. Got all that. Okay, we want to talk about Dice. And Phil, why don't you start us off by telling us what Dice is all about and what you guys are doing?
Yeah, no problem. And nice to see you, Andy. Well, first of all, Andy, have you ever bought a ticket?
Yes, I have.
And how was that?
Not so good, Phil.
And so I think that every time we kind of ask someone if they bought a ticket, they ever come back to me with oh my God, it was amazing. It was always I bought a ticket, I thought it was one price and it was another price, or I couldn't buy a ticket and it was thousands of dollars or whatever it was, or, I missed out on the show, whatever it is. And so there's lots of problems around it and, the opaque nature of the industry. So Dice is a super simple way to find out what shows are going on. 2 taps and you've bought the ticket. It's killed scalping. And if you can't turn up to the show, you tap a button and you get a refund. And it's just making all those things traditionally associated with, going to a live experience, they're gone. And now it's just very easy.
I have a million more follow-up questions and we'll get to them. But Tony, I got to ask you, you joined the board of Dice in September. What made you a believer And why join at a time when the live music industry is still getting back on its feet with COVID?
Sure, Andy. As well, it's great to see you. So for me, music's in my blood. Given my past, and I'm from Detroit, right? So when I was in Detroit, exactly, Ticketmaster first came out, and it was like a revolution. I could go walk down to a local store and get a printed ticket. You didn't have to go to the box office, and so that was an incredible innovation for me. But since that part, they haven't innovated a lot. It's still like, okay, what can we do to extract more money from the fans? Really, is what it is. And it hasn't been about more convenience, about more access, making it easy. You can say what you want about airline ticketing or other travel ticketing. At least you can exchange tickets, upgrade them, change the dates, everything. You don't have any of those conveniences at all in the entertainment ticketing world or sports ticketing world. Well, that's what Dice is trying to solve. And because I'm such a music fanatic and have been suffering with these things for years, I met Phil, and I didn't just get involved with Dice this year. I've been involved with Phil and Dice, 5-6 years now. So this was like literally when they were like 10, 12, 15 people. So we've been working together with them and just been, because of the experience that they really want to bring. Fans first. It's all about the fans. Even the artists, the venues, everyone understands that. More fans. And especially today when, bands are not making any money except for merchandise and for entertainment events. Other than that, they're not making any money on streaming. We see that unless you're the top, 100 artists, they don't make any money. So where are they going to make their money, and how are they going to make sure the fan has a great experience? That's what Dice is all about.
Phil, I got to ask you about the competitive set. I mean, Tony mentioned Ticketmaster. They're still around. StubHub, Eventbrite. What sets you guys apart from those companies, and how are you going to build your brand?
Right. So I think I kind of touched on it. Like, our only customer is the fans, and that was something that we established on day one. So everything that we build is for that fan experience. So when we're building things with partners or venues or artists or anything else, we always ask the question: is it good for the fan? And I think that the second thing is that Dice is just software. So, if you're looking at Live Nation, I mean, they do huge productions, they do all these things, Ticketmaster is part of it. We're just like using software to bring fans and artists closer together, like helping them, decide which cities they're on, how much they should be charging, all these things to make it super efficient. And I think that the third is that we're able to scale much quicker around the globe. So, I mean, we started off in London, but now we're in the US, in France, Spain, Italy, India, Australia, moving into Southeast Asia. So it's like, it's kind of, there's a global network effect that happens as well, because you're giving that data to artists to help them plan global strategies themselves. So it's just really, when we're talking about empowering artists, it's like helping them control their cash, so they own the cash. They can pay people and do things instead of waiting for someone to pay them.
How do you mitigate against scalpers? You mentioned that. Can you drill down a little bit more there?
Yeah, cool. So this is, I mean, it's like one of those things where in hindsight, it's like so simple, but there's nothing to sell. When you buy a ticket on Dice, there's no ticket. And so there's nothing to screenshot. There's nothing to pass on to somebody else or anything else. Just moments before the show, there's like, an animated a QR code that goes around, which, is there, but it's a very elegant, simple solution, but it's a way that, if you've got nothing to sell, then it's impossible for scalpers to put it on any platform because they don't have anything.
And how much of the business, Phil, is reliant upon the return of live music to pre-pandemic levels? And what is your prediction about when that'll happen?
So we've just spent 18 months, or give or take, and like sort of stuck in our homes, been entirely digital. And you're thinking about one of the things that I didn't appreciate, at the beginning of Dice, and kind of really kicked in sort of just before the pandemic, is that we saw some data in terms of loneliness for people aged between 17 and 21, and a third of them expressed that they had intense periods of loneliness. Even before the pandemic. You put the pandemic on, everyone kind of living digitally. The return to live since summer, it's been insane. I mean, every record has been broken at Dice in the last 5 months. When we're when we're looking at the data, like still now, shows are completely packed. Like the venues are packed, everything else. You read in the newspapers that people have become hesitant about stuff, and then you go to live concerts and they're absolutely full. And I think it's kind of going back into what I was talking about with learners, that humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your life. So, live experiences, I think that people are actually appreciating them even more as a result of the pandemic.
Yeah, Phil, I've been giving Tony grief about musical preferences. I'm going to pitch you a little bit. Like, I don't know if it's Adele or Coldplay. I'm doing the UK thing with you. So do you work with the artists or do you work with the venues? So in other words, here in New York City, MSG, Madison Square Garden, are you selling tickets for them or are you selling tickets for Adele?
So we do it for both, but the focus is largely on venues because many artists play venues. But we have an artist development team, and that's part of the idea of the global network is that Dice has venues all around the world, and then artists want to play those venues, and we help them kind of connect them with those venues via their agents or the bookers or whatever else. And then part of that is so I've got an example. So it was an artist in London called By. They started off with us from the very first show, 200 people, and we made the deal with them like, cool, sell exclusively through Dice, and let's kind of like build up this live story. And then from that, you're not allowed to spend any money on social media advertising. You got to trust into your audience, but get the story right. Now they can sell 50,000 tickets in London, and it's kind of like taking them at each of those steps all the way through. And throughout the whole time, Bicep understood their audience. They knew what they wanted, where they wanted to play. They had control over, their live strategy, and this is what we're doing at scale now.
Right. And so do you cover all the venues in the world, or are there some venues that are not a part of your ecosystem yet?
Yeah, so we wish we had. Well, we have all the best ones, or most of the best ones. So there's some holdouts, but there's other people who have the ticketing rights for those venues. But we have it's 3,600 venues sort of around the world, which is increasing, day by day. And we also work largely in major cities. So in New York, over 1 million people used Dice last month. And so there's quite a big spread of venues in New York. And for that, it's the same in Paris and Barcelona, all these things, because there's lots of events happening there. So the discovery engine is really kicking off. And our thing is that if you want to see a show once a month, then let's get you to a show once a week. How do we reduce the friction for you to actually, get there? So, our competition is like people staying at home watching, Netflix. Is like, okay, well, how do we make it as easy and compelling to kind of get out and see something? And it works. I don't think anyone's been to a great show and said, well, I'm not doing that again. So it's the exact opposite.
Tony, while I have you here, I got to ask you a few questions about Apple and the iPhone, Silicon Valley.
Oh, God.
So you were on the cutting edge in designing the iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech? Thoughts on the metaverse? Those are two big questions happening right now.
Well, the big things on the horizon for consumer electronics, we're hearing more about, augmented reality and these kinds of things. We're hearing about the metaverse. Frankly, I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse. So let's make sure we have an environment we can live in before we find another environment that, keeps us in like refrigerated chambers and, so that we can breathe and eat. So that's how I feel about the metaverse, but on consumer electronics, I think, a lot of this stuff, people think that this is going to be the next big thing, like augmented reality. I think it will be for certain very niche verticals, but not necessarily like the consumer thing that you need. Because, we saw this before. You got to need the technology, and then you have to understand that the consumers want it, right? And they want to live with these things on it. And it's social acceptance, not just you accepting it, but the people around you accepting it. And that I've learned all the time is the technology might be right, but is the social timing right? Is there a social acceptance? And are you truly delivering a pain killer because there's a clear need, there's a clear pain? The iPhone solved a need, right? It was on the go, internet, email, media, these kinds of things. We don't see the need yet for the metaverse, and then to have the metaverse wherever you go on you. We already tried that with Google Glass. I think it's going to take a little while.
Yeah, and speaking of Google, you helped create the iPhone, the iPod Nest, which was bought by Google, and these products are networked now in a huge way. What is your take on both the upside and the downside of this massive amount of networking that some people say, leads to dystopian possibilities, but also tremendous upside?
Well, look, there's always unintended consequences in everything. And technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. So we have to do things that promote social bonding, like what Phil's doing with Dice, right? Not letting the ticket bots in there, not letting the scalpers in there, doing all the things necessary. And that's why I love what Phil and Dice is doing, is they're trying to bring all the best things to connect the artists to the fans, right? And getting rid of all of those middlemen who are just stealing along the way. So that's what we want to do. And so I love the network. It can have better shows. have the artists make more things for their fans so that the fans have a better and better experience. And maybe through that, we can create even more social movement to fix some more of these problems. But it's about bringing people together and not about a network of, intermediaries stealing along the way.
Or just one more Wayback Machine question.
Okay.
Okay. And that's, you worked with Steve Jobs.
Yeah.
Apple built a music business when you were there. What did you learn from Steve, and what do you think he'd be thinking about the world today and the technology that we're using?
Well, I think for me, what it was all about in the music store and the iPod, it was always about, what do the customers really want? What is going to give them that that emotional experience that they crave, that they want, and a rational part of that, making it simple and all those other things. And that's that's like Dice. So when you see something like this, you're like, wow. I think that if Steve was here today, he would go, we need to get artists more money. I think if he looked at the streaming services out there, I know how much he loved musicians, bands, and wanted to support them. I remember way back when he was looking at buying certain media companies, that kind of stuff, because he really wanted to revolutionize that. And so as far as I'm concerned, if he woke up today and saw the streaming services the way they are today and where the artists are not getting fairly paid, he would fix that. Absolutely.
I remember Tony and Phil when he came by and demoed the iPad at Time Inc. when I worked there, and he played music and he played Friend of the Devil. And I said, oh, the Grateful Dead. And he goes, I love the Grateful Dead. You can see he really meant it, right?
Yeah.
He was really passionate about that. You come from a musical background, a music industry background, I should say. But geez, what made you decide to get into ticketing?
Yeah, I mean, I wasn't tech before going into the music and not knowing anything about the music industry. So very naive, but very lucky in the music industry that, found, some artists who were getting bigger and bigger, and actually didn't care about ticketing, didn't understand it, because you spend so much time, working with the artists and making an amazing album, to make an amazing artwork, to looking at their live show, and didn't think about the ticketing until the artists started getting bigger in North America, and that was when I suddenly was like, hang on a minute, we did a deal for $40 and now the ticket's 65. Where's this 25 going? It's sold out and it's been sold for hundreds, thousands of dollars, and all the fans are angry at the artists. Like, why isn't anyone fixing this? And so then I went back into sort of old world, new world together, and just analyzed all the ticket companies and tried them all out. Didn't want to, just trying to see if there was a solution. And that was the thing. Well, if no one else is going to fix it, I guess that we have to do it. So, and kind of just touching on to the last question as well. I think that take a lot of inspiration from what Tony created. Really thinking about the small things. The experience when someone sees it. Small little animations within the app, the ticket, the imagery. You're talking about brand before, like people wear Dice t-shirts and have the bags and everything else. Like all these things are like things which we really care about, because you need to make a revolution, and all this stuff like pays off because eventually, because of all these things being put together, artists make more money in the right way.
I didn't really ask you about the business model, your P&L. How are you doing? How's the company doing? So can you dive into that a little bit quickly?
Sure. As I mentioned before, it was the, we, in the pandemic and coming out of it was like, it's a shock. I mean, we went from no one going out to everyone going out. Yeah. And, from 0 people in New York, like sort of going out to, 1 million people going out. So, we have it's over 1 million in New York in the last month, 1 million in London, 500,000 in Paris, like all these people sort of coming together. How we make money is that we charge the venues or the artists for using Dice as their partner to sell the tickets. So it's like we're very pro privacy, and so the again, just protecting the fans from this, but also everyone knows like how we make money. We make money from selling the ticket. There's no advertising, nothing else that's on there. And in terms of the volume is like it's accelerating as Tony knows, like every week right
well
now.
Let me be clear, we're happily writing checks, and we're backing these guys, and even in the darkest of times we see the light, and we see the growth, and we see the fans, and they're coming back, right? It's sticky. People love it. They're telling their friends about it. We do very little advertising. I meet a ton of people I go, yeah, I'm an investor in Dice. It's like, oh, I'm a user. Like there's so many people. If you actually ask people in the regions where we operate, there's a lot of people using it. We just don't sit there and market it. And, it's self-marketed because the fans love it. And so that's why we keep investing, because we know this is the future, and it already is here today.
Word of mouth seems to be working. So are you guys venture back, Phil, IPO in the future, perhaps?
Yeah. So yeah, we're venture back and public listing in the future for sure. Yeah.
Great. And Tony, how did you guys meet?
So interestingly enough, I had friends in London, and they said, "Oh, you have to meet Phil. You guys would get along. You love music. He's doing something really cool." And Phil and I just were at a hotel. I think it was the Ham Yard, and we had a drink, and we just started talking, and we talked all about music, and then we started talking about books, and started sharing titles, and just getting into psychology of like a fan, and what does it mean, and why do we love shows, and really just hit it off. And it was just there. I was like, okay, that's it. And Dice was tiny. It was just a vision. And so it was really about a team and a mission, and Phil as a entrepreneur and visionary.
And Phil, where do you see the company 5 years, 10 years from now? I mean, doesn't it have to become part of one of the, well, they used to call it FANGs. I guess they're MANGs now. Part of an ecosystem. Everything's got to be part of an ecosystem. Or can it be a standalone, do you think, going forward?
Yeah, I think it'd definitely be a standalone. I think that live entertainment, how people look at the TAM, the market right now, I think it's undercooked. I think that it's huge. I think that if you've got 90% of the population of the world liking music, maybe half the population loving music, and 30% of people love music so much that they pay to go see it, then that's a massive market. And I think that, what we're seeing is growing this around the world. I mean, like, for example, we're just starting off in India. That market could be as big as the US within 10 years.
Right. I love the TAM thing. That is a truly small set. People who hate music. I hate music, right? You don't have to worry about that. That's a pretty small group of people, right? It's pretty funny.
It was the same tab for the iPod. It was the same tab for the iPod.
Right. Yeah, that's about right. That's about right. Just everybody. And final couple last questions here. Phil, what do you think that you want to be your legacy?
Wow. I have to think about that one. Okay, you know what? It's the idea. One of the things I love the most, is the idea that we're in Mumbai and there's a scene happening in Mumbai and there's this new music that's happening in Mumbai, and through the connections of Dice, that artist goes straight into the US and Asia and through Europe and blows up. And we do that time and time again. That the idea of bringing culture sort of around the world, that would be awesome.
And Tony, same question over to you. You've got all these things you've accomplished working here with Dice, and I'm sure you've got all kinds of other things percolating in your brain. What do you hope to accomplish over the following years?
For me, it's really about, mentoring and investing my time with the entrepreneurs who are truly changing the world for the better, whether that's environmentally, socially, or for health. Those are the three big things, and Dice is doing that for the social experience all around the world. It's amazing, and that's what I hope Phil is able to fulfill and bring this mission, and I think he's well along the way to delivering.
Well, it'll be great to watch the company grow as we hope we emerge from COVID and live comes back and people get interested in your business. So I want to thank Phil Hutchin, founder and CEO of Dice, and Tony Fidel, board member there and entrepreneur and an executive extraordinaire. Thank you guys very much for your time.
Thank you so much, Andy.
Thanks, Andy. Great to see you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Crossing just a moment ago, the measure of the services sector in the United States coming in a little worse than estimated. The Institute for Supply Management Services Index coming in at 57.1, 58.5 was the estimate. This follows on a similar measure from S&P Global that also came out below estimates. And remember, this is still expansion. Above 50 is still expansion, but we did see prices rise. An index of prices paid by firms for materials and services jumping to a record 84.6 in April. So this could be something that could be putting pressure on things there. What's interesting about the services number is services was supposed to sort of take over for manufacturing growth, if you will. And indeed, we've seen an uptick in services, but a little bit of slowdown reflected in these numbers. We're still seeing a mixed picture for markets because most of the focus for market participants remains on the Fed this afternoon. Coming up in the next hour, we're going to break down expectations for the Fed with Lux Capital's Josh Wolf. That's on the other side of the break.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Markets are, well, we're seeing some nervous action here, mixed action, I should say, ahead of that big Fed meeting later on today. The only index in that green right now is the Dow Jones Industrial Average, and slightly, I should say. Now, here are three things you need to know. Hailing a stock crash, Lyft shares are getting smoked as the company issued a big profit warning for the second quarter as it invests in driver incentives and marketing. Lyft co-founder John Zimmer told us moments ago he and his team are looking for ways to address fresh investor concerns. And booking a good quarter, Marriott joins rival Hilton in bringing back its dividend as its business continued to recover from the pandemic in the first quarter. The company also said today it saw strong demand in April and may begin buying back stock soon. We'll talk to Marriott CEO Anthony Capuano at the top of the 11 o'clock hour, so mark it down. And gobbling up Whoppers. Burger King grills up a big quarter overseas as diners become more mobile and reach for a juicy Whopper. We'll talk with the CEO of VK Parent Company Restaurant Brands in just a few minutes. Now let's get over to Yahoo Finance's Inez Ferre over at the Wi-Fi Interactive. And Inez, it's a Whopper type of Wednesday.
It sure is, as we await for that Fed decision. So the markets may be mixed right now, but oil is going up. Take a look at WTI. It's up 3.5% right now. And this is because of the situation in the EU. The EU putting out a plan to phase out Russian oil imports. So this is sending Brent crude higher to $108 a barrel, just above that. And take a look at natural natural gas up 5%. In fact, I'm going to pull up a 1-month chart. Natural gas futures up 40, Nasdaq 100. We are watching Amazon down 3%. I'm going to pull up some of the outperformers being Starbucks, Airbnb, and AMD on the upper right left side. And also you've got Datadog, CrowdStrike, these stocks that have been under pressure over the last couple of sessions. And over on the sector action, we are watching energy stocks that are outperforming right now. Consumer discretionary down more than 1%, guys.
So consumer discretionary staying there, that is one of the most shorted as of right now.
Yeah, that's right. And that's according to the S&P Global Market Intelligence. What they came out with was a chart basically of all the sectors. Consumer discretionary in April, the most shorted sector in the markets. And what's interesting is that it's a sector which, when you look at the subsectors, the shorted stocks in that subsector, you can see there. Home furnishings, followed by computer electronics and department stores. So home furnishings, that would include Bed Bath & Beyond, that would include Williams-Sonoma. And this would make sense because if we see higher inflation, people can spend less on these products if we do roll over into a recession.
All right, that looming over us, isn't it? Thanks so much.
Yeah.
Appreciate it, Inez. Also looming over us and very connected is today's Fed meeting. Of course, the Federal Reserve expected, as we know, to raise rates by 50 basis points. Our next guest thinks that'll be it. That might be the last hike we see for a while. He called it a contrarian take, the most contrarian take in a recent tweet. Yeah, I think that's accurate. Josh Wolf is with us now, Lux Capital co-founder and managing partner. Josh, good to see you. Lay out your case here. Why would this be sort of a one and done or one and done for now from the Fed?
You know, it's interesting. The last few segments you had, you were talking about ISM is down. You were talking about oil prices are up. Consumer discretionary is down. I actually think consumer discretionary is going to continue to go down, not so much for rising prices that people can't afford it, but demand was pulled forward during COVID, and people don't need their extra Peloton. They don't need more clothes. They don't need another computer. They basically pulled forward years of demand. Consumer staples are getting crushed. And these are the poorest people in the country who are the most hurting. And they've got food and fuel prices that are rocketing. And I think we've got a time where you've got, 11.5 million open jobs. It looks like we have full employment. The Fed's double mandate of price stability and full employment means that, okay, they're going to, try to attack inflation. But I think this is mostly a supply issue. I think this is mostly an issue also of a transferred wealth effect. For the past generation, you've had this Goldilocks expectation of soft landings every time the Fed gets involved. And mostly, even though they're supposed to manage price stability and employment, they've been managing the stock market. And the reality is they transmit this wealth effect. It adds collateral to borrowing and margin accounts. Companies and CEOs and boards are buying stocks back, and they're doing it at ever record valuations. All of this distorts valuations horribly. Everyone has had this Fed put mindset for the past decade, just buy the dip. And so basically the cost of capital was too low for too long. And the lower the cost of capital in my business, we were beneficiaries of this. So I'm being really intellectually honest here that, you'd have these 20-year far out fanciful ideas that basically became these 20-month frenzied projects. And now you see this sort of excess and exaggeration and the absurdity and the frauds that are starting to come out in the tech world. And you can see this, by the way, in the TV shows, right? You look at the Uber show, Super Pumped, and the WeWork, We Crashed, and then the Theranos story in The Dropout. Those were all excess, exaggeration, and absurdity. So right now you've got the Fed basically trying to land a plane. And the risk of oversteering, where you've got passengers in the back, some of whom are suffering from these consumer staples, and they need painkillers. They need rubbing alcohol to heal their wounds. And it's sort of a mixed metaphor here, but they need low rates. And they got to make mortgage payments, and they're taking out more credit, and they got to pay for basic food and fuel. And then you've got others on the plane who are basically partying, and they want the pills and the alcohol just for continued speculating. And so you have a situation where the Fed was too slow to act when the economy was growing, and now it risks being too fast to act when the economy is slowing.
Okay, and so for a Fed that was continually leaning into transitory for quite some time to the point of detriment, and then acknowledged later on how much that actually may have hit on their perception. If they did do a one and done, as you mentioned, how much would they continue to have to be concerned about that perception of how the Fed is navigating right now?
Well, part of this is how much does the Fed care about its credibility? And some of this, we're finding out maybe Powell delayed some of the views that inflation wasn't transitory for political reasons. That aside, yes, 6 months ago in November, the Fed finally says, okay, inflation isn't transitory. It takes another 4 months from that point, just in March, to get its first quarter point hike, and then paring back the $40 billion of monthly mortgages. Now, I expect you're going to see 50 basis points today. Could you see something in June, maybe another 25 points? Maybe. But I really think that the pressure is going to be on between political pressure and just actual, even though we have lagging data, a really hit hard suffering consumer. You add on top of that quantitative tightening that's going to start in June of $90 billion a month between mortgage and other debt that they're pulling back. And so I think the market in anticipation has rightly been guided and has already taken rates up. We now got the 10-year at 3, even though we've got a flat curve across the board. The 2, 5, and 10-year are all approaching that. So the big question is, does the Fed keep going and then tip us further into recession? And I think they got a lot of criticism and will get a lot of criticism for not acting soon enough. And I think the new criticism will be that they acted too fast and too hard when all the signs are that we're about to hit a really hard recession.
Josh, as you mentioned, you're in the VC world. You got a lot of folks on the other side of this trade, as you well know, right? As you called it, it's a contrarian take. And most folks are very much in the other direction, that we're going to see multiple 50 basis point increases this year. Some folks even calling for a 75 basis point rise, at least one of them. If the Fed does what you're suggesting, you would then presumably get a tightening of financial conditions, which could then exacerbate some of the issues that you're talking about. So I wonder if the Fed is really going to weigh the risks in the direction that you're talking about.
Look, nobody has a perfect crystal ball. We'll know today at 2:00. We'll know again in June. My view is the conditions for tightening are already happening. You've got bond and stock market investors that are dumping, right? And so you're seeing a correlation between fixed income and equity, not usually correlated, just decline. People are basically saying this is not a time to be greedy and lean in and speculate and try to make money. You're going to have a whole camp of people that are basically like, now is a time to not lose money. So if we went from FOMO, fear of missing out, and then I coined this term SOBs, shame of being suckered. You didn't want to do something really stupid. I think you've got pull now, which is going to be either the pleasure or the pride of losing less.
SOBs, I like that. I will be using that somewhere at some point this week. Josh Wolf, co-founder and managing partner of Lux Capital. Always good to see you. All right, before we head to break, let's fire up a stock chart of Tinder owner Match. There is no love being shown to the stock as the company surprised Wall Street by announcing a new CEO. Current Match CEO Shar Dubey will hand off the baton to now former Zynga executive Bernard Kim. Perhaps the transition shouldn't be a total shocker. Match shares have plunged 47% over the past year. The company also said first quarter revenue at Tinder only rose 18%, slowing from a 23% growth rate in the fourth quarter. Coming up, trouble for Whole Foods. Julie's back with a look at this one and a few other headlines you need to know. We'll be right back.
A reach for the stars. Roku and private equity firm Apollo Global Management are teaming up in a joint bid for a minority stake in Stars. That's according to people familiar with the situation. In November, Lionsgate announced it was looking to spin off or sell Stars after acquiring it for $4.4 billion in 2016. We'll have to keep an eye on further developments on the matter. Apollo Global Management is, of course, Yahoo Finance's parent company. And Whole Foods is scaling back. Amazon-owned Whole Foods will close 6 stores across the United States, 5 slated to close by May 6th. The remaining store set to close in the coming months. This move comes after Amazon reported its first quarterly loss in 7 years. Whole Foods did not specifically indicate the reasons for these closings, other than that this decision comes after the company's regular performance and growth potential evaluations. And in Ohio, the competition heating up for the state's open Senate seat. Trump-backed candidate J.D. Vance defeated 6 other candidates to win the Republican nomination for U.S. Senate in Ohio, though Trump's endorsements will be tested as this is only the first election in a string of primaries to take place across the U.S. in the coming months. Vance will now compete against incumbent Democratic Congressman Tim Ryan in the fall.
Switching gears, Elon Musk agreed to buy social media platform Twitter last month for a total of $44 billion, with the stated intent of taking it private. But now he says he wants to make it public again, just a few years after the acquisition goes through. Joining us with more on this is Yahoo Finance's Dan Howley. The ever-changing kind of nature of this acquisition, perhaps, Dan, what more do we know about?
Yeah, I mean, it really is strange just because this is something that he said he wanted to go against, more or less, because he wanted to be able to have less oversight, you would think, of the company than it has right now. And so what they were originally planning to do was go private, and then Elon Musk was going to do things, I guess. He's not even really clear on what he wants to do. I've mentioned this before, but prior to the full acquisition announcement, he had a TED Talk where he basically said, we're going to add an edit button. Okay, so that was worth $44 billion, I guess. So, I mean, now they're obviously going to go through with, all the pending approvals and have the company on his own. And I guess we'll just have to see what he does and then what that'll bring when it goes back into being a public company again. So, I mean, look, this is a social network that its growth has never been amazing. Its revenue has never been amazing. Everybody has always talked about how it's not properly monetized. But how are you going to monetize it? These discuss things like, okay, maybe we'll charge people. Maybe we'll charge people for embedding tweets, which just doesn't make sense because you can quote a tweet. So it doesn't seem like he really understands what he wants to do here yet.
It's not unusual for a company that goes private to come public again, but still, you never know with him. Speaking of Twitter and other social media, you getting off it. Getting off Twitter. Are you getting off Twitter? Does that include Twitter?
I can't. So I've had it with social media, right? I'm writing a column this week where I'm basically just leaving what I can. I'll have you know that I've downloaded and deleted TikTok sometimes just like scrolling through social media that I probably shouldn't be doing that. So I've decided to take some limits here. What I'm doing is I've used the limiter that's in iOS to limit my Instagram usage to 20 minutes a day, which, by the way, is not a lot of time when you spend that much time on social media. I've never used Facebook because, let's face it, I'm not, 80, because that's basically, I guess, the age for Facebook. And I don't want to use Twitter anymore during my spare time. And I talked to a couple of psychologists about this for my piece, basically going over, how these habits kind of evolve and how they aren't necessarily always bad when it comes to social media, because there are good sides to social media. People can meet people that they haven't seen in years, join up with new causes, find out interesting things in their lives. But for people like me, I think it was just a total time suck, and I could have been spending that time doing other things. So I'm going to try doing this. I have the limiter on Instagram right now. It popped up yesterday, and I swear I instinctively swipe up to unlock my phone and move over 4 pages to Instagram and go to press it. And now it's locked, and I don't know what to do with myself.
Dan, how confident are you that you can maintain this? You've already brought back TikTok numerous times.
I know. I'm trying. Twitter is just, it's a hellscape. So I never really want to be on it, but I have to be on it for work. I have to look for, breaking news and things like that. So I'm not going to use that in my spare time. I feel like that's just, unless I really want to be depressed about something, then I'll either, watch, a period drama, or go on Twitter. But I do think that the Instagram thing is going to be a bigger issue. But it kind of speaks to, I guess, my addictive personality, but also how these companies build their products. Right. And that this is the point of them, is to keep you using them and keep you stuck on them so you're engaging more, and then they can sell more ads against it. I'm saying no. I refuse to be a part of that system.
Well, the platforms have been built like casinos. There's such an eliciting of a psychological response and a behavioral response that they want you to keep coming back to. I mean, are we going to see a future ever where social media companies are being more forward about how they actually want to make sure that they're maintaining the mental health of their end users?
Well, I mean, right, that's exactly what legislators in Congress are looking at as far as Instagram goes specifically, because they had spoken about the impact that it has on young girls as far as body image goes. Frances Haugen, the whistleblower, had brought up how the platforms are designed this way, trying to get people to stay hooked as much as possible. And they do that by driving engagement through, negative interactions with people, the kind of stuff that really gets you going. For me, that's not why I'm on social media. I literally send my wife pictures of golden retrievers in a bathtub with ducks, little baby ducklings. It's the greatest thing in the world. Or baby cows and stuff from like this farm that I follow.
No, it's not. It's the worst.
It's the worst. It's the worst. It's the worst.
You gotta get off there.
And that's why I'm cutting down to 20 minutes a day. I feel like this is what smokers must have gone through. I feel like.
Dan, I have bad news for you because it sounds like you're going to miss my cow video later, overlaid with the latest rolling Limp Bizkit
Oh my
song.
God.
So I feel sorry for you, but look out for that post nonetheless. Hope you don't get hit by the limiter. Dan Halley, thanks so much, baby. Straight ahead, Whoppers and Timbits for the win over at Restaurant Brands in the first quarter. Restaurant Brands CEO Jose Sill stops by for your chat next. Burger King sales are still lukewarm in the U.S., but the brand is delivering Whopper-sized gains overseas. As
Finance, we have some breaking news here. Just momentarily, we are awaiting the Fed's big decision on interest rates. Now, the central bank is widely expected to raise rates by 50 basis points. Taking a look at where stocks stand here ahead of that decision, you're looking at the Dow, S&P, and Nasdaq all moving to the upside. Dow, S&P both up just around 0.5%, and the Nasdaq up 47 points. Rochelle?
And as we know, of course, the Fed is preparing to pare back its $9 trillion balance sheet. So let's take a look at what's happening with the bond market. We did see the 10-year jumping 5 basis points this morning before paring back slightly. Still up, though, about 3% there. As we look at the 5-year, up over 3% there. The 10-year, as I said there, around 3%. The 30-year also up 3%. A lot of people looking for safe havens here. Traditionally bonds, but not necessarily the case right now. Dave?
All right, to commodities and taking a look at oil prices jumping near $110 a barrel. And some news, Treasury Secretary Janet Yellen chiming in today, telling the Wall Street Journal, quote, "I am worried about spillovers from Russia and Ukraine that can have adverse impacts not just on the U.S., but on Europe and emerging markets." The European Union's top official called on the 27-nation bloc to ban imports from Russia, phasing out crude imports within 6 months, and refined products by end of year, certain to have an impact on global oil markets.
All right, let's take a look at where things stand here, because we are just about 25 seconds until we do get that decision. Dow up 120 points. Taking a look at some of the Dow leaders right now, we have Walgreens in the green, up nearly 2%, Apple a leader, 3M, IBM, and Honeywell, the top 5 performers so far this afternoon. Rochelle?
And also, before we get to Brian Chung, who was in the room there for this federal rate decision, we also have Bitcoin moving higher today. But as we mentioned there, the Fed decision is out. So let's take it over now to Yahoo Finance's Brian Chung for the latest. Brian.
Well, the Federal Reserve has officially raised interest rates by 0.5%. That largely expected, but the Fed also unveiling details on how it's going to go about its Fed balance sheet roll-off program. The Fed saying that it's going to allow up to $95 billion a month in assets to roll off of its balance sheet by September. That's going to be phased in. The caps are actually going to be about $47.5 billion from the months of June through August. Now, I want to read you some bits from the Fed press release. Again, the expectations were for the Fed to raise by a half point in this meeting, but the Fed adding a number of risks that it's attentive to as it starts to raise interest rates. The first, obviously, the Russian invasion of Ukraine. The Federal Reserve continuing to describe that situation as possibly adding, quote, additional upward pressure on inflation. But the Fed adding a bit in the statement compared to their last statement in March by noting that China is now likely to exacerbate supply chain disruptions. Obviously, that because of the COVID-related shutdowns with the zero COVID policy in the world's second largest economy. The Fed also adding a sentence noting that, quote, the committee is highly attentive to inflation risks. Now, as far as the economic assessment, the Federal Reserve noting that overall economic activity edged down in the first quarter. That validated by the negative GDP print for the first quarter that came in last week. You'll recall that was a surprise. But the Fed saying that household spending and business fixed investment remains strong. So all of this kind of underscoring how the Fed still fixated on inflation. But again, the big news today, Fed raising by half a percentage point today, and the balance sheet roll off to begin on June 1st, guys.
Yeah, and Brian, the big question here is what you were just saying when it comes to inflation, exactly what Fed Chair Jay Powell is going to be seeing. We know that he will probably, of course, field some questions on that. But from the conversations that you're having down there, from what you have been following, I guess, what is largely expected in terms of how rapidly we could potentially see inflation de-escalate, I guess, a bit?
Yeah, Sean, I mean, that remains the big question. Everyone obsessed with the details on Fed policy, but we have to remember what is the ultimate goal of all of this, which is to try to tamp down inflation. We are seeing prices increase at a yearly rate that we haven't seen since the early 1980s. Now, of course, the Federal Reserve would like to see that number go down, but there's a number of factors at play here. First of all, there's a lag impact of monetary policy. We only got our first interest rate hike from the central bank in March. Now, the Federal Reserve having this more aggressive move. Again, we haven't seen the Fed move by increments larger, at least in the upwards direction of 25 basis points since May of 2000. That might not bleed through to inflationary pressures until perhaps later in this year or maybe even the beginning of next year. Now, the Fed is hoping that there are a number of supply chain issues that will alleviate, which could give them a little bit of help in bringing inflation down, namely, for example, any sort of positive developments that could come from Russia and Ukraine if there were to be some sort of de-escalation of issues there. We know that Ukraine is the breadbasket of the world, and then also China, if it is indeed the case that the COVID shutdowns there are also part of the inflationary pressure story. If there is an alleviation of that pressure, maybe that also bleeds through. Now, when it comes to a number, we might expect to see Jay Powell in the press conference again in about 27 minutes add some color, but we have to remember that we're not going to get a set of actual projections from the Fed and saying, here's where we project inflation, at least on PCE, to go until the Fed's next meeting. That's going to be in June, so we'll have to wait until then, guys.
All right, Brian Chung, we'll check back with you after we hear from the Fed chair. Thank you, my friend. For more on the Fed, let's bring in our panel, RJ Gallo, Federated Hermes Senior Portfolio Manager, and Sarah House, Wells Fargo Senior Economist. RJ, we'll start with you. We already knew the sex of the baby, so it wasn't as exciting as the other way around, but anything surprised you there? What's your takeaway?
I think that the Fed telegraphed so much that they were perfectly boring so far. I'd say the key thing that seems to be jumping out to me is the highly attentive to inflation risks comment. That's clearly a hawkish tone coming out of the FOMC. Coming into this meeting, I felt the biggest surprises would probably occur at the podium, and the press conference doesn't start till 2:30. So they pretty much delivered as promised, 50 basis points, going to shrink the balance sheet. But highly attentive suggests to me that there's a lot of talons on these hawks to come. We'll see what he has to say at 2:30.
So then I want to bring you in here as well, Sarah. I mean, so we have this 50 basis point hike here. As we were saying, markets clearly expecting this. How, though, do you shape this with some of the fundamentals that we're seeing with the economy? Can it really withstand a recession?
Well, I think it can certainly withstand 50 basis point hike today, as well as probably multiple 50 basis point hikes. So we see the labor market is tightening without abandon. So we think that we'll see another decline in the unemployment rate here on Friday with the jobs report. And the unemployment rate's going to sink even lower than what the Fed expects while inflation remains higher. And I think it does speak to the underlying strength of household balance sheets right now. The fact that not only are those balance sheets strong, but a lot of workers are going back to work and getting a paycheck. And so I think given the inflation atmosphere and just the underlying tightness of the labor market, that the economy can withstand 50 basis point hikes here in the near term. But I think the end of the year is going to be a bigger question with how far the Fed pushes above neutral.
RJ, let's talk a little bit more about inflation. From your perspective, do you think we've seen peak inflation? I guess how rapidly do you see CPI potentially decelerating?
I think there's a good chance that we might have already reached the peak, or if we haven't, we soon will. There's a bit of a perfect storm in terms of building this inflation, the recovery from the pandemic, the extensive supply chain disruptions that occurred pretty much worldwide, massive monetary stimulus, fiscal stimulus coming out of the depths of the pandemic contraction. It all added up to quite a surge in inflation, as we have all experienced, certainly as we go about our daily lives. The bond market is priced with strong expectations that inflation will soon decelerate. Our view is directionally we agree. It's not clear to us here at Federated Hermes that we will see the inflation taper off fast enough to justify some who think the Fed's only going to get into the 2%, high 2% range with the Fed funds rate. For quite a while now, we were arguing here that the Fed has to go above neutral. The Fed is biased to be as hawkish as possible as these policymakers are facing the highest inflation in over 40 years. Some might suggest this is not what they signed up for when they joined the Fed. They're looking at inflation that nobody in in a generation or so has seen. So hawkish is where they're going to go. I just don't know that inflation will come down quickly enough for some in the bond market. We think that on net, the Fed terminal rate will be well into the 3% area. And with that, yields probably have a little bit more room to rise before we start feeling more optimistic about taking more duration risk in our bond portfolios.
Sarah, the same to you. Do you believe inflation has peaked, and how quickly do you think it will begin to taper off?
Yeah, so I think on a year-over-year basis, we've likely seen the peak. So, of course, we can get some surprises and quick moves and things like oil. I think the China lockdowns pose another risk in terms of getting some relief from goods inflation. But I think in some ways, whether it's peak or not, obfuscates or just kind of takes away from the fact that inflation is going to remain elevated for some time yet. So we think that The CPI headline is still going to be roughly 6.5% for the fourth quarter of this year. And even on an annualized basis, we're still looking at somewhere a little over 4%. And so this is still well above the Fed's target. And that's going to keep the pressure on for them to continue to tighten policy and push policy into a restrictive territory.
And RJ, speaking of China, obviously that came up in the notes. We're not exactly sure how long these lockdowns in China are going to be for, and therefore don't know how long it's going to impact the supply chain. What else are you looking at that's beyond the Fed's control that you think could really help or hurt inflation the most?
Well, the tragedy of the Russian invasion of Ukraine and the profound implications really for European security, and then the near-term impact on commodities prices are yet another one of the winds of the perfect storm that helped to inflame the inflation problem that we're facing. That war, not so long ago, there was some hope that there might be credible ceasefire talks, and that hope has been completely dashed. It appears that Putin, who clearly is directing this war, is committed to keep fighting. The Ukrainians are committed to keep defending themselves. And that creates further inflationary problems, at least in the very near term. I think that the markets are focused primarily on the commodity impact of the Ukrainian war. But I do think longer term, there's profound implications in terms of how the West, how much the West has to spend on its security. But in the very near term, I think the war is probably another pro-inflationary factor to consider out there. And it's one that's more likely than not going to persist for quite some time.
And Sarah, going off of that, I guess how big of a headwind, how big of a challenge do you see this being to U.S.'s economic growth here, at least in the short term?
So I think we're already beginning to see it in terms of real household income. So I mentioned balance sheets are starting off in a very strong position, but given the inflation that we're seeing, the fact that we no longer have the fiscal support that we did for the first year and a half of the pandemic, is we're getting to a more precarious position for consumers. So in some ways, the consumer position, it's only going to get weaker from here. And so I think that does bring some headwinds to growth, and is why we do expect growth to slow over the remainder of this year and on into 2023 is there is that inflationary risk where, households income just does not stretch as far, and that's going to weigh on your overall demand. And in many cases, the global backdrop is even weaker. And so that's going to create a problem for businesses and exports as well.
You talked about being perfectly boring, RJ. What do you want to hear from the Fed chair in just about 20 minutes?
The first thing I think we want to hear is they have strong conviction to continue fighting inflation. As bond investors, we've been investing now for well over a decade in a disinflationary world, driving real and nominal yields to very low levels. After the pandemic hit, the Fed drove rates to zero, massively expanded their balance sheet, pretty much set the tone for what we're experiencing today. We knew that inflation would become somewhat of a challenge. I think the Fed also did as well. It's proven to be much higher than the Fed forecasted or just about anybody else. So at this point, as a bond investor, with the Bloomberg Aggregate Index, conventionally used index of investment grade fixed income securities down almost 10% on a year-to-date basis, we've sustained our lumps. The bond market is pricing in a hawkish Fed for good reason. The highest inflation in decades needs to be resisted by the policymakers. So we want to hear Powell have that conviction yet again when he goes to the podium. To be honest, I think he and his colleagues on the FOMC have displayed that conviction pretty consistently. There don't seem to be any doves left. So the big surprise would be if Powell gets up to the podium and is in fact somehow dovish in tone. I think it's highly unlikely, but that would be the big surprise. And that would probably cause some consternation, might cause the yield curve to steepen. If people start to worry that the Fed is losing its conviction on its inflation fighting, then the yield curve might start to steepen out. Instead, the yield curve has been flattening now for quite some time in expectation of the policy moves that we saw today, more of which will come in future FOMC meetings, and the idea that the Fed is very, very convinced that there's only one way to fight this, and that's to keep raising rates. So the yield curve has been flattening. So a surprise would be if he got dovish, and that would probably steepen out the yield curve.
Right, RJ and Sarah, stick with us here because we want to get a quick check on the markets and see how the major averages are responding. We just had the NASDAQ briefly in negative territory. You can see it right around the flat line now. Jared Blickery is standing by for a closer look. Jared?
That's right. And let's check out some of the charts on the Wi-Fi Interactive, where we can see a little bit of fireworks here. Usually, as we've been discussing, those are kind of saved for the Powell presser. Very much an as-expected report, a couple of twists and turns, but nothing major. You can see just a tiny little spike up. That's the Dow on the news, holding gains of about 161 points. S&P 500, slightly less here, up about 1/3%. And the NASDAQ just barely trying to climb into the green, as you were noting, Shauna. And let's take a look at the bond market here. This is going to be 10-year Treasury note futures, so they move in opposite direction of the yields. You can see got a little bit of a spike up here, but pretty muted reaction overall. So let's go over some of the other markets. We did see a little bit of a surge in WTI crude. Energy stocks, by the way, holding up nicely, getting a little bit of a bump off this. Gold getting a little punch to the upside as well. It's been depressed over the last few weeks. And copper, not really a whole lot of movement there. I guess I'd be remiss if I didn't check out Bitcoin as well. A little bit of a bump there. Has been positively correlated with equities as of late. Now, let's check out the sector action. As I said, energy posting on some earlier gains. It's up nearly 2% right there at session highs, followed by utilities and staples. So that's an interesting defensive setup. But materials doing well, as it looks like inflation concerns are abating, at least in terms of what the Fed is going to react. So are we at peak hawkishness right now with respect to the Fed? I think that's what the markets are asking themselves, and it's really going to take the Powell presser for the market to make up its mind. Finally, here's the NASDAQ 100, kind of a mixed board. We got Amazon, that's down 2%, Apple up 1%, chip stocks doing nicely, AMD up 3%, guys.
All right, thank you for that breakdown. Yahoo Finance's own Jared Blickery there. Well, we're going to get more insight now from someone who knows all too well about the inside workings of the Federal Reserve. Our next guest, Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Thank you for joining us. So now we do have the basic here. We know that we're going to see this 0.5 percentage point interest rate hike. This is something that you said in your notes that you were expecting. But as we anticipate perhaps further rate hikes, some people are even saying 75 basis points. Is that something we can expect then, given the late start that the Fed had to this?
Well, it really helps to start with the big picture here. So inflation's running at 8%. Consumers actually, according to the New York Fed survey, are expecting inflation over the next 12 months to be around 8 to 9%. So they're not seeing any relief in sight. The latest wage data that we got from the quarterly survey of employment compensation for private workers is up around 6.5% at an annual rate. So that means workers are trying to get cost of living increases just to catch up to the inflation. And that wage price dynamic is ongoing. What economists think about is the difference between interest rate and inflation. And right now, that difference is very, very negative. Think about it, like a positive 8% inflation rate. And now the Fed's just starting to raise interest rates up to +1. That's a huge gap. Where we think the neutral level of monetary policy is when they raise the interest rate up to be roughly consistent with inflation. So in that perspective, the Fed has a long way to go. So probably 50s, maybe some 75s. We could see a 1% rate hike this year. If inflation keeps running at 8 or 9%, or even heading up toward 10, I think the bond markets are going to realize the Fed has a long way to go.
Well, so Andrew, going off of that, because we've heard some criticism directed at the Fed, Jamie Dimon, CEO of JP Morgan, was the latest one, or one of the latest people to really say that the Fed should have simply raised rates sooner. In your view, do you think the Fed is behind the curve?
Yes, they're behind the curve, but there's no point in criticizing the past at this stage. Okay, the question is how to move forward. And I think I was personally disappointed today that the changes in the actual statement that they issued at 2 o'clock weren't very clear. Okay, what we need to hear from Chair Powell in a few minutes is a strategy. Now, he could say clearly that their strategy is to bring the level of interest rates up to be roughly in line with the level of inflation. Okay, and if we're lucky, inflation could come down from 8% to 5% by the end of this year, maybe even below 5%, but that would probably be good luck. All the factors the Fed itself said today that the supply chain disruptions are probably getting worse. We know about Russia and Ukraine, that's probably making things worse in terms of commodity prices and energy, okay? We know that workers are trying to catch up with cost of living increases. We know that rent prices are skyrocketing. All these things are putting upward pressure on inflation. So the Fed needs a strategy. The strategy should start with saying we're going to move to neutral, and neutral means an interest rate that's roughly similar to the level of inflation, and they're going to move as quickly as they need to get to neutral roughly by the end of this year or early next year.
You threw out the word luck, and the word luck is often tossed about in order to avoid a recession. And Janet Yellen today said the Fed will need to be skillful and also lucky, but I believe it's a combination that is possible. That's not exactly Reagan-esque optimism about our economy. What do you make of that statement, and do you think we can avoid a recession?
I don't think there's any need for the Federal Reserve to create a recession or even to create a risk of a recession at this point. Okay, of course a recession could happen due to some other terrible factors. Okay, but moving to neutral is not a contractionary stance. It's not a restrictive stance of monetary policy. That's a stance that would just help stabilize inflation, keep it from going up any further. Okay, so right now monetary policy is still adding fuel to the inflationary inferno. It's still adding fuel, okay? The point about bringing the interest rate up to be roughly consistent with inflation is that's the point at which they're no longer adding fuel to make the inferno worse. Then they're going to have to figure out how do they start bringing inflation back down, but that could be a more gradual process. The recession could happen if the Fed is lurching, if people are confused what the Fed's plans are, if workers are discussing with their employer about wage increases and no one really has an idea what the Fed's planning to do about all this, that could exacerbate the risk of recession. And on the other hand, if the Fed is really clear about its plans and its strategy, that will help reassure people and we can avoid a recession.
Well, hopefully, Mr. Powell follows your advice. Thank you, Andrew Levin, former Federal Reserve Board Special Advisor. Appreciate your insights here. Let's bring in Seema Shah, Chief Strategist, Principal Global Investors. Nice to see you, Seema. Your reaction to the news from the Fed.
Thanks for having me on. Yeah, it's exactly what was expected. We needed the Fed to make a move, make an aggressive move, and I think they've delivered here. But keep in mind that the inflation risk since the last meeting 7 weeks ago, it's only increased. You've got inflation expectations moving higher. You've got inflation at 8.5%, wage growth up. So it's clear that this isn't going to be enough. And I think all eyes now during the press conference is going to be any kind of guidance that Powell is able to provide about what to expect over the coming meetings. Are we going to see another 50 basis point move? Is it going to be even 75 basis points? So that's going to be the key point going forward.
And Seema, you mentioned wages. Obviously, you have workers seeing higher wages to then try and pay for some of these higher prices. Then you have companies trying to then pay them more, which is then perhaps seeing some of these costs get passed back onto the consumers. How do we get out of this cycle? What is your outlook in terms of what we see with wages and prices?
Right, and the wage price spiral, that has to be the Fed's greatest fear, because once that takes off, it's very, very difficult to contain. I don't think we're there yet, and I think we have got some hopeful signs in the future that this shouldn't become even greater problem. And the reason is that although we've seen excess savings rise for most workers, for most households, actually for the lower wage households, their excess savings have really been cut down by time and inflation over the last 2 years. So actually, they are now under pressure to return to work. So we are expecting labour participation to increase over the coming months. And that should mean that the wage pressure should be a little bit more subdued over the coming weeks. But that is the key point going forward.
Seema, you mentioned just a few moments ago that what the Fed is doing today, the raising rates by 50 basis points, that's not going to be enough. They might have to hike further here, make bigger hikes, I guess, up to 75 basis points. What else do you think the Fed needs to do in order to get the economy back on track?
It's going to be very difficult. So the 50 basis point move today, potentially another 2 or 3 of that size going forward. And then, of course, rate hikes at every single meeting for the next couple of months going into next year as well. Is that going to be enough? They've got a very, very difficult job ahead of them. And from my perspective, the only remedy to such high inflation is unfortunately going to be recession.
If the Fed chair indicates a looming 75-point hike, how would the markets react?
The market is not going to react well to that. The equity market, I think, would be very concerned about the fact that Powell is moving in that direction. But then at the same time, the better thing is for the Fed to try and over-deliver now so that we don't get the risk of inflation really persisting and then having to slam on the brakes and push rates even higher. But certainly the near-term market reaction would clearly be a negative one.
And obviously, we've seen Powell and the Fed really focusing on what we're seeing with employment and really getting inflation down with less of an eye on the equity market. So what then actually poses a bigger risk then, being too aggressive or not aggressive enough?
Well, I think we're talking about the long game here. If they're not aggressive enough, then they run the risk of permitting inflation to keep festering. We'd be looking at, at the moment, we're expecting inflation to come down to only around 5% by the end of this year. And that's keeping in mind that we are expecting back-to-back hikes through this year. If they don't deliver, then you expect inflation to actually settle at a considerably higher level than 5%. And at that point, then come 2023, then you're looking at even more aggressive tightening. So actually, it's better for the Fed to get on with it now, to slam on the brakes today, that they don't need to do even more next year.
Simon, when you take a look at the market reaction today, we haven't really been seeing big swings. The Dow, S&P, both holding on to gains, I guess slightly lower than where we were at the start of the hour. When we started up at the top at 2 o'clock, we had the S&P and Dow both up just around 0.5%. The Nasdaq, though, is now negative. The big question is how much of this has already been priced in? Did nothing here today surprise the market?
No, I think this was absolutely priced in. It was a 100% chance from the market perspective that there would be a 50 basis point hike. A 75 basis point move would have shocked, and a 25 basis point definitely would have shocked. So I don't think there's anything here. It's really about watching the press conference, and I think that's where you could see some equity market reaction depending on what Powell's comments are.
All right, Seema Shah, always great to have you, Chief Strategist with Principal Global Investors. Thanks so much for taking the time. We want to bring back in our panel from the top of the hour. We have RJ Gallo, a Federated Hermes Senior Portfolio Manager, and Sarah House, Wells Fargo Senior Economist, as we wait for Fed Chair Jay Powell to begin his remarks. Sarah, first to you, what questions would you have for Powell this afternoon?
So I want to know more about their tolerance for growth slowdown or potential recession and inflation. So do they need to get back to 2%, no matter whatever it takes? Or if we see the economy slipping into recession, at that point, are they maybe willing to ease up on the pace of tightening and perhaps let inflation run somewhat over 2%? And if so, roughly rate, if that means mitigating the outright contraction in the economy. So just trying to get a better sense of that trade-off between inflation and growth, given just how tricky of a situation the Fed finds itself in.
So just in case our Brian Chung is taking notes, RJ, what would you like to ask the Fed chair?
I'd be focused on the balance sheet plan myself. In particular, a number of years ago, I worked at the Federal Reserve Bank of New York. The system open market account was less than $1 trillion, and it was basically all treasuries. The world has changed massively since then, and there has been some talk that some on the committee would like to get back to an all-treasury portfolio. I think some greater clarity on that is going to be required by the markets over time, and I would like to understand what the chair thinks about the composition of the portfolio. If they do want to go back to an all-treasury portfolio, that's a profound development for the mortgage market. They haven't unveiled that yet, and I think we need to keep putting pressure on them to offer as much insight as they can going forward on that issue.
So, Sarah, do we have an idea of where we are in terms of the economic recovery narrative based on the most recent data, as well as the moves that the Fed is making?
So, in terms of the recovery, obviously we've seen output has more than recovered. The labor market, we haven't seen jobs recover, but essentially in terms of overall tightness, we're back to where we were. So I think in many ways we've seen this recovery surprise time and time again. And I think overall we're looking at such a strong economic backdrop that's why we do have the Fed embarking on this fastest tightening cycle we've seen since the mid-1990s.
RJ, right now we do have a hawkish Fed, but there is this risk, though, that inflation could potentially be stickier than what maybe we initially are thinking it could be at this point. How are you positioned, or how should investors be positioned right now?
Well, on the fixed income side, across our actively managed portfolios, and we are an active manager, we don't run passive strategies currently at Federated Hermes. We've been materially short duration for quite some time. Go back, a year, 9 months ago, transitory was a pretty hot word. It proved to be a false word. Inflation proved to not be transitory. In fact, to be quite persistent and quite a bit higher than many anticipated. We felt that the inflation problem was going to be more problematic than the market. So being short duration has worked. We think most of the pain in the terms of the rapid bond market sell-off that has characterized the last 5 months or so, most of the pain is probably behind us. At this point, the market is expecting a terminal Fed funds rate around 3.4%, give or take. We think that's a reasonable expectation. It wasn't that long ago. That number was still in the twos. So the bond market has incorporated a lot more tightening than the Fed has already done. And that's because these days, the Federal Open Market Committee, it's almost sort of like the Federal Open Mouth Committee. They communicate through projections, through speeches, through very detailed minutes, what their expectations are. And the market has repriced to those expectations given the extremely high inflation. They give a lot of credibility to the idea that the Fed indeed will be hawkish. So a lot has been priced into the market to take the expected Fed funds rate well north of 3%. So I would argue going forward, bonds are still a little tough for investors, and I expect some further upward drift in yields. But we're not as aggressively short as we once were. For a while, we've been favoring floating rate notes and tips. We've turned those preferences down in our portfolios, adding more fixed rate treasuries. It's probably time to get a little bit more incrementally positive on fixed income returns from here after they've gotten bludgeoned, really, to be frank, on a year-to-date basis.
RJ, I remember as a kid watching, you probably don't remember Pee Wee Herman's Playhouse, where they always had a word of the day. Transitory was that for months. Yeah. And now it seems to be wage price spiral. That's something that Sarah talked about earlier. RJ, are we in the midst of a wage price spiral at the moment?
I think we're at the beginning of one. And the Fed is going to work hard.
RJ, apologies here for jumping in. I don't mean to interrupt you, but Fed Chair Jay Powell is starting off his conference down in D.C. Let's head to it live.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Chamaros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration, really, of how tight the labor market really is, the fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. But I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month should we, or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate? Or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point, was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand there. More than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and I mean that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. Two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance, and that depends not only on the level of those things. It depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1 to 1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job to given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that, stick in our lane.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is we have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Mike
McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that, so in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions, really amplifies our policy. It's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and so that shows that the markets think that our forward guidance is credible. And I think that's, we want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Greg, Rob.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, steady, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on. And it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see, unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right. And by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Fed Chair Jay Powell wrapping up his press conference where the Fed raised rates by 50 basis points, the largest hike that we have seen in 22 years, also outlining its plan to begin shrinking its balance sheet. Now, taking a look at the market, we've got a rally on our hands. The Dow, S&P, and Nasdaq all firmly in positive territory. Look at that. Dow, S&P both up well over 2%, as well as the Nasdaq. Now, this boost here in the market coming after Fed Chair Jay Powell really ruled out a larger rate hikes, at least for now. He said that a hike of 75 basis point, quote, is not something that the committee is considering, at least at this time. And Dave, the market's breathing a sigh of relief here. All 11 of the S&P sectors moving to the upside. We're seeing leadership from energy, technology, and communication services.
Yeah, that was clearly the lead and the big takeaway from the 47-minute speech from the Fed chair. And boy, did the markets like it. Let's talk about it all with Michael Cox. He is the former chief economist for the Federal Reserve Bank of Dallas, and Ed Al-Husseini, who is the Columbia Threadneedle Investments senior interest rate and currency analyst. We'll get rid of my sheets of notes. And Michael, just give you a blank slate. Your big takeaway from the Fed chair's speech and Q&A session.
Well, I really did not like most of what I heard today, because I heard Chairman Powell pointing the finger at other causes of inflation, supply chain problems, oil and gas problems, labor shortages, and so on. And I am totally with Milton Friedman, who I think is smarter than the whole room put together there, who said inflation is always and everywhere a monetary phenomenon, the result of too much money chasing too few goods. Look, the Fed has increased the M2 money supply 43% since February of 2020. That's since the COVID began. 43% more money put into the economy is going to cause inflation. And you don't need to look elsewhere for some beyond that, beyond the Fed, for some reason why we have so much inflation. Inflation hit 16% on an annually adjusted basis in March, and it just keeps rising and rising and rising. Certainly, it's good that the Fed finally raised rates today, and that to me is the reason that the market is up. The market is finally saying thank you for stopping some of this hesitation. It's good the Fed raised rates today, but there's been too much hesitation, too much waiting, too little courage, too much talk and not enough action, too much admiration of Volcker and not enough emulation of him. Volcker said the Fed has to keep this, Powell said the Fed has to keep this from causing inflation expectations to build. Well, guess what? They're already building. Look at the mortgage rates, which are 6.75%. We already have this inflation expectations building into the economy, hurting markets. And finally, the Fed raises rates, which should have started to happen over a year ago. And the market says, thank you. It's about time you did your job.
Now, it's interesting, though, because we're seeing this rally today, but then just last week we saw the markets very volatile, dipping into the red, even though they did build in this 50 basis point hike. So, Ed, what's your reaction to what you heard today and how the markets reacted? I think Ed may be muted there. Ed, if you can hear me, you're muted there. Until then, Michael, I'm gonna have you respond then in terms of what you expected in terms of a 50 basis point rate hike and how aggressive the Fed might have to be for the rest of the year to try and catch up.
Well, let me go back and answer. What I would have answered to your question is that it's hard to say that the market really expected this to happen, because the Fed many times in the past said they were thinking about raising rates, but when the time came, they didn't. And they played the boy that cried wolf. So until the Fed actually did what they said they were going to do, which finally happened today, the market, really couldn't have that kind of rally that they finally had today. So I believe today was finally vindication that the Fed will, for once and all, do what they said they're going to do. And I think it's a very positive sign, and I hope that they continue. But I would really like to see some Volcker emulation and not just Volcker admiration.
And we're just going to take a quick break here and bring in Brian Chung, who was in the room there at the Federal Reserve during that press conference. Brian, biggest takeaways?
Hi, Rochelle. Yeah, no, a very busy press conference that just unfolded. One of these situations where the statement didn't really yield all that much. That was surprising, but the press conference is where we heard the commentary. The Fed chairman saying that the Federal Reserve will make appropriate monetary policy in this uncertain environment. And we know that the policy statement added China as a risk to the economic outlook. That is because of the COVID-related shutdowns, because of the zero COVID policy in the world's second largest economy. The Fed chairman saying, though, with regards to inflation, we know that inflation is at yearly pacing at levels we haven't seen since the early 1980s. But the Fed chairman said that he does not expect or does not see a wage price spiral, at least for right now. Translation, things likely aren't to get up to speed to the double-digit inflation that we saw in the late 1970s, early 1980s. Of course, history will bear that out in the next couple months or perhaps years. But what was interesting was whether or not the Fed chairman was going to take even more aggressive moves off the table in future meetings. Obviously, that 50 basis point move today was the most aggressive single meeting move that we've seen since May of 2000. The Fed chairman asked if perhaps a 75 basis point move could be on the table. Take a listen to what he said earlier.
75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data.
So the Fed chairman laying out pretty clearly, at least right there, that a 75 basis point move is not going to be on the table, at least in the near term. Instead, it's going to be a 50 basis point, that half point move, that will be on the table in the, quote, next couple of meetings. Keep in mind that would be in June and then in July. Now, obviously, a lot of concerns over what the inflationary picture is going to look like at that point. But again, the Fed chairman saying that the economy looks poised to be able to handle and absorb those interest rate hikes. Now, of course, the next meeting is going to be in another 6 weeks from now, and a lot could change between now and then, guys.
Hey, Brian, what did you make of the tone of the meeting? Because when we started this, or when Jay Powell started this, he started the presser by saying, I want to speak directly to the American people. He's saying that the FOMC is acutely aware that high inflation means hardship. This isn't necessarily the way that these things typically kick off.
No, and that's an important point that you bring up. We hear the Fed chairman usually begin these press conferences by saying the Federal Reserve is paying attention and is, attentive to the American experience in the economy. But he doesn't start off with the literal words, I would like to speak to the American people, and that caught a lot of attention. It underscores just how severe the inflationary picture is in the United States. It's no surprise that Americans are feeling this, especially those on the lower wage, in many cases also minority households. Now, the Fed chairman was saying, look, we're going to do whatever we can to try to use our blunt tools to make sure that we can take inflation back down. And that led to a number of questions in the last hour over how the Fed chairman plans on doing that. And I had the chance to ask the Fed chairman about the Volcker experience, obviously referring to the Paul Volcker-led Fed of the late 1970s, early 1980s, when he dramatically raised interest rates to tamp down on runaway inflation. Now, yes, it was successful in taking inflation back down, but also came with a lot of pain because higher borrowing costs really abruptly ended American consumption and business investment, things that rely on borrowing. And when it comes to the lived experiences that were had through that time, it was definitely not fun, although it did ultimately achieve that outcome. But the Fed chairman saying, quote, there may be some pain associated with getting back to 2% inflation, but said ultimately the bigger pain is not dealing with the inflation that we're facing now. So a bit of a tightrope that the Federal Reserve is walking.
Brian, it's exactly what I wanted to ask you about, because Michael Cox, who we're going to get back to in a moment, former chief economist of the Dallas Fed, said there's too much Paul Volcker admiration and not enough emulation. Is that the consensus you're hearing out there, that he's not emulating Volcker enough?
Well, I mean, there could be an argument that he doesn't want to do exactly what Paul Volcker was doing because that triggered a recession. That's why they call it in the economic textbooks a Volcker shock. The idea is that the Federal Reserve feels like in this case, in this scenario, that's what the Fed chairman was saying over the last hour, they feel confident they can get a soft, or as the Fed chairman just said, a soft-ish landing. What that would imply is that the Fed could slowly ratchet interest rates up in increments of 25, in increments of 50. Remains to be seen if it's going to be in increments larger than that, to eventually take the economy to a place where growth will certainly be lower than trend in 2021, because that was an extraordinary circumstance post-pandemic. Unemployment rate could indeed go higher, but hopefully not at levels that would be at the double digits that we certainly saw in the 1980s, the early 1980s. Obviously, this is very ambitious. This is in many ways perhaps a bit aspirational, but the Federal Reserve is saying, look, at this time we have some market confidence, because you could see in market pricing that there's not quite expectations of inflation running away, at least right now, that they can pull this off. But of course, history will have to bear that out, and that makes the next few months and next few years very critical.
Indeed. Thank you so much for joining us. Yahoo Finance's own Brian Chung with the breakdown there. Well, let's bring back in our panel Michael Cox and Ed Al-Husseini for their takes. Now, Ed, I know we didn't get a chance to get to you before. So in terms of what we were talking about, this expected interest rate hike here, 50 basis points, though, markets off to the races on this news. What were they reacting to that they didn't already have priced in?
Yeah, I think on the margin, we took out some probability of 75 basis point hikes later this year. And so you saw the front end of the Treasury curve really rally as we got those comments from Powell during the press conference. I wouldn't put too much weight on it. I think in the grand scheme of things, what Powell stressed is there's a tremendous amount of uncertainty. There's a tremendous focus now on the data that's going to come in the second half of the year. And the Fed is prepared to do whatever it takes. So is it possible that they'll step up to a 75 basis point pace? Absolutely. I think the question is, by the time we get to, say, a 3% Fed funds rate by the end of the year, where do we go from there?
Hey, Michael, before you were pretty critical of what the Fed has done so far, the fact that it has only raised interest rates by 50 basis points. If you had the ear of the Fed, what should they be doing right now?
Raising rates is not 50 basis points for the next few meetings. And you can't blame this if we have to go through recession, which I believe we will have to. You can't blame that recession on raising rates. You have to blame it on the inflation that preceded it. I mean, to say it's raising rates that causes the recession, that when we had the Volcker tightening of monetary policy, is like saying withdrawing for drugs is what causes the bad feeling. You know, it's the drugs that come first that causes the problem. And that's what we're doing. When you put the economy on an inflation path, the good effects come first and the bad effects come later. The same, and when you put the economy back on a path of inflation withdrawal, the bad effects come first and the good effects come later. Don't forget, we had the strongest economy in many, many years after we extracted inflation out of the economy. During the Volcker years. Very strong economy after that.
And Ed, do you think we'll have to go through a recession? And the Fed chair was asked if the Fed has a credibility problem. Do you think they do?
So far, not really. I think they've buttressed that credibility in the course of the last 6 months by making a very rapid pivot to where we find ourselves today. As Chair Powell said, look, we impact markets and financial conditions through forward guidance. And to the extent that that forward guidance is working, it's a really good signal that our credibility is still with us. And perhaps most importantly, inflation expectations. So far, and again, inflation expectations is a really hazy concept, but to the extent that we can see them in surveys, in market metrics of inflation expectations like tips break-evens, they've not really run away from us. They're elevated, but they've not run away from the Fed. So at this stage, I think the Fed still has credibility. I think it will be put to the test later this year. And whether the Fed continues to tighten policy in response to inflation or whether it steps back is going to have a big role to play in maintaining that credibility into the end of the year.
And Michael, in terms of the added pressure, we did hear Chair Powell talk about the wage price dynamic and saying it's key that price stability exists in order to have a strong labor market versus having people, clamoring for too many jobs that are out there and some of these companies then having to pay them more and that also adding to inflation. What are you watching in terms of that dynamic?
He's right. He's right about that. Well, I'm watching so many things because right now, we haven't had an inflation psychology for a long time. And when you start this inflation psychology, people look around and they look at everything they buy is going up in prices. And they think, well, how much do I need to raise my prices? How much do I need to demand more for wages in order to keep up or even get ahead of the prices that I'm seeing? And so for a while, inflation gets ahead of itself. And there's an inflation spiral, a wage price spiral, which exceeds probably what would exist even in the long run. I think that's the period we're in right now. Some of this inflation you're seeing right now isn't permanent. It's once and for all. And those are the kind of things you're seeing coming out of the three things that was mentioned, the oil and gas and the labor shortages and the supply chain shortages. But again, there is a strong underlying permanent element to this inflation coming from monetary policy because of the 43% increase in the money supply since February of 2020.
Ed, from an investment standpoint, how are you navigating some of the uncertainty out there? Because we have high inflation, we have a changing Fed policy, we have geopolitical uncertainty when it comes to what's happening in China, and of course, Russia and Ukraine. What should investors be doing?
Yeah, absolutely. So when you look at the fixed income space, we've obviously had a pretty significant drawdown in valuations in fixed income in the first quarter and well into April. So it's created, I think, a really interesting valuation picture. If you look at the long end of the Treasury curve, 10-year yield's about 3%. I think they're starting to look quite attractive at these levels, particularly with the backstop that the Fed is providing in taking inflation and inflation risk off the table as they tighten policy. So towards the longer end of the curve, I think now is at valuations that are fair to starting to look a little bit cheap. And then most interestingly, I think in the credit space, if you look at the widening in credit spreads, both in high yield and investment grade, look, by and large, they reflect not so much a slowing economy, but rate volatility, underlying interest rate volatility. And so we have high quality, relatively low durations, and relatively interest rate insensitive assets in the front end of the investment grade credit curve, for example, that are offering exceptionally attractive yields. So I think what we're hunting for is long duration in the Treasury space, and then shorter duration, shorter maturity credit products that have cheapened up in the course of the past 4 months.
Michael, it's certainly more important how we get out of this mess than how we got here, but you did assign a fair amount of blame to the Fed. The Fed chair was offered the opportunity to share the blame with the administration and with Congress for flooding this country with money, but he did not do it. He said it is solely our responsibility to get us out of this mess and to control price stability. Does Congress, does the administration deserve a fair amount of the blame for why we got into this mess?
Yeah, I think for two reasons. First of all, they just keep, paying money out. Well, tremendous amounts of money was put into the economy for, payments for workers. People couldn't get to work during COVID, but the Fed could have taken that money back out of the economy. During the Great Recession, the Fed increased the money supply only 12%. And those were hard times too. That was a longer recession than this one. This recession was only 2 months. It was the shortest recession in history. But during the 16 months of recession, Great Recession, the Fed increased money supply only 12%. But, paradox, you might say, well, why do I blame this administration? Well, this chairman, during this chairman, Powell, we've had the largest increase in inflation that we've had under any chairperson, even going back to G. William Miller now. Now, the opportunity came up to reappoint a different chairperson. Okay? So ultimately, it's the choice of this administration who's running the ship at the Fed. And whether we have a Volcker-type person or whether we have a person who continues to increase the money supply, ultimately it is the choice of the Biden administration how easy they want monetary policy to be. And they're telling you how easy they want it to be right there.
Right, we will have to leave it there. Do thank you both for your insights. Michael Cox there, former chief economist for the Federal Reserve Bank of Dallas, and Ed Al-Husseini, Columbia Threadneedle Investments senior interest rate and currency analyst. Thank you both.
Well, coming up next, we are breaking down how the Fed's latest rate hike may impact ETFs. We'll have that when we come back. Stocks rallying with 20 minutes to go until the closing bell. On the heels of that decision that we just got from the Fed raising interest rates by 50 basis points. Fed Chair Jay Powell saying that there are no plans, at least for now, to raise rates by 75 basis points. Let's talk about what all this means for ETFs. And for that, we have Tom Lydon. He's the CEO of ETF Trends. This is part of our ETF report brought to you by Invesco QQQ. Tom, first, let's get your reaction to this, because looking at the markets more broadly speaking, it looks like investors were encouraged by what they heard from Fed Chair Jay Powell just a few minutes ago, also from the statement that we got from the FOMC. But what did you think of it?
Yeah, it was very optimistic. There was some whispering, as you know, going on about maybe sneaking in 75 bips, and it was nice that it wasn't done. However, we know, and we're surveying advisors all the time, the Fed's got a big task at hand. For the last couple of years, surveying advisors, their number one concern has been inflation. The Fed has signaled that they're not as concerned about inflation. It's transitory, but here we have real hefty inflationary numbers coming out. And also considering the way inflation is measured today compared to how it was measured back in the 70s, which tends to be the benchmark for most advisors, it's definitely concerning. So more and more we've seen money in motion that we haven't seen in the ETF space for a long period of time. More money has gone into commodity ETFs this year than we saw go into fixed income ETFs, which is really surprising. And more advisors tend to shift away from not only fixed income, But the benchmarks like the S&P 500, which really was a stalwart for the last 10 years coming out of the financial crisis, people are concerned because of the heavy allocation in the FANG stocks and Tesla and Microsoft that have all been underperforming the major market indexes so far.
And Tom, what are you hearing just from investors? Because talking to us about what funds are attracting inflows right now, are there some investors that you think are simply staying on the sidelines because of some of the uncertainty out there?
Yeah, we have over $6 trillion in money market funds, which is a record. And also a lot of money has gone into short duration. But the broad market index in the fixed income side is down 10% year to date after a poor year last year. So you think about investors that are approaching retirement or in retirement right now, that's somewhat dead money. And in fact, the dangerous area if we have an extended period of time of rising rates, which is really, really scary. But we are, for the first time, seeing sizable moves going into commodities for all the right reasons. But many are saying that we're just in the early innings as inflation, although signaled 8% or so on the CPI, we could be in an extended period where it could be 3 to 5%. And historically, for commodities, that's a really good period. So having in the past a 5% allocation, many advisors are moving that up to a 10 or even 15% allocation for their clients.
Tom, something you and I have talked about in the past are these thematic strategies, and you talk about the popularity of maybe commodity funds right now. When focusing on thematic strategies, though, does that make sense in this type of market?
Well, it depends on the areas that you're moving to. There's some themes like traditional growth or even innovative, disruptive technologies like the Cathie Woods and the ARCs of the world. Definitely been punished. However, if you look at the valuations in those thematic strategies now, they're pretty inexpensive. And if you've got a long-term outlook, being able to buy Cathie Wood ETFs for 50 or 60% off, and if you've got a 10-year horizon, pretty big opportunity there for sure. And we're seeing some money go into those areas. We're also seeing money go into options overlay strategies where you may have an underlying index like the S&P 500 or the NASDAQ 100, where you can have options that can kick off 5 to 7% income in a time when income's challenged on traditional fixed income strategies, where money moved from an income side of the balance sheet over to the equity side of the balance sheet, where you're still invested, but also get that income kicker. That's been really attractive.
Tom, a mover here this afternoon is Bitcoin. It was briefly above 40,000, now sitting just below that level. Some talk out there about when or how likely it is that we will see a Bitcoin spot ETF. What are some of the trends that you're hearing from investors just about how they want to or how they plan to invest in crypto when it comes to ETFs?
We do a survey with Bitwise every year, and we just finished the 4th year. More and more, not just individual investors, but advisors that work with high net worth clients are trying to find ways, in safe ways, to get allocation. If you custody at a Schwab or a Fidelity or a Morgan Stanley, it's really difficult to be able to allocate into the currencies themselves. However, there are some future strategies in the ETF space that are available. There's some separate account strategies that are available as well. I think eventually we're going to have to see that the SEC chair has to turn the card. He has to be able to allow investors to go into this area. It's just baby steps that they're taking. And with this future strategy that they have available now and approved through 40 Act ETFs, it's the closest he's gotten to be able to allow advisors and individual investors buy that in their brokerage accounts.
And Tom, just wrapping up and going back to the theme of the day, which was the Fed and what we just heard from Fed Chair Jay Powell, any concern from you and some of the trends that you are closely watching that we could potentially be at risk of a recession if the Fed does, in fact, act a little bit more aggressively than what investors are hoping to see?
That's the big question, Sean. It's a big concern because we have to fight inflation, but many advisors are feeling like the Fed's A, too late, and B, not being as aggressive. And if that puts us into recession, so be it. Many advisors are more fearful of the after effects of inflation and what that could do, even though we might go into a recession for a short-term period of time. Fed's in a tough situation, and investors and advisors are very much concerned. Even though we in the U.S. are in better shape as far as food, gasoline, services, those types of things, we have to keep an eye on what's going on overseas, because it's not going to be that long before some countries actually have food shortages or energy shortages, and that's going to spill over onto our shores. You were talking about the right thing, and today, yes, it's nice and positive to see the moves in the market, but this is going to be a long-term battle. It's going to be a marathon.
All right, Tom Lydon, always great to speak with you, of ETF Trends, CEO there. Rochelle?
All right, just on the other side of this break, ride sharing in space and here on the ground. Those are part of our Triple Play picks coming up next. Welcome back, everyone. It is time for our Triple Play, so I'm going to kick us off starting in the sky. My pick is Satellogic, ticker symbol SATL. Now, this is a nanosatellites operator and a builder of spacecraft. Now, the shares actually got a boost in early trading, but they couldn't quite hang on to it. As you can see there, the stock is down about 1.5% at the moment. Now, we did see it's also down year to date by more than 8%. But despite that, the shares were moving on news of a multiple launch agreement reached with Elon Musk's SpaceX to increase launch capacity for its next 68 satellites. Now, in a company statement, they say SpaceX continues to be Satellogic's preferred vendor for rideshare missions. Now, the deal furthers Satellogic's goal of achieving a weekly remapping of the entire surface of the Earth in 2023 in high resolution and with high frequency. Now, if successful, this would be the first company to ever do so. Now, it would also allow companies, governments, and organizations to monitor changes on the ground and make faster decisions in terms of things like natural disasters or even conflict.
Well, Satellogic sounds like the latest company to really want to do business with Elon Musk. He's a man that's very popular these days, so certainly we'll see how that pans out for Satellogic. Well, from space, let's bring it back to Earth, and let's talk about two companies that are moving to the downside pretty significantly today. Look at those losses from Lyft, the two ride-hailing stocks taking a huge hit. Now, Lyft tumbled as much as 35% in intraday trading. It was the biggest drop that we have seen for the shares on record here. Now, this is all over worry about its outlook and also the driver shortage that we've been hearing about for months. Investors questioning if Lyft's efforts to attract more drivers, whether or not that's going to derail the company's road to profitability and reach those goals that they have laid out. Now, in a note to clients, Piper Sandler analyst Alexander Potter writing that, quote, there's no room for error in this environment, but still the sell-off that we're seeing today seems a bit overdone. Uber falling alongside Lyft today despite reporting strong demand for rides during the quarter and doubling its first quarter revenue, Dave.
Yeah, the numbers for Uber look spectacular, right? I mean, trips up 18%, monthly active consumers up 17%, revenue up 168%. The prevailing wisdom was that because Lyft spent on drivers, Uber would have to at some point. But Dara came out this morning and made clear we've already done that spending on our drivers, so we're fine. By the way, little plug here, super pumped, the story of Travis Kalanick and how he founded Uber. Unbelievable. Check it out on Showtime streaming. It's incredible. All right, my play is DraftKings. DraftKings stock started the day down a bit, but it has really rallied with the rest of the market. The news is that it is now on the ballot in California. They got 1.6 million signatures to get sports betting on the ballot in California in the fall. And they actually teamed up, DraftKings did, with FanDuel and with BetMGM to get those signatures, to get it towards the voters. But the big question now going forward is, will it pass? This will be one of the most expensive ballot proposals of all time. They are spending an expected $100 million already. But on the other side, the tribes, the Indian tribes in California, expected to spend some $250 million to get that ballot provision turned down. This is going to be one of the biggest sports betting markets in the country. Right now, it's New Jersey, Nevada too. California would clearly be the biggest sports betting market in the country if they can legalize in the fall. And if I'm a betting man, which I am, I think they're probably going to pass. This is a legal marijuana state, after all, Rochelle.
It is, but you do have to wonder. I mean, obviously, with Native American rights on the table, that isn't something that California is just going to let mull over. I don't know if there's some sort of agreement that could be reached that would give them some sort of betting rights as well. But I think they actually might be in for a bit of an uphill battle. And as we've seen with some of these betting companies that came out, they offered all sorts of deals when it comes to getting new people to sign on. But once those deals go away, are people still going to be as interested in sports betting? We'll have to see. Obviously, it's a growing, budding thing. A lot of people waiting for this. And as you said, keeping that one eye on California.
It's remarkable, Rochelle, how much they're spending on these deals to lure new gamblers. I mean, you're offering $1,000 risk-free bets. You're offering $500 with no risk, zero. But will they keep them? They'll keep enough of them. Earnings report on Friday for DraftKings. That will be a very interesting number because the stock has gotten crushed this year and crushed over the last 12 months. At some point, it's got to be a great opportunity again. If you are a betting man, there is the chart. Look at that thing. It has been ugly in recent times. Coming up, we're counting down to the closing bell on Wall Street as markets rally on that Fed news.
We're minutes away from the closing bell. We've got a rally on our hands. All three of the major averages firmly in the green. Dow, S&P, and Nasdaq up over 2%. You can see that S&P up nearly 3%, Nasdaq up over 3%. Ines Ferre has a closer look at today's movers. Ines.
And Shauna, what a rally we are seeing. Let's take a look at our Wi-Fi interactive board. As you just mentioned, the S&P 500 up 2.9%. In fact, is set to have its best day since April 2020. The Dow likely will have its best day since November of 2020. The Nasdaq up more than 3%. Looking at the sector action, we are seeing energy, which is adding to the gains from earlier this morning. But the big winners here are also being technology and communication services. This is after Fed Chairman Jerome Powell's comments, taking 75 basis points off the table. So let's take a look at the NASDAQ 100. You can see on the left-hand side of the screen some of the big cap names here. Apple up more than 4%. We're looking at Alphabet also up more than 4%. You've also got Amazon, which was down earlier today, down 3%. It's up more than 1% right now. Over on the Dow, we're watching all 30 Dow components in the green. The semis are in the green as well. Here's the closing bell for today, Wednesday, May 4th, at the New York Stock Exchange.
Plenty of reason to applaud the market action today. That is your closing bell, and here are the applause-worthy numbers. Wow, look at it. Just about 3% for the Dow, 3% for the S&P, and over 3% gains for the Nasdaq. A lot of green on the board after the comments from Fed Chair Jerome Powell. Let's bring on our panel to talk about it. David Wagner, Aptus Capital Advisors Portfolio Manager, and Hugh Roberts, Quant Insight Head of Analytics. Gentlemen, good to have you. David, what are the markets rallying on? It did look like right about the time the Fed chair ruled out a 75-point hike, they spiked. Is that it in your estimation?
Absolutely, that was it. I think we definitely got more of a dovish tone from Jerome Powell today, really on two things. I think the Fed was expecting more tightening over the next 3 months. Obviously, we're getting substantially less. And the big thing that Jerome hit on, they dismissed the fact that there could be a 75-point rate hike here in the near future, that the committee is not talking about at all. And taking it a step further, Fed Chair Jim Bullard, he actually didn't even vote for 75 basis points. So he's been blowing smoke for quite some time now, it feels like, after this full dissent, that he voted for 50 basis points. So obviously more of a dovish tone really driving the markets higher right now.
So then, David, what happens next? We've got this 50 basis point hike. What are the markets going to be looking at signal-wise as to how to position themselves?
So we've been here at Aptus kind of looking back at historical standards during tightening periods to see, hey, what sectors of the market have actually done well in this type of environment? Obviously, not a whole lot of environments that we can really go back to as we transition from a QE period to a QT period. But if you look back in 2018, 2019, when we let a lot of stuff roll off the balance sheet, or the Fed, did, we actually had the defensive sectors really start to outperform. So we had the staples, the healthcare, and the utilities areas of the market outperform. On the other hand, we actually had energy and materials really underperform. So, I'm kind of tossing that out the window actually right now, because I'm actually very bullish on materials and even more bullish on energy moving forward. So if we go back to later periods in the early 2000s and other periods where we actually saw rising rates of the Fed tightening, you still saw defensive outperform. So that's what we're going to stick to, and we're going to barbell that with some energy trading here moving forward in this environment.
Hugh, let's get you into the conversation, because clearly investors, more broadly speaking, seem to be pretty excited about what we heard from Fed Chair Jerome Powell today. But what did you think? Is the Fed making the right move by raising rates by 50 basis points today?
Well, I would echo most of David's comments. I think it has to be the removal of 75 basis points as the catalyst for intraday price action. You can also see that in the sector breakdown you guys just showed, with obviously tech leading the way. Obviously, that's normally perceived to be a rates play, so that kind of dovetails with that once again. To answer your question more directly, I fear that this might just be a bear market squeeze, that the one constant from Chair Powell has been the need to tighten financial conditions. And what we're seeing today is flying in the face of that. So you could argue that we've got a paradox here, that the more we get a risk-on reaction in the short term, the more rate hikes we take off the table, looking at red euro dollars, for example, the more I fear that this will turn around and bite us again.
Interesting. David, I want to get your reaction to what Hugh just said.
I think Hugh's spot on right now. I think this is a bear market rally here. I mean, just 2 days ago, we had the VIX trading at about 36, 37. That's pared down closer to 27 right now. And historically speaking, when you get that VIX coming down a little bit, hey, you're looking for the potential for some type of squeeze up, in my opinion. So I fully agree with you here.
So Hugh, for people who are looking for an opportunity to get into the market at this point, especially retail investors, after all this volatility that they've seen, what would you advise them?
Well, annoyingly, I thought we had a contrarian call, but David's just stolen my thunder because we actually have energy. Interestingly, so Quant Insight is predominantly about macro factors. We're not a bottom-up shop, so we're looking at economic fundamentals, measures of growth, measures of inflation expectations, financial conditions, risk appetite, and our quantitative macro models at the moment show that. That energy has actually somewhat bizarrely become a little bit more of a defensive play. It's actually one of the few sectors that's comfortable with wider credit spreads. Credit spreads really on our modeling are ground zero. If we see another risk-off episode that pushes high yield spreads in particular wider, then that really is the catalyst that would be the, people talk about the Fed have to keep going till they break something. We don't worry so much about the Fed put. We don't worry so much about inverted yield curves. What we worry about are credit spreads. That really is the kind of nexus of all these kind of pressure points at the moment. So we're really kind of watching that both for directional at the index level, but also therefore for the best kind of sector plays. And interestingly, it's counterintuitive, but the mathematical relationship at the moment shows wider credit spreads is actually a benefit to XLE. So I have to agree with David and go with XLE as one of our picks.
David, let's talk a little bit more about energy because, like he was just saying, it could be called a contrarian play. I don't think a lot of people are going after this sector right now. But when you're trying to decide which investments make the most sense right now, what are you looking for?
Yeah, it's kind of funny. So I'm a bottoms-up guy. Hugh just said he's a top-down guy. And a bottoms-up guy and a top-down guy really coming together with an energy play right here. I love it right now. I mean, it's been such an unloved space for quite some time. And what we've been saying about energy is it might be a little bit overbought right now, but it's fully under-owned. If you look back over the last, say, 40 years, the average weight in the S&P 500 for the energy sector is closer to 11%. Yes, this year, the S&P 500's energy sector has doubled in weight from 2 to 4, but it has a long way to go. I mean, they're having a full new entrance of potential investors right now, especially on the generalist side, that energy companies are coming out saying, hey, we're not putting 125% of free cash flow back into the ground. We're actually going to pay out 75% or 50% of the previous quarter's free cash flow to investors through share buybacks, through dividends. So, they have really changed their mentality that, hey, it's not growth at any cost. We're going to be diligent from a capital allocation plan moving forward. So we love energy. I'm right there with you, Hugh.
You guys are agreeing way too much today. All right, Hugh.
It's scary.
Hugh, I want to get back to, and maybe you guys can disagree here, to what the Fed chair was saying about a soft-ish landing. And Powell said they have a good chance to have a softish landing. Our earlier guest, Michael Cox, former chief economist at the Dallas Fed, said he wants to see less admiration of Paul Volcker and more emulation. Can we avoid a recession? Should he emulate Paul Volcker more?
Well, that's the million-dollar question, isn't it? I mean, for every talking head who points one way, you're going to get someone else who gives you a different opinion. I mean, history suggests that it's a very, very big ask. 1994 really is the most recent time they successfully engineered a soft landing. And I would almost argue that they were easier circumstances that the current Fed face, given all the different crosswinds between COVID, between armed conflict in Russia, Ukraine, lockdowns, supply bottlenecks. I mean, it's just, there's a myriad of different factors moving. We would argue, with my sales hat on, there's almost too much information for the human brain to parallel process. You need a little bit of quantamental, you need a little bit of hard maths to help you. along the way. And what our models are showing at the moment, if we want to focus on the S&P 500, but it's equally applicable to Russell or NASDAQ, is that macro warranted fair value, i.e. where US equity indices should be given economic fundamentals and financial conditions and the like, have been falling steadily. They had, funnily enough, shown signs of a temporary bottom just last night, and we've started to level out a little bit. And the good news is on our models, on valuation terms, the markets have priced in some bad news already. They are a little bit cheap. So again, bear market squeeze makes sense to our mind. But I would just have to reiterate the same point. Just watch credit spreads. They really are ground zero for us. If they break, then risky assets in general, not just the major US equity indices, but risky assets in general are in trouble.
Appreciate your insights on those signals to watch there, gentlemen. David Wagner there, Aptus Capital Advisors Portfolio Manager, and Hugh Roberts, Quant Insights Head of Analytics. Thank you so much. All right, shifting gears now, and we're going to earnings being reported after the bell. We're looking at Etsy, as we can see, down in after-hours trading by more than 14%. Jared Blickery has the latest. Jared, what are we looking at here?
You're looking at a stock that is trading at near two-year lows here. You can see on your screen now the current quarter, the reporting quarter, the numbers were not that bad. Adjusted EPS coming in exactly as expected. You can see revenue coming in at $579.3 million. That's higher than the expected revenue. However, when you get out to the forecast, you see some disappointment here. They're seeing second quarter revenue of $540 to $590 million. Estimate was for quite a bit higher, $628.8 million. Also seeing second quarter adjusted EBITDA margins about 25%. The estimate was for higher, 26.5%. So a miss there. And then the key stat of gross merchandise sales, they're saying that should be $2.9 billion to $3.2 billion. By the way, gross merchandise sales for the reporting quarter, the first quarter, were $3.3 billion, and that was exactly in line with estimates. Do have a quick quote from Josh Silverman of Etsy. Despite continued uncertainty and macroeconomic headwinds, Etsy continues to rise to the occasion to deliver solid results that show us maintaining most of the gains reported during the extremely strong year-ago period. So a bit of disappointment on the guidance there. Etsy down to multi-year lows, down 11% on your screen.
Certainly one to watch. Thank you so much. Our very own Jared Blickery there. All right, do stay with us on Yahoo Finance. On the other side of this break, a deeper dive into Etsy. Stay with us.
All right, on earnings alert here, Etsy reported its first quarter earnings after the bell, and you can see what after hours numbers hammering the stock down now 15%. Let's break down the company's results with Marvin Fong, BTIG director. Marvin, it looks like about as expected in terms of revenues, but the forecast is where they came up well short. What do you make of it?
Right, yeah, remember that they provided guidance, the fourth quarter, when they provide guidance for the first quarter, it's actually very deep into the year. So they provided guidance for the first quarter on February 24th. So really just 1 month left to go. So, first quarter should have fallen well within expectations. And so really all investors' eyes were on the second quarter guidance, considering all the, changes that have happened, relatively recently. And so, the guidance range is larger than usual. The past couple of quarters, they've done a range of $200 million. This one's $300 million. We are earlier in the quarter than we were in the last quarter in terms of guidance. But, clearly, the street was too high. A lot of the estimates were quite stale. But, the consensus was at $3.4 billion. Now they're guiding to substantially less than that, 2.9 to 3.2. We think the true expectations were something more like 3.1 billion, which would have been more or less kind of flat in the Etsy.com marketplace. Instead, they're talking about being down low single to high single digits. So that's really what's driving the disappointment. But keep in mind that the stock had a furious rally into the close. So kind of compared to where we started today or ended yesterday, the stock's actually not too much different.
Then as we dig into the earnings, then what do you see as the additional pressures going forward for Etsy?
Mm-hmm. Yeah, a lot of it is math. Keep in mind that, the comps for Etsy are quite unusual. They had so much more growth in 2020 than anybody else. So 120, 30% growth in 2020 in the second quarter. The comp in 2021 was low compared to that, like 12, 13%. And now we're going into this quarter. But we like to kind of baseline things against 2019, right? The true year that we didn't really have any COVID impacts. And in that regard, the company is in the first quarter, it was 2.7 times bigger than it was in the first quarter of 2019. Now that's going to step down in the second quarter because, the pressures that they're citing, geopolitical, reopening headwinds, things of that nature. But, even with guidance where it looks like it's going to land, the company is still going to be 2.3, 2.4 times bigger than it was in 2019. So you do have to take a longer lens, but clearly, investor expectations are real time. It's kind of a what have you done for me lately business, but a lot of it is just sort of the progression of the year-over-year growth rates.
Well, Marvin, it seems like they're doing enough for you. You have a buy rating on the stock, $140 price target. With this after-hours move, we're just below $100 a share. What's it going to take to reach that level? Yeah,
so we are actually pretty conservative in our actual estimates. Like I said, the street filled with lots of estimates that really hadn't been updated, for inflation, for higher interest rates, things of that nature. A lot of them were really set when the company last reported, and that was literally the day that the Ukraine conflict began. We've actually been really the low on the street in terms of our estimates. We've been conservative. We've factored in all the consumer pressures. Where the real debate lies is in the multiple. What is the right valuation for this company? During the pandemic, it was trading into the 40 times EBITDA multiple, and historically, that pre-pandemic, it was 26 times on a forward EBITDA basis. And so it's really just investors trying to recalibrate. Whether the earnings estimates or the revenue estimates change 10, 15%, by itself can't explain the move in the stock. It's really getting that multiple right. For all that's happened, for even if we want to characterize this as a disappointing guidance, remains a much bigger company than it was pre-pandemic. We think management is very good. A lot of buyers, remain on the platform. They just, mentioned in this earnings release that they added 7 million new buyers. So it's still a growing platform. It's a premier franchise among e-commerce. Investors are just trading and selling a lot of stocks vigorously. The multiple has really reached a point where it's, like I said, historically it's 26 times. They've brought it down into the upper teens. We think it's going to take sort of this relaxation of of pressure on multiples across technology for Etsy to kind of get back to that, in line with that historical average. Maybe it doesn't really ever get back to 26 times, but we definitely think with the secular growth profile of the company that you're getting a pretty good deal if you can get it in a mid-teens EBITDA multiple.
Internally,
and in fact,
though,
we think it's worth more like 20 times.
Apologies there, Marvin. Internally, a bit of an issue there. They had the strike from the sellers. It was only a week, April 11th through the 18th, but they were striking because the fees were increased from 5 to 6.5%, which is rather dramatic for those sellers. How much does that change the dynamic there and the financial model?
Yeah, so I guess to put it in context, at the end of last quarter, Etsy, the core marketplace, had 5.3 million sellers. So 1% of that is 53,000 sellers, and I think the actual number of sellers that was striking was about 17,000. So about 1/3% of sellers. To put it in context, the second point I would make is that none of these sellers, as far as I know, really said they were going to permanently leave the marketplace. They weren't that disgusted. They were merely protesting. But I think that they recognize that Etsy is their top channel, maybe their second top channel, but really a very important channel for them, and that they really can't afford to go off of. Now, in terms of a percent, yes, it was a rather large increase, and especially the timing. It was announced at the same time at fourth quarter earnings, so announced the day the Ukraine conflict began. Bad, not great optics. With all the other challenges of inflation, it just seemed, not a great time to add this to sellers' plates. The reality is that, Etsy had probably been working on this price increase for many months prior, or transaction fee increase many months prior, and it just was all kind of coincidence that way. But, it was their second fee increase, the first one being in 2018. So they've done these two fee increases in the entire history of the company. In that context, not that much. 6.5% still compares to something like 15% on other marketplaces. So, it still is a good deal in the grand scheme of things.
Marvin Fong, BTIG's director, thanks so much for joining us. Let's talk about big tech, because the secret to Google's search magic, it isn't just the algorithm. The tech giant relies on workers known as quality raters that get paid, get this, just $10 an hour. And they aren't even employees of Google. Ali Garfinkel is digging into this story for us. Ali, let's take a few steps back. First, just tell us, what are these quality raters and why are they so important to Google search?
Thank you so much for having me, Shauna. So the first thing to know is that a quality rater is somebody who is helping improve Google's algorithm. They're a person who is able to look at something and say, hey, this is actually a great result, or this is actually maybe not a good result. The example I've been using is that if you, Shauna, were Googling a pair of black pants, they are the people who make sure that you get, say, a pair of pants, not a sculpture of a pair of pants or a photo of a pair of pants. And it might sound like these people work for Google, but as you said, they don't. Christopher Cawley is the name of the rater that my story focuses on. And for the last 5 years, all of his work has been for Google and Google products, but he is not an employee. He's instead working for a subcontractor called Rater Labs. He makes $10 an hour, and he is not considered part of Google's extended workforce. And the situation sort of begs this interesting question. If all the work a rater does, should someone like them be considered a Google employee?
I mean, you raise an interesting question then. So what about working conditions for raters? What do we know about that?
So their working conditions are in some ways a lot like yours or mine, working from home. They wake up, they go to their computers. But in some cases, they're a little unusual. For example, most of the raters I spoke to, none of them have ever had any sense of what their direct boss's name might be. They also communicate exclusively through a chat system that's run by Rater Labs. But the kicker is a lot of them feel that that chat system is monitored. So it brings up all these odd situations where they'll have to find each other on Facebook.
Looks like we lost Ali there. But Ali Garfinkel, thanks so much for bringing that story to us. And you can catch more of that on yahoofinance.com.
All right, coming up, the 2022 F1 Miami Grand Prix kicks off this weekend. You won't believe the eye-popping numbers of part of this race. Next. Like it or not, NFL games kicking off at 9:30 a.m. Eastern Time is here to stay, and the league is determined to go international. The NFL today announcing a slate of 5 games abroad, including the first ever in Germany. Josh Schaefer here to break down the story, when and where we can see these games, and most importantly, who? Tom Brady.
That's right, Dave. They're going to have Tom Brady over there. So we've got 5 games announced today internationally, and the league's going to have 3 of those games in London, and one of those games is going to be broadcast exclusively on ESPN Plus for the first time. There's going to be another game in Mexico City, and the big one, the NFL's first game in Germany. So Tom Brady and the Bucs will be playing the Seattle Seahawks on November 13th at Allianz Arena, the home of the renowned soccer club Bayern Munich. This is really kind of an interesting story to follow, guys, because as we've been watching, the NFL is trying to expand further into these international markets. With 26 international markets they created earlier this year, and the big thing is having Brady over there, right? Yeah. When you have Brady over there, you can attract a different kind of audience and really get people into that player-driven thing. That's what the NFL is going for, because you're not going to go to a game without any merch, right? So now you can engage with those international fans. They're going to buy a Brady jersey, buy a Brady shirt, then you're making money off them. That's good for the NFL, of course.
A huge money-making opportunity, certainly, for them. Let's switch gears. We're going to stick with sports. There's another sport that's not quite as popular, not nearly as popular, I should say, as the NFL is football right now, but it's F1 racing. It has certainly gained popularity because of a recent Netflix series. A big race coming up this weekend in Miami. Eye-popping numbers that we're seeing in terms of how much people are spending on hotel rooms, how much they're paying to go out to eat, bottle service at a club. What is going on?
Yeah, so the F1 is in Miami for the first time, and people are excited, right? It might be bigger than the Super Bowl some people are projecting, which is pretty big, right? So the prices that I saw just looking at some different things online, you want a room in the Hard Rock Hotel on Friday or Saturday night, that's probably about $1,100. If you want to go get a meal, Carbone, the famous Italian eatery, is doing a whole kind of setup on the beach, $3,200 to attend that. And then the tickets themselves, cheapest ticket, somewhere in the grandstand, not a great seat, $750. You want to be at a corner, see a crash, see something exciting, $1,000. Wow. To be at the finish line, guys, $1,500. Now, why, Shauna, you kind of referenced this, right, with Netflix's Drive to Survive. So let's take a look at those viewership numbers we just had up there. Netflix kind of had this big series with Drive to Survive. They've created stars. Max Verstappen, Lewis Hamilton, Daniel Ricciardo. These have become household names because people are watching the streaming service and watching that docuseries. Now, we had 949,000 viewers last year. That's up 41%. From the numbers in 2019. This year, if you look at the first two races, it's more than double the 2019 numbers. The numbers are absolutely taking off. Rochelle, have you been watching F1 racing, or are you getting into the craze at all?
So, you know, I mean, I'm always a big fan of, like, when you have something like Netflix and a special sort of introducing you to something that you don't watch regularly, I like this pairing. I've only looked a little bit, you know, I mean, Lewis Hamilton, I'll watch. Everybody else, I'm like, yeah, if I don't know you, I won't watch. But I think it's interesting in Miami. It's one of these places where it's really cool to be seen. So obviously this is a first for Miami, but how much longevity do you think this is going to have once the sort of the novelty wears off?
It's a good question, Rochelle. I think it's going to last a while because, so this year they're in Miami, next year they're in Las Vegas. Mm-hmm. When you have this touring model, the novelty stays as you go to different cities. And as you go to those different cities, it becomes really maybe a sustainable model and perhaps a model like we're seeing with the NFL that maybe these other leagues are going to start to follow and travel a little bit more and kind of get out of the classic home market setup.
And to back up your point, 300,000 people are expected in Miami for a race that only fits 80,000 people, and the economic impact they expect to be $400 million. It's a spectacle. It's not just a race. Josh Schaefer, good stuff, my friend. Thank you. Rochelle?
All right, well, coming up, May is Mental Health Awareness Month. So just ahead, we'll talk to the CEO of mental health app Real, as more than half of all Americans living with mental illness aren't getting treated for it. Find out why next. Welcome back, everyone. World Cup champ Megan Rapinoe, the NFL's Eric Kendricks of the Minnesota Vikings, and even actress and Goop founder Gwyneth Paltrow, just some of the names trying to reduce the stigma and improve access to mental health treatment by partnering with a company called Real. Well, Real COO Ajay Khatri joins us now for more on this. Thank you for joining us. So some prominent names there, obviously. What is drawing them to Real, both as advisors and investors?
Oh, thanks for having me, first of all. The reality is that there's not enough, mental health tools out there for people in the United States. About 93% of the population doesn't have access to a one-on-one therapy or a therapy model. So we've got to redefine how we provide care, and that's what Real's going after. And I think, the list of investors that you mentioned and advisors are fully aware of that problem and have all experienced or had family or friends experience that, and so are looking for different ways to scale the business.
Jay, I was scrolling through when I downloaded your app earlier today, mental health apps on the App Store. I didn't get to the bottom of the list. There are 20,000 estimated mental health apps out there. What separates yours from the pack?
Yeah, that's a great question. I think a lot of money has gone into the space, and people are trying to attack it in different ways. I think what makes Real different, generally speaking, is we're driving an asynchronous experience. So one, there's an overall stigma to getting mental health help, and if you could do that in your privacy of your own home anonymously, that's the first step to getting you to see full-time care, as well as. Our team is focused a lot on clinical outcomes and driving clinical outcomes. So it's created by therapists, psychiatrists, MDs that are really focused in on how do we drive and improve care and actually provide a scalable model. We'll have some clinical data being released later this month that'll show the efficacy and proving that this is the next step forward in providing a care model that can actually scale.
And you talked about the shortage of mental health care workers. Over 50% of Americans living with mental illness, even though most of the Americans actually live within 10 miles of mental health treatment facilities, aren't getting treated. We're seeing that's about more than 27 million people without that care. And we're seeing a majority of young people, 60% of young people also not receiving mental health treatment. So how do some of these mental health startups work with insurance companies or other companies to really make this affordable and more accessible?
Yeah, I think it's a great question. I think there's a number of different pathways there. Truthfully, payers across are looking for answers as well. And you've got to find asynchronous methodologies. We're just not putting enough people and therapists through school today to be able to meet that demand. So when you have a supply-demand issue, technology is the greatest equalizer of our time. And so we're focused in on how do you provide that, whether that's in conjunction with therapy or prior to therapy. How do you really work through this as a holistic industry? And the major names out there in terms of CVS, United and others out there are looking for the same answers that we're trying to provide.
You raised a point about the stigma that's out there, and it's astonishing that 47% of Americans believe seeking therapy is a sign of weakness. I'm not ashamed to say I have sought therapy numerous times in my life, and it's helped me through some of the darkest times in my life. And I think we should all come out and say that if we're not, and we shouldn't be ashamed. How do you push back on that stigma in addition to helping?
Yeah, well, first of all, we're celebrating Mental Health Awareness Month, right? So it's nice to have something out there that is, reinforcing a positive behavior. I think the other thing is we've been so focused as a society on our physical well-beings. I think we've got to put more out there. We've got to give more tools to people to be able to realize how to improve themselves. And I think Real does that, right? At the core and the heart of Real is we want to provide a tool set that really allows you to start to self-identify when you're starting to experience and when you need help. The first step to all this is actually identifying that you are going through, and you need help from a mental health standpoint. The truth is it takes 11 years on average for a person to seek mental care help after they've identified or it's been identified that they could or have symptoms. So we've got to work on this collectively. I think companies are more in tune with it as COVID as one of the positive outcomes from COVID has been awareness that we need more mental health help and overall tools to make us all overall well.
And as you mentioned, COVID, the WHO talked about the disproportionate impact that COVID has had specifically on women and young people. How does Real try and perhaps give better access to those groups? And what is still needed in terms of funding and support for those groups?
Yeah, look, I think there's a number of things that need to happen in the space. Generally speaking, from a diversity standpoint, there's so many demographics out there that don't have access to care today, including youth, including women, including racial minorities in the country. I'm proud to say that Real has tapped into being able to attack some of those. And as we release our data over the next upcoming month, we'll show some of that data and some of those demographic data where we're able to do that. But we've got to ingrain it earlier in our life cycles from a youth standpoint, that getting and seeing help is part of it. We go get a physical every year, each one of us. It should be mandated that we do the same thing from our mental health standpoint. We should be seeing, on at least at the very least on an annual basis, if not more often, to do a mental wellness checkup.
Certainly important there to recognize the importance of physical and mental health being made a priority. Thank you so much. Real's COO Ajay Khatri, thank you for your time this afternoon.
All right, coming up, streaming giants like Netflix and Disney are spending big bucks on some of their most popular titles. We'll have the breakdown for you right after the break. TurboTax owner Intuit reaching a settlement to pay millions to customers misled with promises of free tax filing. So here's the details. Under the settlement, Intuit is going to suspend its, quote, free ad campaign and pay $141 million to more than 4 million users. Now, in a statement, New York's Attorney General wrote, "For years, Intuit misled the most vulnerable among us to make a profit. Today, every state in the nation is holding Intuit accountable for scamming millions of taxpayers, and we are putting millions of dollars back into the pockets of impacted Americans." Now, taking a look at shares of Intuit, they were initially impacted by this report. Now, shares closing up higher today, up just around 3%, along with the broader market rally. Let's switch gears here, talk about another company that's a favorite here amongst investors. It's Netflix, and they are on a spending spree. We've known that for quite some time, but they are willing to pay up for content. But the amount that they're paying per episode for some hit shows, it might shock you. Senior entertainment reporter Alexandra Cannell is digging into the numbers for us. And Ali, I was reading tens of millions of dollars per an episode of some of these hits. Do I have that right?
Yeah, you do, Shauna. It's quite crazy. We know that Netflix spends roughly $17 billion annually on content. But as we're saying, some of these numbers are out of this world. According to the Wall Street Journal, the upcoming season of Stranger Things, which will debut later this month in 2 installments, cost a whopping $30 million per episode. And, you know, that made me get a little bit curious when it comes to some of the most expensive TV productions out there. And spoiler alert, it's not just Netflix that's spending a whole lot of cash. So let's start with Friends. This is one of the earliest shows to really double down on a big budget, mostly due to the cast and their demands to be paid equally. By the final seasons, all 6 members of the main cast were each raking in $1 million per episode, thus contributing to that sky-high production cost of $10 million for NBC. And you can see that NBC dealt with a very similar situation with ER, given George Clooney and keeping him on board. And then, of course, we have Disney's The Mandalorian, Game of Thrones, The Crown, all those shows with double-digit production costs. But let's get to the high rollers here. One of those being The Morning Show. We have big A-list stars, Reese Witherspoon, Jen Aniston, Steve Carell, Apple TV Plus throwing $15 million per episode for this series. But let's take a look at the upcoming Lord of the Rings that will debut on Amazon Prime Video. If you thought the final season of Stranger Things at $30 million per ep was a lot, this blows it out of the water. According to Variety, Amazon is spending $465 million to produce the first season of this show. That means each episode is slightly above $58 million in total cost. It's just absolutely insane. But these are what the price is right now for content.
And I will watch Rings of Power every single minute, so at least they get a little bit of money out of me, I suppose. But then how exactly have these types of shows really helped fuel the surge in content spending that we've seen in recent years? And in terms of the expectations for 2022, are they even higher?
Expectations are super high. It's more CGI, more A-list stars, more premium content. That's what consumers have become accustomed to. And that's been fueled by streaming. According to Ampere Analysis, streamers helped content spend grow 14% year over year in 2021, resulting in more than $220 billion spent for 2022. That firm expects the number to be even higher, with content investment exceeding $230 billion. Again, primarily driven by subscription streaming services. Of course, there are a lot of hurdles that's happening when it comes to streaming platforms right now. We have subscription fatigue. We have some churn in the space. Netflix is dealing with a lot of those hurdles head on. But at the end of the day, content does go a long way. Netflix still has a lot of subscribers worldwide, well over 200 million. And we're seeing a lot of these other players now spending as much as they are in terms of keeping up with some of that content. And if you're a player that can't, that's when I think we'll see more consolidation and M&A in this space overall. So Dave, I don't know if you're planning to watch Stranger Things, but if you do, just know you're watching a heck of a lot of money per episode.
I've never seen an episode. Not one.
Me neither.
Okay.
I know.
Okay, both of you.
We're in the minority, though.
Stranger Things.
Ali, thank you. May the 4th be with you. Today is Star Wars Day. If you didn't know, check your trending Twitter topics. It is #1. Disney did not disappoint on this day, unveiling a new trailer for its Obi-Wan Kenobi series, which debuts May 27th on Disney+.
They're coming. Stay hidden, or we will not survive. Leave us alone. When the time comes, he must be trained. Like you trained his father?
Oh, Ewan McGregor, Hayden Christensen's going to be good stuff. 2 episodes come out initially and then 1 weekly. The latest installment in Disney's expansion of the entire Star Wars franchise. It spawned big business at the company outside of movies and shows, including the Star Wars Hotel at Disney World, which technically is called the Galactic Star Cruiser. And they don't want it to be labeled a hotel, but they want it to be a, quote, immersive experience because it is all things Star Wars. You are surrounded in it 24/7 role play. You stay in a Star Cruiser, and it ain't cheap. Prices start at $4,800 for a 2-night stay, or start at $6,000 for a family of 4. And if you go during a popular time, add $1,000 to that price tag. Disney is everywhere with all Star Wars products, but what shocked me is not the price tag, it's that this one, Shauna has never seen a single episode, a single movie in the Star Wars series. How?
I don't know. And you know what? I've heard so many people have told me to watch it, you included, or you were shocked when I told you about an hour ago that I had never seen a minute of it. People love it. Obviously, if you take a look at the numbers, take a look at the number of spinoffs that have been successful. Rochelle, I'm clearly missing out on something. What do you think? Are you a big fan?
I'm like 2 steps away from where you are. The only one that I have ever managed to stay awake for was Rogue One. I'm sorry, I have tried. I fall asleep every single time. All credit to Star Wars. When you want to talk about a franchise that has made everything based on a few movies, when you talk about the merchandising, the theme parks, this is a dedicated fan base. I do respect it. It's not my thing. My favorite part of Star Wars is Darth Vader. I don't know what that says about me. The bad guys, they have the better fashion, the better villains. I'm sorry. I wish I could be into it. I will probably try again to watch all of it, the spin-offs, the cartoons, all of it. But for right now, there's too many other things for me to watch. A lot, yeah, years worth.
It's remarkable what Disney has done with it. Just at the time it looked like Star Wars was fading from our conscious, it is everywhere. And again, check your Twitter timeline. It has exploded all day long, and it's only going to get bigger as they continue to roll out new things. So I'm going to get this one to watch.
I'm going to watch it.
Like
I know I'm going to be hearing from one of our bosses, Ken Underwood, who I know is a huge Star Wars fan right after.
Well, he's got good taste.
Rochelle.
Well, you're gonna need some sustenance to get through all of that. And speaking of that, on the other side of this break, we're taking a look at cereal that you add orange juice to, Tropicana Crunch. Going for an interesting move here. We'll have a taste test just ahead.
is a new twist to your morning cereal. Maybe it's not for everybody, but forget the milk. It's all about OJ. Tropicana launching Tropicana Crunch. It's a cereal that you eat with orange juice in honor of National Orange Juice Day, which is today. Brooke De Palma is here to help us taste test the new product. And Brooke, I have to admit, when I first heard about it, I was a little bit skeptical, but what could we expect?
Well, Shauna, you're not alone in being skeptical, because I certainly was too. A bit nervous about orange juice inside my cereal, but it actually turns out that about 15 million Americans have at least tried orange juice in their cereal. Now, it comes with oat grain flakes, whole grain oats, as well as brown sugar, sliced almonds, and crisp rice. So if you take a closer look at what's in it, it looks pretty much like every other cereal. Nothing too crazy. But now what is crazy about this is the fact that they encourage us to share this with this orange juice.
Because our kids need more sugar. They absolutely need more sugar.
No, I was going to say that this actually was sold out. So it went online and they posted around 1 p.m. Eastern that this was all gone. It was complimentary. You know, you went on, you tried to get it. But of course, this is about $4. So for a free cereal, $4 orange juice, it's not too bad. And, you know, it's serving 3 of us.
We have to try it. What actually is the cereal as I take a bite?
It's whole grain oats, those flakes, those crisp rice. I feel like we should mix it all together. I hear a crunch.
It's actually pretty good.
Oh, no.
I think it's fantastic. Yeah. I love collabs.
Why didn't I do this earlier?
I'm all here for this one. But, you know, your face says you don't like it.
It's peculiar. I'm definitely used to eating cereal with milk. I'm a big granola person. So if this was by itself, I think I would like it a bit more than with this Tropicana orange juice, but it's not bad. Now, it did also come with a straw, 1 straw inside of the box. So for people who necessarily don't want to eat it together, you could sip out the OJ and then eat it alone. It says, you know, of course, environmentally friendly paper straw here. But, you know, PepsiCo back in August, they announced that they were selling sales of Tropicana brand for $3.3 billion that was. And this really comes, as you said, you know, high in sugar. PepsiCo really looking to diversify their portfolio here and perhaps do less sugar and more healthier alternatives. But the cereal, pretty healthy here, not too much sugar in that. Whole grain oats, flakes, you know.
We don't really think this is going to last. I mean, it's a cute promo, but is this built to last?
It should last.
Only
it's really
for
good.
today.
It's really good. I
Only for
enjoy
today.
it. But yeah, it's more of a jumping on the International Orange Juice Day.
Exactly. National Orange Juice Day is only today, May 4th. Also, I know Star Wars there, as you mentioned before. But it's only for today. And like I said, it already sold out. So whether or not they'll bring it back, well, we'll have to see.
Well, we got to get Rochelle into this because she's not taste testing it with us right now. But Rochelle, you've heard our reactions to people who are fans. One person's a little skeptical. How are you feeling about all this?
So, I mean, I was going into it skeptically for a number of reasons. One, I just don't like frankenfood. I don't like mixing things that don't make sense. What am I washing down? What am I washing this down with it if I'm not washing it down with my orange juice if it's already in the bowl? I don't know how I feel about the straw coming with it, kind of getting the cereal and the juice mix at the end. I'd be willing to try it. I'm not a fan of frankenfood. My daughter is, so I know she probably would be willing to try it. But, you know, I would be willing to give it a try, but yeah, I'm not sure what I would wash that cereal down with. Dave seems to be a fan. Look, he's going for second.
My second bowl.
Oh my God, this is actually his dinner, Rochelle, if you didn't know. This is why he's currently chowing down. So forget the breakfast. Cereal is now dinner. And you know, people are really eating whatever during this COVID-19 era. Trends are continuing, so Dave, you're not alone.
And Brooke, it also speaks to the fact that these brands are not doing this, obviously, as a publicity stunt, but they are. Do you have any idea just in terms of, does it help sales? Does it generate some, I guess, added buzz around these products?
I mean, absolutely. On Monday, we saw Krispy Kreme. Rochelle, you did get to try that one, but we did see Krispy Kreme come out with those cinnamon glazed donuts. And as you guys know, it was hard for me to grab some for you guys. We were looking around New York City. We were working with the Krispy Kreme team just to grab some. So certainly people are flocking to these interesting takes on breakfast just because, you know, you love Tropicana juice. You also love cereal. It really, you know, those at-home type foods really became so popular during the COVID-19 era that it's almost like a why not? It certainly brings more attention to the brand as well.
The why not is it's the only way we get our kids to drink milk. I'm the father of 3. That's the only way we get them to drink milk, Brooke. But thank you. This was delightful. It was a nice way to
I'm glad you thought
go
that.
into dinner here. We appreciate it.
Maybe we'll have it again sometime.
Our little appetizer.
Good to see you.
Enjoy, guys. Well, before we go, let's get a quick check on how markets wrapped up the day on this Fed announcement day. As we saw that all three major indices rallied after that announcement and the press conference of the 50 basis point hike. The Dow there up about 2.8%, the S&P 500 almost 3% there, and the Nasdaq, the big winner, over 3% for the day. Well, that does it for Dave, Shauna, and myself. But Yahoo Finance will be back at 9 a.m. and we'll be back at 3 p.m. Eastern for your next installment. Do join us.